Test one, two. Hello. Good morning, everyone. Thank you for being here bright and early for the second edition of the Vault Summit. I know there were some parties last night, so appreciate you guys being here. And yeah, so we have a packed agenda. Today we'll be covering talks on how institutional allocators are evaluating vault strategies, what compliant vault design should look like, and how risk propagates throughout vault systems and how we can manage those risks. Of course, a big thank you to our hosts, Morpho, for making this edition possible, as well as our other sponsors. You can see their logos on stage. And so, like I said, we have a packed schedule, so there won't be time for Q&A in the audience, but if you have any questions for our speakers, feel free to grab them in the networking area. And I think without further ado, we'll kick off with the first session of the day, which will be about deploying capital into on-chain vaults. With our speakers, we have Nenta Chow from Bitmart. He will be moderating the session. We have David from Fasanara Capital. We have Laszlo from Kiln, Patrick Barrett from MembersCap, and Thomas Leffert from Exponent. Welcome our speakers on stage, everyone.
All right. First of all, thank you for having me. Pleased to be here. As mentioned, my name's Nathan, the global CEO of Bitmart Exchange. Today's panel will be deploying capital into on-chain vaults, and the focus is really what it actually takes for institutional allocators to move real capital into on-chain vaults, including the evaluation process, internal hurdles, and what live deployment actually looks like in practice. By way of background, I also came from TradFi before moving into crypto. And the questions that we've always asked for about any new instrument were always related to the risk management side of things. Can we custody it? Can we explain it to a client? And also, when can we exit when we need to? And I know this is a more institutional focus, and there's a few topics that the organizers would like me to cover. But I think that just to kick things off, I think most recently, I'm sure some have come from DAS. I think you you had mentioned that earlier. On-chain's the talk of the town. Now, I saw something interesting online on X that, after having conversations with multiple trading firms, the view is that on-chain vaults are really sort of the best way for a lot of these trading firms to sort of get retail participation and bulk up their AUM. How do you guys feel about that?
Let me start this. So my name is David Vachev, and so I'm head of tokenization at Fasanara. Now, to set the context on this, Fasanara is a real-world asset manager focused on asset-backed lending. So we make a lot of our yields via effectively short-duration credit. And we're quite unique in that we also have an in-house crypto hedge fund. So we're very DeFi native, and we've been this way since 2018. So we have a bit of both the RWA side and the DeFi side, and my role sits at the intersection of that. Now, super interesting point that Thomas mentioned. The way we look at vaults and how we assess them is almost like a container which has something of value. Now, what's so game-changing about this is once you make this programmable using smart contracts, composable within DeFi, and allowing you to be able to have a new range of accessibility that wasn't otherwise possible, it's a complete game changer. And you have all of that visible to everybody on blockchain rails. So for us, we look at it, one, from a distribution side, but two, from a capital efficiency and risk management side, from our perspective.
Yeah, I mean, I can only agree on what you said. So we, Laszlo Szabo, co-founder and CEO of Kiln, we last year were the largest independent staking company. We're working with hundreds of institutions And we see ourselves as an on-chain yield platform. So we started to distribute vaults 2 years ago with some of our customers, 25 wallets, the like of Ledger, Safe, Trust wallets, where when you access these lending stablecoin vaults, it's actually us in the background that powers the API, powers sometimes the 4626 vaults itself. And we thought, okay, vaults, as you said, is going to be the next wave of on-chain yields, and this is a way how great on-chain asset managers that could be most of the time off-chain and will start to pursue these strategies on-chain to attract more users. Will use that framework essentially to power yields. We just thought, okay, how can we bring a better standard product to mix DeFi with real-world assets? So that's why we launched RailNet, this new on-chain state machine that enables an asset manager to build strategies composed of DeFi lending, liquidity providing on-chain perp stacks or real-world assets combined. I guess just on the point you mentioned, so we just announced our partnerships with FalconX yesterday, where they essentially offering on-chain vaults for Bitcoin strategies up from 4 to 6%. There's of course a huge opportunity to offer yield on Bitcoin. There's no yield on Bitcoin today, and the reason they're doing it, as you said, is because they had an hedge fund. It's the on-chain asset, the asset management arm of FalconX, Monarch, and they had a hedge fund for years, and they thought, okay, how can I access more retail capital, and essentially vaults enables that for them.
I'm Patrick Barrett. I'm the CEO and founder of Members Cap. So we're an institutional reinsurance manager based in Bermuda. So what we do is invest in a portfolio of liquid reinsurance exposures and deliver essentially uncorrelated yield. So I agree with everything that's been said. I guess the only thing I would say, and this is wearing the traditional asset manager hat, is it the fastest way? And it's probably the only way. I guess I'd quibble with whether it's fast if you're coming from a traditional perspective and you're sort of aligning what you're used to in a traditional world with what it takes to create a product that's actually going to meet the needs of investors in this space and be scalable and have the sort of risk parameters that are required to actually make it viable for a vault strategy. So I think if you are looking to distribute an RWA, really, this is kind of the only path available to you now if you want to scale to a large degree. So it takes some time, and there's a lot of learnings to it. But yeah, I agree with what's been said.
Hi everyone. My name is Thomas. I'm a co-founder of Exponent. Exponent is focusing on interest rate swap trading on Solana, and for us, vaults are a way to simplify access to those complex strategies. Rate trading is not something anyone can do. It's more for sophisticated participants. And so we started working on what we call strategy vaults to really open access to those complex setups you can do for portfolio construction on chain. So it's more, for us, it's more from a builder perspective, where vaults are a way for us to get distribution, onboard sophisticated asset managers who have the expertise to run the strategies on behalf of users, and on the other side, retail users who were kind of left out of those products and strategies can now access them and have professional players doing that on their behalf. So we really see vaults as the next logical evolution for portfolio construction in DeFi, where we've seen DeFi starting with those one-size-fits-all models, where all the protocols were trying to fit everyone under the same basket. Like you had pool-based lending protocols, you had AMM pools like Uniswap v2, where there wasn't really any active management possible on those primitives, and then it evolved so we could bring more capital-efficient on-chain products. So you had isolated lending markets, you had CLMM like Uniswap, where you have to actively manage those positions in order to make proper returns and outperform others. And so for a lot of users, this is too much. And so vaults are really here to act as a layer on top to let the professional guys do that, and users still get exposure to those yield opportunities without having necessarily the knowledge or time to run those themselves.
Yeah, appreciate everyone's perspectives. So, and I'll frame this around some recent market events, right? I think Resolve Labs was recently hit with an attacker using a single compromised private key to mint 80 million unbacked USR stablecoins with just 200K of real collateral. And the token crashed from about $1 to 25 cents. And that fake collateral was sitting inside multiple Morpho vaults. So when from your perspective, when you first proposed putting your tokenized funds, right, whether FAST or MCM, into on-chain vaults or accepting sort of new stable coins as collateral, what sort of extra checks did your respective investment committees or risk teams sort of demand? And after what happened with Resolve, did anything change to be more? Are they tightening that? Curious to know your views.
Yeah, it's a very good question, and I think the context is important here because just as Thomas's points here, DeFi was really built around crypto primitives. So all of a sudden now you have institutions coming, the infrastructure hasn't caught up yet. And examples like this obviously highlight this, but importantly, the most obvious audit you would do, for example, smart contract risk, wasn't really there. Like that was independent of the hack that happened. So there's multiple layers of risk and assessment. Now, the most important thing from us is really the actual credit underwriting. So we as an asset manager do this all day long, and this is our bread and butter. So we really want to ensure the soundness of that collateral and the solvency of this as a first instance. Then there's the liquidity component, and especially the duration mismatch that we have between some assets that get put on here and the liquidity needs of DeFi. And then also a very important one for the RWA's side of things, which we're involved in, is oracles, and because again, the data is only as good as the oracle receives it. And now, where does that come from? How is that verified? So for us, there's multiple levels, but ultimately it starts with, are we comfortable with the underlying collateral? Can we credit underwrite it? So if everything goes wrong, we're happy to own this at the value which we believe is fair.
Absolutely.
Yeah, the way we've been distributing a lot of these curators vaults on Morpho to some of our customers. So we've seen it's our job to explain, a lot of these platforms, what happened, how they could potentially enforce the unwinding, even in non-custodial vaults. These are features that we sometimes offer them. And I think the way you picture the risk is to decompose every layer. So for example, our head of asset management was the ex-CEO of Credora. Credora was the first vault rating mechanism in DeFi. And we explain data room, which sometimes we work with the asset managers so that they can understand the collateral risk, the LTV ratio of a pool, the smart contract risk, the audits, the governance of the smart contract, which in this case was lacking, and the overall liquidity risk of the pool. The other part is you need to pick your asset manager very well, or on-chain asset manager or curator, if they prefer to call themselves like this. And that means that it might happen, right? Elements like Resolve might happen. There's different strategies, different protocols, and you cannot be 100% sure that a smart contract is not going to be hacked. But at least you ensure that either the unwinding is done fast enough, through tools like Hypernative or just the team having the right monitoring tool in-house, or either they have the required balance sheets so that they can pay back the users. Because I can tell you that following the Resolve events, some of these curators or on-chain asset managers have been paying back the users because they want to preserve their reputation.
Patrick?
Yeah, I mean, I would just say when you're designing the overall structure, I mean, we're applying the same, perspective of diligence and working with you know, the sort of, you can call them even like institutional intermediaries that are sort of arising now to advise on various aspects as you're structuring these products. But I just want to go to a point. I mean, that David mentioned, and one of the things that's just so important for our overall risk management is ensuring that the product itself, you know, is actually liquid underlying, right? I mean, that's been one of the biggest struggles in the space, and I think it's why you've seen a lot of institutional managers struggling to scale their products because the underlying product itself isn't really liquid. And so I think you're seeing a bunch of products come to market. We have really had to go back to the drawing board ourselves to create something. And I think this is like one of the unspoken elements of trying to launch a product leveraging Vault infrastructure is your underlying product really needs to match with very particular risk parameters, liquidity parameters, yield parameters that don't come easy, right? High yield, low risk, low drawdown, and liquid are things that are very difficult to pair together. And so I think there's only a few asset classes, at least as the DeFi investment universe exists today, that are really kind of fit for purpose, you know, outside of purely sort of crypto native things. And so that is really our kind of biggest focus for risk management overall in a product that's going to be able to sort of meet redemptions and maintain itself without you know, a blow up.
Yeah, maybe just quickly as a Vault infrastructure provider, for us it's less about how, like, we don't think you can remove risks from those vaults. We think what's important is how you display them and make vault depositors aware of, for instance, the asset exposure, what assets you're exposed to when you deposit into this vault, as well as the protocols. If you have, or vaults are, can do cross-protocol interactions, which means you can interact between multiple DeFi venues. And so it's very important for us that the Vault Manager is able to translate the strategy into the UI, so users can understand when they deposit what could happen. How can I lose money if I deposit into this thing? Is it maybe because this Vault is exposed to lending protocols and so there's risk of bad debt, or maybe the collateral assets are more exotic and so there's illiquidity issues. So yeah, when we designed those strategy vaults, the goal for us was really to be able to almost like recreate this, you know, in traditional finance you have like a fact sheet with what the vault is supposed to do, what are the exposure, mandate, and all of that. And so our goal was to really replicate that, but also use the transparency that you have when building on-chain, because everything can be seen. If your vaults are fully on-chain, fully programmatic, depositors are able to see everything from the actual exposure, allocation history, and really get a sense of, okay, what could go wrong here, and am I confident enough to deposit into this vault and trust this manager to respect this strategy and follow it.
Thanks for that, Thomas. And you know, maybe I'll just follow up with the next question for yourself and Laszlo. From where you guys sit, institutional clients often have monitoring in place, right? But in the case of Resolve, you know, more full vault curators kept auto-supplying liquidity for hours after that depeg and didn't react fast enough. So what do clients consistently underestimate about setting up real-time risk controls and automatic circuit breakers in live vaults? And what would you have told them to build sort of before that first dollar would go in?
Yeah, so monitoring is obviously very, very, very important. I think for us it's also a bit different because, again, with Exponent's Vault, you can do pretty much anything. Like, you could interact with perp exchanges, you could interact with credit protocols. And so for us, when we talk to managers getting onboarded, it's really about making sure they know exactly what they want to offer. And so think about, okay, what's the vault mandate? What do I want to achieve with this vault? And not change it in the middle, because then depositors will potentially lose trust. Like, if you're depositing into a vault that's supposed to maximize credit returns and do some looping on Morpho, for instance. You don't want the vault 2 months later to start doing some market making on Uniswap or another order book on Solana. So when we talk to managers, we really try to work. I mean, it's their job at the end of the day to run the strategy, but we try to work with them to make sure it's clear what they're trying to offer. And then it's also easy, once you know exactly what the vault is supposed to do, it's easier to manage all the risks involved with that strategy, because you're not, like, you're constraining the strategy into something very specific, and you're not trying to do everything at once.
Yeah, I think first of all, we will work with the platforms and these institutional players, with essentially what type of DeFi protocols or real-world assets they want to be exposed to, and then they will essentially mission an asset manager to only allocate into these protocols or real-world assets, right? So in the case of Resolve, they will try to understand, the governance of the contract, the liquidity risk, the risk of depegging, and so forth. The second thing is, again, there's some of these vaults, they have admin rights to sometimes force exiting the funds back to their user wallets, either through their watch or through an automatic setting through IP native or other type of monitoring tools, where you say, okay, there's a hack happening, you can try to unwind as fast as you can. And if that's not the case, then they will work with the asset manager, which I might need to pay a bad debt, in which case this asset manager better be very well capitalized, potentially regulated. So I guess these are kind of all the elements so that you ensure platforms, when offering vaults to their users, don't get stuck in Resolve events if they happen again, and they will.
Okay. Well, I'll switch it over to the next one for David and for Patrick. So, you guys have obviously major allocations into on-chain votes, and to scale up, right, when everything looks stable. But now that we've seen what happened with USR collateral causing real losses and bad debt in several of these Morpho vaults, what would sort of give you the confidence or the hesitation to increase allocations? Again, if a similar sort of tokenized assets showed up. I know you guys had mentioned several key sort of criteria, whether or not it's performance data, liquidity, curator reputation, or something else. I'm curious of your thoughts.
Yeah, and not to repeat everything that was said, which is super important, and the parameters, but having a bit of context on this, we talk about asset managers. So we are an FCA-regulated asset manager. Now, we don't just snap our fingers and get that. So that takes a lot of time, and we have a fiduciary responsibility to our investors. Okay, on-chain, I can spin up a vault, and I'm called an asset manager, and I can curate that for you. And then who bears the risk? So from our side, it's really a case of how we see the industry evolving is who has been able to navigate both the real-world asset side and be able to actually do the credit underwriting, be able to understand how asset management works from a TradFi perspective, but also have that DeFi fluency to be able to deploy capital on-chain, to be able to lend, to be able to borrow, to be able to set the parameters and curate the vault, because that marries the best of two worlds. And what you find at the moment is the worlds are still trying to kind of trying to come together, and Patrick made a very important point regarding the liquidity elements which is being solved, but more broadly it's how somebody who's off-chain interacts on-chain and how they bring about the best practices of TradFi is really what we're focused on here, because as we've just mentioned here, you're not going to be able to remove any of these risks again. It's about risk management, which is what we do all day long.
Right, and you mentioned who sort of can you trust on the credit underwriting side. I mean, even with the best practices on Wall Street, I mean, we still see time and time over again those sort of underwriting. Wall Street still continues to take excessive risk over a period of time. It always comes sort of in ebbs and flows. And I think especially these days, what's been talked about a lot on the private credit side, not necessarily just the duration mismatch, but really sort of how liquid it is and how fast you can react, because all of these private companies, it's a lot of these are sort of they're not very diversified in terms of their actual businesses. So if it's one or two variables change, that can dramatically change the projected cash flow and debt repayment for the business itself. And and there's a lot more. I think folks in the sort of Web3 natives now are starting to also understand this more as they start digging into, okay, what's under the hood for some of these vaults and private credit related assets that are underlying. Do you have any sort of view on that? Because it just seems like we're taking very similar things have happened in the past. Just maybe you can call it subprime mortgages, CDOs, CLOs. I think on the loan side, these standards tend to change when folks have internal sort of goals and targets to achieve. So how do we kind of address this?
Yeah, it's an important point, and by all means, TradFi is not perfect. The only thing where I would say is a differentiator is the mechanisms of recourse are there. And so, again, whether they work perfectly or not, I think people in different jurisdictions know when things go wrong, what happens, whereas obviously in DeFi, it's very much not the case. Now, importantly, with what you mentioned within private credit also, again, it comes down to effectively a mismatch of expectations. Actually, nothing here went wrong at all. These are multi-year loans, direct loans to over-leveraged software companies that were effectively packaged as these BDCs that were sold as semi-liquid instruments to retail. So then retail does what they do and thinks it's a NVIDIA or a Tesla. They hit the sell button, and then you have this. Actually, nothing has gone wrong. Now, what is important, though, is what we've been discussing before about the underlying. So we at Fasanara do a form of private credit, which is asset-backed finance. Now, this is very short duration credit. Effectively, this is invoices, receivables, 30, 60, 90 days. So the liquidity is effectively self-amortizing. So we can match that and bring that into DeFi. And we start that as a base. Can you see? It would never really work if we had multi-year loans and we tried to package them into DeFi right from the start.
That makes sense. All of them are short duration. You can easily, it's very much liquid, and you'll receive that cash back. Okay.
Yeah, I mean, I'll just add on. I think we, always need to remind ourselves that we are at a frontier of what's happening in both technology, but also finance. And so what you're constantly struck by in these conversations is the leading lights, if you will, in this space, and you're having conversations and you realize sometimes you're talking past each other and just using different terminology, or you're not quite, there might be a slight nuance, or there's not a full understanding of what it is we do or they do. And other times there's just gaps in understanding, and then you realize it's because actually no one's really had to think about this as a first principles matter applied to a very complicated process with very, very heavy risk management on top of that, and then trying to game that out and figure out in a novel way, where are the risks to us, where are the risks to investors, where is the overall risk in this platform. And so this was to my original point about thinking of risk management. It just takes a lot of time to think through those things. And so I think when you start to see RWAs like Fasanara and ourselves, who come from an institutional perspective fundamentally as regulated asset managers, there's a lot of time and thought that needs to go into these things because it hasn't really been done before. I also think from the investor's perspective, sorry, my voice over the last few weeks of speaking in conferences has absolutely been shot. We're right at a point now where I think there's still not a lot of focus on, okay, what is actually in these products, and are they high quality yield products, or are they simply, are we focused on attributes that are sort of generically applied to them? So for example, in the reinsurance space, there's a whole range of insurance and reinsurance, but there's really only one sliver that's the institutional asset class, where you see pension funds and you see sovereign funds and endowments and big hedge funds. So it's important that there's a level of transparency there, and that when you are, from the investor perspective, diligencing a manager and ultimately a product on chain, that what what you're being sold is actually in the box, right? And so I think, where we are now, there will be a huge differentiation as certain asset managers figure out how to make liquid products with the right yield profile and the right risk parameters, while still putting in institutional quality, high quality assets. And I think those are the ones that are ultimately gonna succeed and scale over time, as incentives and other things kind of fall away on projects that maybe started with like a technology first approach, right? Ultimately, we need to start with product first, and what is the underlying investment manager's perspective, and then we're essentially applying technology for distribution, right? Now, it's not that sexy to talk about it that way, but that's fundamentally what we need to do.
Right. And when you mention distribution, I think the case is very obvious for distribution to retail with these on-chain vaults. But because of the summit and sort of what the focus being institutional here, what's the one thing, the first thing and the most important that would truly unlock sort of the capital from the institutional side to put more and allocate more money into these on-chain vaults? Because institutions have access, right? I mean, access is sort of the key. I mean, that's why it makes sense for retail. I see that point. You have it sort of opens up the access for retail, but what about institutions? Do they actually need to deploy on-chain when they can sort of get similar exposure in many other ways?
Yeah, I'm happy to. It really is. So firstly, operationally, just sort of the slightly boring point, very few asset managers or institutions can actually have the DeFi fluency to be able to spin up smart contracts and to be able to actually manage and curate vaults. But over and above that, it's really what is the opportunity size. So we saw this earlier in the year when gold and silver was moving, just the delta of those moves with the entire market cap of crypto. So it has to be something of a meaningful opportunity. Now, we've managed to find success in the vaults that we've launched here. It took a long time to actually structure the products this way, and so we continue to build that momentum. But it really needs to have a tangible ROI on the asset manager.
Yeah, I think there's not one thing, but three things. First, we said it since the beginning of the panel is the risk, right? Really understanding the risk, different layers, from the collateral to the smart contract to the liquidity to the protocol or reward assets quality that this strategy is being allocated to. Second is, I think most of strategies today are very lending based. You borrow assets, you loop it 2 times your farm. Not very sustainable when it comes to bear markets, right? You could argue a majority of these yields now are just incentives program from protocols. I think institutions, they get that. Once they understand where the yield comes from, they understand that a big part of that yield will need to come from real world yields and real world assets. So I think mixing DeFi but having real world assets on-chain portfolio would unlock big part of this institutional capital, because they will start to understand where the yield comes from. And the last part is compliance. In compliance, we see it in 3 different ways. But I think you have either KYT end-to-end when it comes to wallets. You have KYC at the vault level, and then you deploy into KYT type of strategies when it comes to an exchange. I would argue that some of these institutional players, they are comfortable only using KYC end-to-end type of flow. So they ensure that all the funds in the vault are KYC'd, and they ensure that the deployment of the strategy, either in a KYC pool in DeFi or a KYC real assets, is being pursued by an asset manager. So yeah, I would say these are the 3 things, and then just time. It will come.
Yeah, I mean, the first question they ask is, how does this fit into my risk framework, right? And it's very difficult for them to compromise on those things, which is to say it's impossible to compromise on those things. And so there's a lot of, I'd say, development from a regulatory perspective. Some stuff that's happened in the US maybe has opened up some pathways, for example, around stable coins, but it's like, how does this fit into my Basel III and Solvency II frameworks, right? That's just fundamentally how they're thinking about things. So that, yeah, I mean, that's perhaps the time element you refer to there. You know, and then the other side, to pick up on David's point, is scale is a really big thing. We get asked all the time, how much can you deploy? And if your answer isn't into the billions because the market supports that and isn't going to distort the market or distort what you're kind of able to do, you know, it's just not interesting as an institutional allocation, right? So those, I mean, there's 10 other things that are also very important, but I think those two are just the most basic table stakes that institutional capital, and it depends what we mean by institutional capital, but the big institutions, those things are just fundamental to first solve, and then ultimately we'll see scale, but those things need to be solved first.
Yeah, I agree on the time perspective. I think vaults are still quite like young and just now becoming a bit more complex than before. Lending vaults were really like the main type of vaults we were seeing on chain, and now we're starting to see more complex things like cross-protocol vaults, which can be way more granular. And so I think for a lot of those big players, they want to see some success stories, some track record to understand what's the potential for them to allocate time and efforts into either deploying into those vaults or even managing some vaults themselves. And they need to justify those costs. They need to justify like having a team focused on that. As we said, there's you need to monitor risks. You need like to allocate proper resources to it to do it right. So I think as soon as we're going to start seeing some of those vaults becoming very big and driving a lot of traction for asset issuers or driving good returns for fund managers, we're going to see more of them being excited and joining the race to also be part of this vault segment.
Okay. And because we're running out on time, I think the last question, and this is really for me too, because coming from the perspective of a centralized exchange, and you know, as you guys may know, centralized exchanges ultimately are now all employing sort of on-chain, the on-chain solution side, right? Whether or not it's your OKXs of the world focusing on their decentralized wallet or Kraken, so on and so forth. So for those that, I guess, you know, for my benefit, I guess, selfishly here, what, you know, there's obviously pros and cons, right? I think for, you know, some may view it as, okay, is on-chain a destination or just the final destination for some of these funds? Because ultimately that, you know, it's effectively the final distribution layer for retail is on the centralized exchange side, which will have, you know, sort of shift a lot of that potential volume into the on-chain world. Now, for an exchange that has not yet fully embraced that on-chain, the on-chain side, what's sort of the key benefit from whether or not it's an ROI perspective or just, you know, longer term business viability? If, you know, I'm just curious sort of your thoughts.
Yeah, I mean, look, everybody's chasing yield, and so this is why everyone's come to DeFi. This is why we're now talking about RWAs or so. Everyone's been doing the basis trade. It's completely effectively commoditized now. So this is why we're moving to DeFi, and people accept the risks. To your point about exchanges, the most obvious and simple benefit is a better consumer experience, but ultimately better yield, right? The idle stable coin reserves go into a vault, and you can see that happening already with Coinbase. It's happening with Kraken, various other exchanges. So it's the most obvious thing that you can do to your users.
It's most of the time in most region and jurisdiction regulatory edge. So MiCA is not considering on-chain yields and vaults. And you know, there's a lot of large exchanges in the US, same in Asia, that feel comfortable essentially linking non-custodial wallets to the exchange UX, so that the user doesn't feel he is leaving the exchange, but he's still allocating these funds from a non-custodial wallet once he click on I want to yield on that vault. So that I'd say that's the main part. The second main part is, like, of course, the yield quality, which I think you find higher quality on chain than off chain these days. It's also much easier for an exchange to manage it, to implement it, versus having to manage all these yield product off chain, do the custody and the trading and the settlements daily themselves. If they wouldn't use a vault. So yeah, it's a better product.
Yeah. Well, we're running out of time here. Do you want to go?
Yeah, I can go. Just to quickly add on what was said by David and Laszlo, I think it's vaults are a way for exchanges to offer safer yield opportunities. Like, rather than trying to build themselves those strategies, they can work with curators and work with them on what kind of assets they want to offer to their clients and customers, what kind of strategies, and vaults offer a safer environment for the strategies. And we're starting to see really interesting success stories there, like Kraken recently and Veda working on some vault to offer that to Kraken users. And if done right, I think it's a very good product to offer to customers. And as David said, a lot of the main reason people come to DeFi and interact with those on-chain products is for yield. And so for those exchanges, it's a very big segment for them to be able to tap into those on-chain yield opportunities and offer them in a more controlled and a safe way to their customers.
Absolutely. The chase for yield, as David had mentioned, is exactly what I think every sort of market participant, especially in DeFi and Web3, are after. Well, thank you very much. I've certainly learned a lot from you guys on this panel, and it was a pleasure to host and moderate this one. So thank you.
Thank you. That was fun.
Okay, please give us a moment while we set the stage for the next session. Okay, next up, we have Chris Walker from Credit Coop, who will be talking about follow the money payment flows as collateral. Welcome, Chris, on stage, everyone.
Good morning, everybody. Is this on? Check, check. Great to be here, guys. Thanks for having me. Today, we will be talking about how Credit Coop secures payment flows as collateral, and we see this as a huge opportunity for the space, and I'm sure you'll hear more later. So this slide here, Credit Coop, for those of you who don't know us, we are an on-chain credit protocol, and what we do is we enable payment companies to get working capital and increase their processing capabilities with MasterCard, with Visa Network, with their users. And we do all of this all programmatically on-chain. So this slide here, what we're showing is today's day and age, we've got the expectation of instant settlement, whether you're a consumer app or a business app. And on the left-hand side, we have cardholders. They can pay on any single chain, and they can do that instantly. The reality is, in this world, merchants and the networks that use these payments don't pay out every single day. So what happens is they have a lag, and they either fund that with their balance sheet, secure it with, if they're a bank, they have deposits, or they use credit. And this is where we come in for non-bank issuers on Visa Network specifically. We help them fund this 2 to 5 day gap, depending on where they are in the world. This is a very acute problem for smaller companies, especially seed stage startups, even Series A startups. As their volume increases, so does their need for that capital. So on this slide, the darker the shade of purple, the more manageable this float is. If you do $1 million a day, you must have at least $2 million locked up, sometimes up to 4 times locked up, depending on how well your relationship is with Visa Network. They have different collateral requirements for different issuers and different payment processors. On the very bottom, you can see how extreme this can get when you have $500 million a day of volume. You may have upwards of $1 billion locked up that's not used for hiring, that's not used for marketing, or potentially acquiring companies. And effectively, for these non-bank issuers, you are limited in a sense of volume by the scale of your balance sheet. Again, that's either equity or debt that they're using on their balance sheet. We see this as a problem, and we are working to enable all these non-bank issuers to not have this float problem and not have this scale issue where they're limited to that balance sheet capacity. And right now what's happening is more and more non-bank issuers are participating because we're getting a lot of regulatory clarity. In the United States, the OCC has recently made out a request for comments for implementing the Genius Act. This has been a huge driver of demand for stablecoins, specifically in the payment space, since July of 2025. Expectation is this will continue to increase over 2026 and be implemented no later than January 18th of 2027 in law in the United States. Additionally, we're getting some clarity from SEC when it comes to broker-dealers. So historically, guys, if you were a broker-dealer and you wanted to settle a trade for your client in a stablecoin, you had to haircut that 100% on your balance sheet. So no broker-dealer in the world would ever really do this because they're also capital constrained. And there's been some changes in the United States with the SEC that effectively view stablecoins as money market funds. So instead of a 100% haircut, now it's a 2% haircut. And there's the ability for more broker-dealers to participate. This is shown in the data that we're seeing. The market is growing very rapidly. Stripe last year processed nearly $2 trillion through their network. And the expectation, again, is that continues to grow. That's a 34% year-over-year growth number. Pretty impressive when you consider the scale of Stripe. Slash is a Visa card issuer. For those of you who don't know them, they use stablecoins to do payouts, to do card issuances, and do corporate cards for their clients. They processed nearly $4 billion last year. This is a number that 1 year ago was, $250 million annualized. So very rapid growth there, 16x just in 12 months. And the other element here is, in the trend of non-bank issuers, you also have private credit funds that are looking to have this digital layer. So Christine is walking in right now. Apollo is participating on chain and finding these different protocols to interact with. The same can be said, right, for Blackstone, for KKR Credit, for Ares. They want to tap into this market, and this is a really nice tailwind that we see when you combine the regulatory, the broker-dealers, and then the private credit funds participating in non-banks. So why is this exciting for these participants, and how do they actually participate and secure those receivables? With Creditcoup, we've created a smart contract that acts as a controller of that cash flow. So effectively, what happens is we programmatically route those payments directly to the end destination. So at Visa Network, how that works is you swipe your card today, the issuer has to meet an obligation at the end of the day with the network based on all of their user swipes. What happens is we front that money, advance it. We're working through some things with Visa to be able to do this direct. Currently, there's one hop, so we push to the card issuer, and then they push over to Visa for their obligations. At the end of the month, when everybody pays their bill, those payments flow through programmatically and actually repay that lender's advance that happened 30 days prior. This happens automatically, and no funds ever hits that card issuer's account. Why that's exciting is, as a lender in asset-backed finance, you don't have to trust that the borrower will ultimately pay you. It happens as their business grows, as their customers use their card products. The other element here is, in asset-backed finance, you really need to control the receivable and have a super priority on that. In traditional finance, they accomplish that through SPVs, through securitization structures. At Credit Coop, we accomplish that by the spigot. And that has a controllable electronic record for your super priority position that no one else can have a claim on. So even if there's a UCC1 filing, even if others, lender-to-lender warfare is very real in traditional finance, have competing claims, you as the person in control don't have to worry about any of that. And this is in 25 out of 50 states in America. We'll continue to see more states adopt Article 12 of UCC, which has this definition of controllable electronic records. The other element that's pretty exciting for participants in asset-backed finance is the real-time nature of all of this. So because everything's on the blockchain, and because we have data feeds from Visa Network, we're able to look at traditional coverage ratios, your liquidity duration, any deviation that happens from the underlying velocity of that cash flow can be monitored in real time. That's a pretty exciting proposition for people who are looking to deploy billions of dollars and are accustomed to, at best, right, a monthly report that's looking back versus a real-time monitoring and solution. This slide here, I'll start speeding up here as we're running out of time. This is a step-by-step kind of walkthrough of how we accomplish this. So in traditional finance, warehouse lines, right, can take 90 days. On the blockchain, this takes less than 1 second. On Solana, milliseconds. On Ethereum, 12 seconds. Because of this, card issuers that are non-banks are able to enjoy the benefits of securitization without having to spend $1 million on legal, on structuring, on rating agencies, and they don't need that scale, right, that traditional finance has. Our first borrower started with $20,000, and now they're doing $250 million a month of volume because of some of these benefits that they're able to rapidly scale on chain. I'll try to flow through here. You can see here some of these metrics are pretty impressive in the traditional credit sense. So for those of you in the room who do asset-backed finance, if you do real estate finance, typically you want to see 1.5 coverage ratio. These borrowers are growing so fast, and because their need is so acute, right? It's just 1 day of settlement. They're able to cover their debt many times over with this cash flow, and this is why we've had no defaults over close to $1.5 billion of volume at this point. We've created another metric we call the spigot repayment rate, and what this means is, same thing as a coverage ratio, just over 31 days, how many times does the cash flow cover the actual debt obligations? And similar to the coverage ratio, the repayment rates are many multiples of their obligations, just over 30 days. We see this around the world, whether they're US issuers, European issuers, Latin American issuers. It all looks very similar in their needs. So as we scale this market opportunity in 2026, we're really excited about the regulatory front. Visa using stablecoins in an end-to-end loop. To date, they focus mostly on the card issuer side of the stack, and later throughout this year, they're going to be working more on the acquiring side and processing side. So as we scale our protocol throughout 2026, we'll be launching our Vault product to the public. The receipt token's called CCUSDC, and then throughout the year, we'll be integrating and making composable with DeFi. So working with Morpho to have leverage looping markets where CCUSDC serves as collateral, working with Pendle to have a stripping of the principal token from the yield token, and then in 2027, we'll open this network up and really scale to further grow the stablecoin settlements of Visa Network, of MasterCard, and the 15,000 participants in those markets. Just to sum it up here, we followed the money, and what we found is it's a really attractive business for asset managers to lend against. This ecosystem will scale over the next 1, 2, and 5 years. Some estimates say 10x in 2026, putting us at a place of 30 to 40 billion of stablecoin linked card spend in 2026. Some people say 30x, right? Some people predict 90 to 100 billion dollars. This would be rapid growth from where we were in 2024. Again, $250 million of annualized spend. 2025, we ended the year at $3.5 billion. So there's a lot of room to grow here, and that's even not even scratching the surface when you consider Visa alone processes $15 trillion in their card network. MasterCard does $10 trillion. That's $25 trillion. And even at a place of $100 billion of annual volume, we're not even a fraction of that yet. So a lot of room to grow. For those of you in the room who are asset managers, we'd love to speak with you about some of the opportunities in our pipeline. If payment companies are in the room, we'd love to chat with you about your working capital needs. And thank you for having me.
Okay, thank you, Chris. Next, we have a fireside chat with our moderator, Dennis Bree from Morpho, and speaker Hong Kim from Bitwise, who will be speaking on-chain vault strategy through an asset management lens. Welcome our speakers on stage, everyone.
Thanks for having us. Excited to be here.
Glad to be here.
Hong, when we were getting ready, Hong, he wanted to mic up specifically, so he didn't want to hold one of these. We thought maybe there's going to be physical activity involved, but no.
They said I should mic up, so yeah.
All right. Well, super excited to be here. I'm Dennis Bree. I head institutional growth for Morpho, and then we have Hong Kim, CTO and co-founder for Bitwise. Super excited to have this conversation. I have known Bitwise for a long time. You guys have got an impressive 8-year track record. I think you've got 1.5 billion in assets and something close to over
15 billion.
50 million.
Yeah,
50 million assets. I undersell you. And across 40 different crypto products. So tell us a bit about Bitwise and what you're excited about this year.
Yeah. Maybe also just for the crowd, I'm the CTO of Bitwise, so I don't do this type of public speaking often, so it might be a little bit more raw. But hopefully that's more interesting to you. And yeah, also would love to just take the conversation in any direction that's kind of helpful for the audience and more engaging. I know these things can be a little bit dry. So
This is
yeah.
going to be fun. We're going to make
Yeah,
this
yeah.
fun.
Let's just try to. I'll try to keep the responses short so that you can kind of Let's only 15 minutes here. Bitwise, 8 years, about 200 people, 15 million in assets. Mostly people know us for ETF products, but we have SMAs, private funds, derivative products, have staking. Now we're getting into vaults, which is the conversation here. Yeah, we're a specialist asset manager. We're trying to be the asset management firm that people can trust. And Vault is on-chain asset management. So we're here.
So
And that's what I'm excited about for this year. Yeah.
That's what you're excited about for
Yes.
this year. Good. Tell me about the decision to move into vault curation. How is a firm dealing with mostly family offices, RIAs, traditional institutions? What kind of led you to that decision?
Absolutely. So Hunter and I started the business in 2016, so this is year 10 of building Bitwise for us. And it's not like in the past 9 years we didn't want to offer products directly in DeFi. But we're an onshore regulated firm in the United States, and to be honest, it was a pretty tough environment to be engaging, building products directly in DeFi. And this is finally the year that we can do that from a regulatory environment perspective. So I think one reason of the why now is that. And also to answer your question about kind of I do think that there is, at the beginning, not all of our kind of TradFi customers will be like the RIAs, family offices, like people that have total connectivity to brokerage accounts and all of that, like comfort there is not really the immediate target audience of Vault, I think. Right. Basically, the reason that we thought this is something worth doing, I mean, the entire TVL and Morpho maybe on the Vault side is 2-3 billion or so. Bitwise has more AUM than that. Right? So in some ways, it's not the immediate opportunity that makes it compelling for us to be investing so much into Vault. It's the future. And the reason the future is very clear is because of stablecoin growth. So like people talk about on-chain asset management, but really a big part of it is stablecoin asset management. Ultimately, when dollars transform into an on-chain wrapper for one reason or another, whether it's utility or cost or efficiency, stablecoins are coming online, all coming on chain, and to serve them, if you want to serve products, investment products, asset management products for stablecoins, then you need to meet them where they are, and that is on chain, and that's basically Vault. So because we believe in the stablecoin super cycle, it's very obvious that this is where we should be.
So were you front running the opportunity, or were you having active demand from your customers around on-chain finance, Vault curation?
Yeah, so we have a wide range of customers from the very traditional side. For example, we have like 10 or 20 banks or broker-dealers in the United States that we serve kind of their traditional customers on. And this is your financial advisors, institutions, endowments, like the whole spectrum there. But also we have staking products. We stake about something close to maybe 4 or 5 billion of assets. And on that side, we have exchanges, wallets, fintechs, public companies as clients as well. And I think from that side, we saw demand around earn products, basically, yeah, kind of stablecoin yield products from mid last year, pretty clearly, and we've been figuring out if we can offer this product from our company. But I think that's where basically everyone that is thinking about integrating stablecoins in a serious way into their platform, whether that's fintechs or et cetera, or the ones that already have stablecoin balances with the customers, is really where the immediate need is. Like, I don't think a Morgan Stanley advisor is suddenly really looking for on-chain vaults, because their needs are very well served. Their clients are, yeah. So I think over time, as the space matures, there will be even something for that crowd. In the same way that stablecoins were initially developed for kind of on-ramp, off-ramp to crypto exchanges for trading, right? And then those rails got developed, and then all the AMMs or lending protocols, even more, all were built for DeFi use cases. And then now it's porting into more TradFi use cases as well. I think vaults will likely go in the same way as well. It will first be dog-fooded or used internally for all the kind of natively on-chain or kind of stablecoin asset management, and then it will evolve to a point that it will just be more efficient and easier to use for the traditional use cases as well. But I think that's not where we will go first.
It is interesting. I mean, one of the things that I was surprised about is how quickly institutions are moving towards vaults, right? Lots of questions around regulatory, compliance, legal, security as they get comfortable with it. So walk me through, like, how's curation?
I think institutions moving to vaults, though, is like the institutions wanting to serve the crypto user base, the stablecoin user base, right, the on-chain user base. Okay. So I think it is more of a business expansion move for them rather than a vehicle to more efficiently serve their existing user base. I think that will come, and that is part of the kind of 5 to 10 year time horizon plan. So I think those things will happen, but it's not something of now. And if you think about it, like until the full kind of backbone of a lot of like securities, for example, are a little bit harder to move around on chain in a permissionless kind of manner. There's still a lot of things to work through, KYC or like rules. Like it's yeah. So for the entirety of TradFi's like workflow to all wholesale move over and say that this is more frictionless and efficient, I think that is, I mean, we'll get there. I'm very optimistic that we will. And like Genzer is saying that we'll bring all of finance on chain in his time. So we'll see how far we get in that moonshot. Right. But like there is a lot that we need to get through as well.
Okay, I have lots of questions on that. Tell me about how's curation going? What does the team look like internally that manages that? Like, I'm super curious on how you're thinking about risk management. This is a relatively new space for most of your customer base. As you say, they're not there yet. But as they start thinking about that, what have you set up as a team today to do curation? And tell me a bit more about your risk management strategies on a high level.
Yes, we have a portfolio manager who did kind of 17 years of credit and TradFi side of things, and then recent years in DeFi. His name is Jonathan Mann, who leads the team with associate portfolio managers and a few quants and engineers. It's kind of a more like systematic type strategy team, and a little bit different from the more kind of, if you think about our Bitcoin ETF or Solana staking ETF, I mean, there's a little bit more components, but those are more passive investment products. And these require more systematic allocations and more real-time, block by block assessment and evaluation of allocation, or kind of pulling back liquidity, assessing LTVs. All those things need to happen in a more programmatic real-time way. So it's a different type of team and engineering effort that is required. Part of what makes it a bit more appropriate for Bitwise is actually Hunter, my co-founder and CEO, and I both come from a more technology background. Hunter was a product manager at Facebook before this, and I was a software engineer, studied computer science. We've built an asset management business over time, and the rest of our executive team comes from the TradFi side, and we've kind of learned what that looks like over the past 10 years. But building technology or kind of more systematic kind of approaches to directly kind of on-chain asset management is a very exciting journey, and it's something that we've been on for the past year or so. Yeah, does that answer your question?
Yeah, it does. So one of the things I'm curious about is I talk to banks, fintechs, about whether it's about an earn program or whether it's about something else. What do you think are the things that need to happen from a regulatory perspective to really start to act as a catalyst for your RIAs, family offices, that side of the business to start looking at on-chain finance? What are the things, if we fast forward maybe 12 months and we have a great year, what are the things that need to be in place for them to turn around to you and say, hey, we're interested in on-chain finance, we're interested in this program, we're interested in a yield program or this use case? Talk to us.
Yeah, if we're talking about like 12 to 24 month timelines, the likely reality is that one approach that we're taking probably will be out in the market sometime in the next few months is just wrapping vaults in ETF wrappers, and then bringing that to market. Because that's what Bitwise has learned a lot is that in financial products, like any other products, like even like software products, what you know is that friction matters a lot. And if you bring down friction, then usage grows meaningfully. That's the lesson of Bitcoin ETFs. People thought, there's a million ways you can buy Bitcoin. You can buy it on PayPal, you can buy it on Coinbase, and you've had that for 10 years. Why would a Bitcoin ETF have any attraction, right? But turns out there's been $60 billion worth of attraction. Because ultimately people, you're just not going to open up another Coinbase account for 2% of your clients' assets when you have 50 clients that you need to manage, and a lot of public market. So I think the first likely bridges the most popular bridges I think will be built that way, where people don't even have to necessarily learn a whole new thing. If you, for example, package like vaults into ETF wrappers and make it available in brokerage accounts, that's like one way that if I practically thought about how would our the average financial advisor actually allocate into a DeFi yield-generating strategy, I think that type of approach would be maybe
So
more.
you're saying abstracting friction, moving that up?
Yeah.
Okay.
Both directions.
Yeah.
Yeah. Because that's also how stablecoin stuff is getting adopted as well, right? Ramp just this week announced that they're integrating stablecoins into their product. It's not that they're training their entire customer base about how to use stablecoins. it's just they're making it seamless into the back end. I think that will likely be similar in the TradFi adoption direction as well. Like the same thing that they know how to do, engage in buying an ETF or et cetera, and then in the back end, there's either the yield generation or efficiency, et cetera. I think that's more likely how adoption actually happens.
Okay. Maybe in the last 30 seconds, if there was one thing that you would like to see changed in the Vault architecture that you're experiencing today, what would that be?
I think we're at a phase where there's like too many Vault protocols. I think the meme where like everyone is like, there's too many protocols, and then the result of that is that they come up with another protocol to solve the problem of too many protocols. I think Morpho is great because it's very focused and simple around just lending markets, and everything is on chain in that kind of construct and primitive, and it's tight and it's opinionated. I like that about Morpho's Vault. Of course, it doesn't allow direct allocation into RWAs. It doesn't allow leverage in any way. And these are things that people like to do in different contexts. So then I think there's now kind of a million flowers blooming. Every curator has their Vault protocol. Every chain, it's just kind of,
right.
Yeah. And I think there will be a phase where we consolidate into standards and a clarity of a few. I'm more so looking for that. Yeah. Ultimately, the things that you're trying to do is a straightforward set of things.
Right.
So I don't think we're at a lack of like expressiveness. I think more so the market needs a little bit more like these are the things that are tried and true and are safe, and we know the boundaries of them, and everyone has audited them. The compliance and risk teams have evaluated them. I think that is actually what's causing a little bit more difficulty in the customer conversations or product development conversations.
Yeah, makes sense. Thank you for this conversation. It's been fun. Thanks all.
Okay, next up, we have Thomas, who is joining us back again from Exponent. He'll be talking about how vaults can grow more sophisticated without sacrificing user protections. Welcome Thomas on stage, everyone.
Hi everyone. My name is Thomas. I'm co-founder of Exponent, and today I want to talk about how we can bring more complex vaults to on-chain participants without forgetting about protection for them, and how we can make risks from those vaults very clear to depositors so they understand what they're buying into when they deposit into those vaults. For context, even though we're not actually building directly on EVM, we've had tons of learnings from builders in this room. And I think the vaults we're bringing to DeFi in the coming months are very interesting and quite novel. So just for context, Exponent builds Solana's leading interest rate swap exchange. It's used for portfolio construction where participants can trade rates to hedge rate volatility, speculate on them, and essentially outperform market rates. We've been working over the past months on what we call strategy vaults, which are essentially vaults manager can set up to build and construct strategies on top of Exponent's markets and interest rate swap instruments, but also combine them with DeFi protocols like lending protocols such as Camino, as well as perp exchanges like Phoenix. For us, it's the way we thought about building vaults wasn't really as the core offering of what Exponent does. It was more, how can we evolve the core mechanisms we have for interest rate swaps on chain, and really offer the strategies to users who are maybe less sophisticated, but still want to access those yield setups and the strategies possible when you use and trade interest rate instruments. If you look back at DeFi and how portfolio construction in DeFi evolved, the first DeFi products we had were very focused on trying to bring everyone under the same bucket, where you had those one-size-fits-all models like Uniswap V2 style pools, pool-based lending protocols, which were not very capital efficient, but were enough to bootstrap some on-chain activity and get liquidity from day one. Over time, we've seen those primitives evolving and requiring more active management. So today, if you want to provide liquidity on chain, you need to actively manage that position, whether it's on Uniswap V3 or V4, in a CLMM pool where you need to actively manage the range. It's the same for credit, where we saw isolated markets and lenders had to become more sophisticated, understand the different collateral types, to really understand what they're underwriting when they lend those assets into those pools. And so vaults have been the next logical evolution for a lot of those new, more complex DeFi primitives, where essentially they abstract a lot of the complexities on behalf of users and enable professional managers to sell their expertise as well and generate additional returns from those users. For us, it's really a way to bring interest rate swaps to a broader audience and enable users to interact with those vaults to really customize how they want to earn yield on-chain. As I've said earlier, we've had a lot of learnings from existing players in the vault space. When we started thinking about the architecture behind strategy vaults, the goal for us was really to make sure this would be something that would be robust and could enable depositors to understand what they're depositing into. Because if you look in TradFi, you have some structured products where you just have a fact sheet and then you subscribe to it and you don't really know what's going on. You have the mandate, obviously, and the description, but it's hard for you to understand what's going on. And we didn't want to replicate that in DeFi with those strategy vaults where you don't see anything and you're almost depositing into a black box. So one of the points that was important for us was transparency, where you see everything on-chain, so all the vaults are fully on-chain, whether it's the strategies, whether it's the assets, and you can really check what's going on when you deposit into a vault. The second point was depositor protections, where even if you're not managing the position itself, you still have some guardrails to protect you, for instance, of a sudden mandate change. And so if you're not happy with that, like the vault manager suddenly decides to add assets you're not happy with, you can opt out, and if the protocol, the vault mandate changes, your assets will be withdrawn. And lastly, to have all of that on-chain, we had to integrate on-chain policies, which are essentially programmatic rules which enforce some actions and assets for asset managers, so they're not able to suddenly change something, and if they want to update the vault structure, they have to go through a time lock, and again, they can add those protections for depositors so they can feel more confident about what the vault is supposed to do and not suddenly start doing something completely different. So yeah, overall, just to give a quick high-level overview of Exponent strategy vaults, those vaults are really built with cross-protocol interactions in mind. So as opposed to some vault products we've seen in the space, which are very vertical in the sense that you just have one kind of activity ongoing, like credit, for instance, like lending vaults. Exponent vaults are built for using Exponent interest rate swap instruments and using that across DeFi, like for instance, locking rates on Exponent and then borrowing against those positions on Camino and doing some looping. But it's also for, you can do market making on an order book like Phoenix or Exponent rate order book. And so it's really broad, but we wanted to really make that clear to users what's going on and what the vault is actually doing to not be lost or not be able to double check that the manager is not doing something wrong. As I've said, we have specific, the manager can whitelist specific protocols and actions, again, to make it clear to users what's going on, but also to protect the funds that are deposited into this vault. The non-custodial part was quite important for us. And so essentially the manager doesn't hold any custody of the assets. The assets are deposited into a vault, which is very similar to multi-sig account, so multi-signature account. And then you have policies attached to this vault, and the manager can only allocate liquidity within those policy constraints. We have built-in depositor protection, as I've said. And lastly, something that was also quite important for us was to make it very easy for managers to share those vaults to their LPs and almost have a dashboard built in when they create a vault on Exponent. And so we really see, and I think a lot of people here as well, we really see those vaults as the next generation of asset management, but on-chain. And so we wanted to have really the perfect UI to essentially evolve on-chain asset management and have really clear details about what the vault has been doing, how it's been performing, did the vault lose money in the past, what kind of assets the vault was exposed to, what kind of changes was done to the vault, and everything is live. So if suddenly the vault manager wants to add a new asset, this will be reflected on the UI, and depositor can decide if they want to stay in or withdraw from it. Lastly, this is more for managers, but even though we focused a lot on depositors and making sure they can have some protection when depositing into those vaults, it was also important for us to make those vaults very easy to spin up for managers. And essentially in less than 7 days, in less than a week, they can create a vault and start collecting capital from depositors. We have a UI where you can easily spin up a vault, but and you can also do that through the SDK. And then to make it easy to create those strategies, we've built templates for all the major on-chain primitives you have in DeFi, like lending on Camino, providing liquidity on an AMM, or even doing some long-short positions on a perp exchange. So that was a quick overview of Exponent. We're here today the whole day, so if you're curators looking to offer more complex strategies, structures to your LPs, feel free to come to us. We're happy to share a demo of how it looks like. And if you're also a fund or asset managers looking to use those vaults maybe for private purposes for your LP as well, feel free to come to us. We're wearing some Exponent jackets, so you should be able to see us easily. Thank you, everyone.
Please give us a moment while we set the stage for the next panel. Okay. Our next panel will be about creating demand for vault strategies through consumer finance with our moderator, Dennis Bree from Morpho, and speakers, Debbie Soon from Privy, Mehdi from YO Labs, Calvin from Kraken, and Gabriel from Centaura. Welcome our speakers, everyone.
Hey guys, welcome.
Hello.
Looking forward to a fun conversation. So we have names and titles on the board, so we're just going to maybe jump in. We have a quick fire round, right? In one sentence, if you can do it. Tell me about what you're building, whether for consumer or institutional, and how vaults fit in. Debbie, start with you.
All right. Well, Privy builds wallet infrastructure, makes it really easy to embed money into your existing product. And where vaults fall into that is that the balances that you have in your product no longer have to sit idle.
Yeah, at Centaura, we do strategy management on vaults. So we are the vault product. Probably the best known one is Kraken Earn. We run a vault for the Kraken exchange.
Yeah, they do. Our product's DeFi Earn. We launched 8 weeks ago. Centaura, we're working with quite closely. I think we've done 150 million in assets in about 8 weeks. But vaults sit as a strategy layer, and we think about them as how do we use our distribution layer as Kraken and our exchange to kind of bring vaults to consumers in the apps they'll use.
And we are Yo. Yo stands for Yield Optimizer, and we're creating savings accounts with Bitcoin, USD, Euro that are automatically optimized for yield across all of DeFi.
Okay, great. I'm going to start with you, Debbie, because I'm interested, like, you sit across a wallet infrastructure and you're seeing lots of different builders come to you with yield or earn programs. Like, what does that look like? What type of sophistication are you seeing? What type of variety, and what surprises you?
Yeah, I think I would say in the beginning, a lot of our customers had the idea for a general savings app, or rather they're connecting to vaults, they're connecting it to DeFi, where the clear use case is that this is a savings app that just does better than your regular bank account. I think what has been really interesting is that we're now seeing, it could be an app for something completely different. It could be a marketplace. And I think or it could be a payroll platform. And we're seeing these users now actually be interested in vaults and DeFi as a accompaniment to what the main product does. And so I think we're seeing this kind of shift in expectation or desire where no one is just building a savings product itself, and it's just really part and add on, and almost like yield is there by default.
Right. Calvin, to you, Kraken launched a phenomenally successful Earn program. What did you guys learn in the first 2 weeks of launch from that product?
Yeah, I think we had a thesis we were operating out of, which is that we knew that users from the data that we had wanted yield, and they wanted access to stuff on chain. It's just a little bit complicated. We talk about the UX layer quite a bit. I think as we've focused in the last year on the application layer and how important that is, it's about abstracted experiences. And so, we knew that we had to kind of build something that was going to be really simple to understand for our users. And we have a pretty large consumer user base on the retail side. So I think we still have a lot to do. We just kind of launched phase 1 of this, but for us, it's about making it really simple and understanding kind of our own user data and how to kind of market to those users to something that's more simple for them to understand.
Is there friction that exists for the next cohort of users to come on? I mean, when you think about the product, what do you see as the challenge for onboarding the next set?
Yeah, I think you have to uncrypto it. People understand yield, generally. I think that I've been in crypto for 12 years, so you've seen us go really deep into the technical properties of stuff because we're so excited about the innovation potential.
Right.
We have to remember that people have been using phones and applications in finance for eons. And so the quicker we understand where the distribution points are, and these are for infrastructure providers like Vaults, and how we do that distribution properly. Centaura is a really good example of a business that's understand this really, really well. I think Privia as well, everyone here. And so I think, when we try to figure out how do vaults now start to shift from just being just that distribution to rules-based finance, that's when we start to truly see it as product infrastructure rather than like the product itself, which I think takes time for the industry to mature and understand, and also the participants that have distribution to buy into. And I think we're at that point of convergence where for companies like us, we see what's happening in the DeFi space. We want to offer simple experiences, and we know that it's been building for multiple years. So I think it's really easy for a company like us. Company that's a little bit more TradFi is going to take a little bit more time. But yeah.
Okay. Manny, do users care about vaults? Like, they don't see it, right? They interact with a different interface. Can you talk a bit about like how vaults sit with you, how that interface looks like with customers? Are they aware?
Yeah, I think to build on Calvin's, people don't care about vaults. They don't care about chains. They don't care about protocols. They actually just want the yield. And so that's 80% of the users that we need to onboard going forward. We need to uncrypto it, and we need to make it actually simple. But as we make things simple, we can also hide the complexity. It's good, but we don't want to hide the risks. And so that's always like, how much transparency do we need to give while keeping that user experience easy? On Yo, you can put any asset, USDC, USDT, you can put it from any chain, Ethereum base. It just generates yield. You don't need to really know where the yield comes from, but you can know where the yield comes from. And I think that's the kind of user experience that is needed everywhere.
So that's an excellent point. How do you balance that simplicity and lack of friction with letting the user know about risk?
Yeah, so we have to respect the manifesto of crypto about transparency and all of that. But we also need to prioritize the information for the user. So when the user comes in, the first page, they're just going to see a yield chart, and a certain performance. We're not going to say USDC, we're going to say USD. We're not going to say Euro C, Euro CV, Euros. It's just Euro. And it looks as simple as a traditional finance product. It looks as simple as a savings account, potentially. And then we give the tabs. We give like UX, that's a UI that allows the user to actually deep dive. And you can get to the bottom of like actually choosing what are the pools that you want.
Okay. Gabriel, I want to go to you. Centaura have been extremely successful over a short period of time as a curator. My own personal experience seeing them on Morpho, as you guys are very sophisticated. One of the challenges, as you will know, is as we think about long-term durable demand, we can think about incentives, but DeFi is still pretty mercenary. How do you think in Centaura about building that demand? What sort of strategies do you look at when you think about the type of borrowers that come in and what they need?
In terms of the borrowers, I think the beauty of DeFi is that you have everyone interacting with each other. You have institutions. You have just someone in their house interacting with them, being counterparties to each other, and so, while you need to understand and kind of categorize these flows, they all serve their purposes. I wouldn't say that there's a good or bad flow. They all have moments in time where they can be helpful. Incentives can be quite beneficial when you're trying to bootstrap a vault, and then you just have to really make sure that you have some sort of tapering program in place to keep that capital there, so you don't want to have sharp fluctuations, because that's what makes people leave. But if it slowly drops down and you're still performing as the same as other vaults or similar, you usually will get stickier capital. in terms of like strategy setup, it really depends. At least from our side, we do a lot of like pretty deep due diligence on collaterals that we use. So we're maybe a little bit slower on collateral additions, but we usually are trying to look for things that have staying effects. So while these incentives can be quite interesting at the beginning, the end goal is always to have yields on the vaults that are not driven by incentives or even something that's quite DeFi native. Like it's always helpful to have something like an Athena asset on there that has a certain strategy that can generate organic yields from their products, but then real world assets as well, having this diversity can make it so the vault stays at a pretty constant level without having fluctuations between the different industries that the yield is coming from.
I'm curious, when working with Kraken, what are the type of things you think about when exploring strategies for yield generation? You know, as a research analyst, you're kind of like looking at risk, but then also looking at return. At a broad level, like what are the top 2 or 3 things from a criteria perspective that you care about?
I mean, the risks are definitely the top. The biggest one that probably people don't really talk about because it's not so sexy on vaults is operation execution. You know, if you're doing some sort of loop or if you're doing any types of trades, there's slippage, there's price impact, there's places where you can eat away at the yields that you're trying to generate. And so this comes back to this durability of the returns. You don't want to have to flip between strategies and assets constantly because that price impact, and you know, if there's not a lot of liquidity at the point you have to exit a position, you're just going to hemorrhage on your yields. And so, you know, you want to find that fine point between something being durable and also having a high return, and then look at that and see, is there the liquidity needed to exit in the size you're looking at? Because running a vault at 100 million can be manageable. Running a vault at 500 million or $1 billion, this is a different ball game when you're trying to manage that position in DeFi.
That kind of brings me to the next point of, and maybe a question for the panel. What do you think needs to be in place operationally, legally, and even considering the the regulatory framework that you're operating under for a large fintech to think about coming into DeFi for a yield product? So, like, I have lots of conversations around this and spend more time with attorneys. I love attorneys, but like spending lots of time with attorneys. But there are real questions, real concerns, real risks. Some of it's just knowledge, but when you get to like a level 2, there's real sophistication in trying to understand, in a bankruptcy case, who owns the funds when they're sitting in a smart contract. So what are the things that need to be in place, you think, to be able for a DeFi or for a large fintech to come and say, I'm comfortable with this? I'd be curious about some of your conversations. Maybe starting with you, Manny.
I think it comes down to 2 things. The first one is risk. They need to be comfortable with the risk. And in DeFi, you have all types of risk.
Do you think they understand the risk?
They don't. But we have to do the work. We know DeFi. We know that a leverage position is high risk. We know that code that is not battle tested, that is not audited, is riskier, and so on and so on. And so the first thing is that we need to, I think we all do in this industry, talk about risk-adjusted yield now, and that's something that's important. And the more we do that, and the more we show that the returns make sense, the better the adoption. I think there is something else that we don't talk about, though, which is the securities law risk. And as we put humans in those vaults that have to do actions, we are creating potentially a security. And so one of the things that I think that we are going to be working on more and more is to take out the human aspect as much as possible by making everything algorithmic. So the algorithm to allocate should be an algorithm, not necessarily a human, and it is totally possible to do that. The trades themselves that you spoke about, I think we can make them automated, And as we do that, the vaults become less of a security there. Obviously, everything that is inside as well should not be a security. Like an asset like ETH is not security. An asset like USDC is not a security. A protocol that is like Morpho is not creating any securities risk. But so if everything is DeFi, if everything is not a security, then we're doing something that is sustainable for traditional finance to come in without that issue on top.
Yeah, I think he covered a good amount there. I think for me, I think about like what's required for, you know, a product to be regulated. There's audit trails. There's the quantification of risk. And I think it's like, to his point, making it a lot simpler. Like we know the choke points where risk is. I think that needs to be explained and translated in a way that regulators are going to understand. I think part of like where we get to is like a sandbox in which like there's more of a feedback loop as we iterate. It's often missing in crypto. It's gotten a lot better. I won't lie about that. But I think that to build and innovate, there's like a dichotomy of innovation and then regulation. They're almost like opposing forces in a way.
And are you talking about feedback from, you're talking about consumer feedback or feedback from a regulatory perspective?
Feedback
right?
from a regulatory perspective.
Right, okay.
I think the consumer feedback's also important, but that's on like how they understand risk. I think transparency on where yield comes from is also really, really important. Mm-hmm. To your earlier point about incentives, like we haven't ran incentives, so you know rewards come from actual borrower demand for DeFi earn. I think people don't really understand that, right? Like we have incentives, we have like yields that are like astronomically high. The majority of the adoption has come from like people that are native to the space, and therefore they've become a little bit accustomed to really high astronomical APYs. So I think distribution through platforms like exactly what Kraken's doing gets it to like regular users. And like now the adoption curve of regular users using this, and a company like us using this, we have to go through that process and figure that out with regulators. And we have those comms and open lines, right? And so I think a framework needs to be established, but that only happens when you have like that feedback loop between product and regulators and like a high frequency. Because we've kind of gone too far, right? Like in a lot of ways, in a lot of areas, not just like for vaults, but for everything. And we're getting pretty deep. And I think like we've sped up a lot on the regulation side, but for the majority of the industry, we've been behind, right? And so I think that needs to converge a little bit more.
I mean, Kraken are one of the innovators. I mean, globally, when we think about, both from a license perspective and the coverage that you have, as well as product innovation, you've been at the forefront. I'm curious, what are the questions, if you can share, that regulators ask across different jurisdictions? What do they care about?
They care if we're focusing on the perspective, if we're protecting consumer interest, right? Like we have to be the ones responsible for the products that we release to our users. And so if we want to innovate, right, we have to kind of go into sometimes newer areas. So a lot of the times for a larger institution, we have to wait, right? Like we have to wait, we have to see kind of what happens in the space from when there is an early concept or something that's new and novel, and let that go through a couple iterations where it's palpable to like put into a larger ecosystem like ours. But yeah, I can't pinpoint any specific. We get a lot of questions.
Yeah, I'm sure. Gabriel, if a large asset manager comes to you and says, "We want to work with you on curation," what are the first three qualifying questions you would ask them to kind of understand? Are they aware of the risks? Do they know the space? Do they have the resources? Like, how do you think about qualifying capital allocators?
As in deploying into the lending side?
Yes.
It's even within kind of, let's call them DeFi native institutions, there's a big breadth of understanding of the DeFi space. So centralized exchanges can range in what they understand, how they deploy, what sort of team they have for on-chain deployments. In terms of what questions we ask, I don't necessarily say we have any like specific questions, but we have, like, as Centaura has evolved, previously we were into the block, And for years, we have been working with institutions in our Smart Yields product. So rather than through like Vault infrastructure, it was just client-based strategies that we deployed. And from here, we manage a lot of the monitoring and the risks here. And so we were able to kind of gauge from conversations with them what kind of exposures they want. And especially with how modular protocols have ended up developing, we can still do that to some extent. We can set up a vault, but then potentially have some sort of sub-vault system in between if certain clients want to reduce their exposure to different items. But as of right now, I would say most people come and they're interested for integration because they know that we can deploy in size. And then the conversation goes, we present strategies to them, and then we start to funnel down to the ideal strategies based on if they're hesitant on certain things or if they have specific red lines on assets that they want exposure to. And then often we're providing any of our due diligence we have on these and our metrics and our data that we present for these different assets. So somewhat bespoke for each person, but I would say it varies greatly on what people are excited to be exposed to, how risky they want. And sometimes there's a disconnect on saying, you know, I want this sort of benchmark, but I don't want to be exposed to anything presenting that. And so there's sometimes a reckoning that has to happen as well.
Okay. Debbie, I have a personal question. I was in Mexico 2 weeks ago at a fabulous Stripe event, and it was really interesting for me to watch a company like Stripe bring together Privy and Bridge into the mothership. It was a unique conference in that it wasn't a traditional crypto conference, right? I had a conversation with a company from Argentina who were a B2B provider for like really SMEs, physical therapists, hairdressers, and it kind of struck me as we were listening to these conversations on stage with Zach and Henry, you know, how normal businesses thought about crypto and stable coins, and we're talking about, you know, fairly sophisticated risk management strategies within vaults. But tell me, what are your impressions there of, you know, Privy, Bridge kind of coming together within the Stripe mothership? How has that been going?
Yeah, no, I would say it's been going great, and I mean, I think a lot of it too is that we are all parts of different forms of the stack. I think actually just even to tack onto your earlier question, how do we make these products, you know, regulatory compliant? You know, even for Kraken end product that goes through Privy wallets. You know, so Kraken having been a centralized exchange uses signs for it to go to a non-custodial wallet, which then connects to the vaults. And so, you know, without that non-custodial setup, it will be a lot more challenging for, you know, for a regulated institution to, you know, really plug into DeFi. So I think, you know, Privy, you know, has that custodial and non-custodial setup, allows somebody to have that side by side. So essentially, they could have the flexibility of connecting into open, decentralized markets from day one, or, you know, if they prefer to adopt a custody solution, they can do so as well. And I think some of the businesses that you met in Mexico a couple of weeks ago, you know, they may have a little bit more of a conservative stance as it comes to custody. And, you know, we're able to do that a lot more quickly and have this kind of custodial and non-custodial side-by-side solution more quickly because we're able to work with Bridge as a licensed custodian from day one. You know, and obviously we're looking to continue to expand our custody partner network so that we can cover more geographies in places where Bridge is unlicensed. But I think, you know, kind of being under this, you know, Stripe family of companies, if you will, I think definitely allows us to move faster. I think at the same time, like, you know, both companies have their own individual, and three, if you include Stripe, all three companies have their own individual roadmaps. I think we operate at like with different paces, with different, like Privy is a 60-person company relative to Stripe, which is a 10,000-person company. So naturally we operate at like different speeds and again have like different priorities. But I do think that it's exciting to see where there are natural overlaps and deeper product integrations that, hopefully we'll be seeing, over the rest of this year.
And I don't know if you can share, but Cam, who kind of leads your go-to-market team, when does the Vault conversation or the Earn conversation or the DeFi conversation come up with Privy?
Yeah, I mean, I think a lot of, like I said, I think a lot of people are coming to Privy, I think in some sense because, I think the wallet is basically the account layer, right? So, regardless of whatever you're doing with crypto or with stablecoins, that you need a place to hold them. And so I think people come to Privy and be like, oh, well, what else can I do with these accounts? And now these accounts are highly programmable, highly modular, highly flexible, and can connect seamlessly into these vaults. Now I think we've built, this was always doable before, but I think now we've extracted away the complexity even more. So not just making it easy for the end user, but making it easy for the developer as well. And so now it's really easy to earn on idle balances that you have in Privy wallets that, again, connects to a Morpho vault, through, that have been, carefully curated. And so, I think we're seeing a lot of people now being, it's as simple as like, let me just turn it on. I just want to turn on the button to earn, and then I can toggle how much revenue share that I want to have between their end users and themselves. And I think sitting as Privy, I think our mission has always been the same from day one. It's like, how do we make it as easy as possible for developers to build on crypto rails? I think we're doing that now just with an evolving, in the beginning, I think when we talk about developers, we're talking about like, independent crypto developers. And I think the space has matured so much over the past few years where these developers that we're talking to could be a Mexican-based business serving SMEs.
I want to shift the conversation just to institutions and kind of how we think about any conversations that you've had with institutions and how they may be different from some of the consumer conversations that we've had. So what specifically do you think needs to change today in terms of Vault architecture for it to be a robust, or does it need to change in order to offer a more robust offering to institutions? Let me start with you.
Yeah, I think there's a different set of like parameters for each segment, right? And so I think for where we've been at with Vaults currently, it's been focused on the consumers directly with Vaults and then like through this distribution layer. I think we've been in discovery a lot. So like we've heard different things that are important to different institutions in terms of like what they're trying to bring to market. I can't pinpoint anything specific because it's like the same general things that we've seen on the consumer side, but more around like rules-based finance, generally speaking. I think Vaults are starting to become a central piece of like, how do we think about this as a smart bank and like routing layer? And so I think the stuff we're doing with DeFi Earn, for example, with Centaura on the strategy curation side, I think institutions are looking for what's like real yield and like what is like this incentive stuff that's been going on here. How do we mature this and make it palpable for like the way that we interact in the world? I think it's two different worlds. And so I think this year will be a lot of discovery for us, but we've heard a variety of things.
One of the things I'm curious about is how does real world assets fit into that yield strategy? Is that something you guys are looking at? How close are we to that? We have a market today on Morpho that's robust, 15 to 20 real world assets. But as we think about them as being a central, consistent component of yield, how are you guys thinking about that?
Yeah, I mean, we have X stocks that we've been working on quite deeply. We had a hackathon yesterday. So I think RWA is also a really large focus area for us. I think everywhere in finance there is like a real yield in the existing world to be used. And so, stocks is kind of where we're starting. But there's more other asset classes that we'll start to get into. But it'll be a central theme for us Q3, Q4.
Yeah, I think RWAs are a really interesting new source of yield, especially that we have seen some yield compression over the past few years on everything, every yield coming from DeFi itself, from market making becoming more efficient, from more and more staking being used, from like having enough liquidity for lending. So RWAs are actually the fastest growing component of the yield sources. It's still relatively small, but it's important for us to differentiate between two types of RWAs. There's the RWAs that are just like wrapping the treasuries. Those are easy to understand. The counterparty is the US Treasury. There is not so much, there's a lot of clarity on the custody of these things. And then there is like private credit. If you look at private credit today, there is a lot of private credit coming in. And it worries me a lot because there the counterparty is not as reliable. They can...
When you say not as reliable, what do you mean?
So the first thing is that we don't understand what's the underlying of the private credit most of the time. It's tokenized, a lot of corporate credits, and it's really hard for us to understand what's the bottom of that financial instrument. And so what I see around in this industry is more and more of these like private credit that could be an adverse selection case where they couldn't sell it on TradFi, BlackRock is closing on redemptions, and all of a sudden we're receiving all these RWAs with private credit. And so that's something that I think as an industry we need to be careful about.
But don't you think that as DeFi matures and RWAs come in, that transparency of those assets is going to be vital. In order for them to survive and grow, we need to understand what's the underlying, what's the pricing, what's the liquidity, and frequency of redemption. Those are going to be essential, right?
Absolutely, but this is like mixing two worlds. You're mixing the traditional finance world or the real space, meat-space world with the metaverse. And for someone, for example, to have the right to redemption, it's permissionless in DeFi. Well, it's not permissionless in traditional finance. Resolve today, Labs, has had a hack and blocked redemptions on RLP. And so that's something where when you have a human in the middle, you can end up with like not being able to have your redemptions and not being able to have your rights. And so when we bring in private credit, we're bringing in new types of risks that we're not used to in DeFi that make the case more complicated. And you talked about transparency. I think we have full transparency on chain. We are able to get to the bottom of like exactly how this yield comes from. Whereas like when you have like a mix of these, where you're bringing in an RWA that is complicated, if they don't provide you the transparency, well, you're not going to have it. And people are still like investing in these. And the best transparency that they can do is probably quarterly audits. Well, over a quarter, there's a lot that can happen. And so I'm bracing for some pain for the coming few years where we will finally see problems with redemptions on private credit, which are the problems that already exist in traditional finance. We're probably going to see them in DeFi as well.
I feel like what he's describing sounds very much like 2008, you know, and all of that opacity in terms of all of these derivative products that nobody really understands, and they're like nested one in another and another. So yeah, that's like that would be a very scary situation.
Gabriel, curious to you, are RWAs essential for consistent yield strategies?
The consistent yield strategies come from having diversification of where the yield sources are. And so RWAs can be a component of this. Personally, I don't really like the term of RWAs because I feel like it just clumps a lot together that, as Mehdi pointed out, is actually a very diverse product range. Like, are you backed by mortgages or some derivative of a mortgage? Is it private credit? Is it T-bills? Is it payment, like short-term loans for payment transfers? I think someone else was having a key point about that earlier. And these all have different risks, and you have different duration exposure, and these things matter a lot. Coming back as well to the reporting, right? These guys can try and put as much as they can on chain, but there's a latency and a lag, a gap on how reporting is on chain, which is block by block, or stuff at a institution that's working in the real world, which can be daily at best maybe, but not the weekends. And so you need to, when you're bringing on these real world assets, you need to really be very careful on how you integrate them. And so they will bring a lot of benefits, but they will also, if curators especially are not paying attention, could backfire quite easily. So whether it's not, people think that it's a stable coin because it's actually kind of an accrual token and it starts at $1 and it accrues, or if it's actually just, there could be drawdowns, which we've seen with like Fasanara, that they had a drawdown that I don't think it affected anybody, but these sorts of things are real risks that you run. On top of it, depending on what type of real world assets you're bringing on, when are they trading, when are they liquid on chain and off chain, how can you redeem them, can liquidators act on these? We've been working a lot with Bakkt, with Ondo, on bringing like lending markets for security stocks, and trying to create the oracles in a way that you have circuit breakers, that you have different preventative systems in place to make sure that if there is a stock, the stocks get divided, or if there's a distribution, that those oracles reflect, and it doesn't reflects the correct price, and it doesn't put you in a situation where you have bad debt or liquidations on chain that aren't going to get liquidated because you have to wait for some sort of KYC liquidator to come in and make that liquidation. So there's a lot to be wary of. I think we'll see some unfortunate missteps, but in the long run, we'll see RWAs on chain, and I think it'll probably become one of the largest asset classes in DeFi.
When do we get there?
I think, there's a lot of bubbling about private credit companies having issues. If that ends up falling, it might take a little longer, but we're already seeing it, and I think in the next year we'll start to see structured products that are managed products in a way that is safe for users. I mean, that's what we're working on. We have conversations with several different real-world asset providers on how we can manage their integrations into DeFi. So I would hope to see more in the next year, but if we see some TradFi stuff start to break down, it might get extended before we see real uptake.
Okay. We have less than a minute left, so we'll just do a quick fire question round. What is the vault-powered consumer product that exists 18 months from now that you're excited about? What is, as we look into the future, what needs to change from today to get to a place that we're offering something that is a V2 of what we have today?
I'd say a curator-less vault, maybe. Something where the curator just comes in.
So Gabriel doesn't have a job then, is that
I
right?
think he does have a job, but he has a job in the beginning.
We're already doing beta testing on it, so okay. I might have to find another job soon enough.
Okay, you've just got 10 agents doing your job, is that right?
It's in the pipeline for us, so
okay.
I have to be careful.
Okay,
we
hiring
should all race for this with AI as well.
Yeah, I think for me it's just like a completely agentic powered vaults.
Protection and cover at scale. So Centaura is incubating a protocol called Firelight that is looking to provide cover for vaults to allow users to have some sort of protections on exploits, technical and economic. This will be coming soon, and it's meant for institutions to be able to integrate into their products at scale.
Great.
Yeah, I think for me it's being kind of the wallet layer. Like I think I just see every single app is just basically a global programmable savings account that can seamlessly plug into any of these protocols.
We're at time. Could I get a round of applause for our fabulous panel? Thank you for having us.
Now, please give us a few minutes while we set the stage for the next session. All right, next we have James Harris from Tesseract, who will be speaking about what the next wave of institutional capital needs from vaults. Welcome, James, everyone.
Hello, everybody. Good afternoon. Great time in Cannes. Great, I'm James Harris. I'm CEO of Tesseract. We are a institutional yield provider. We have a MiCA authorized entity that is authorized by the Finnish FSA. And today I'm going to talk to you about vaults and what institutions need from them. Yesterday, we, very excitingly for us, launched our entry into the vault market. And we did that by launching dedicated client vaults, which are MiCA compliant vaults by design that were built from ground up to meet the European regulatory requirements. Very, very exciting for us. We could not have done this without our excellent partners, Fusion by IPOR. They provided the technical chops that we needed to create the vault modifications that we needed to deliver MiCA compliant vaults. We also are heavily indebted to a cohort of 6 institutional clients that helped us on a consultative basis as we went through our pilot program to deliver these vaults. These are new innovations, new ground, and we needed all of their advice. We're delighted to announce that 21Shares was one of those partners that helped us do it. So I'm going to be talking about vaults today, and institutional variants of which. But first, allow me a quick, irreverent detour. In times like this, when the markets are like they are, it's important to take stock of where we are. And when we really zero out, I've been building in this space for 10 years, like let's take a look at crypto's contribution to the world so far and what it means for an institution. First, Bitcoin, obviously, that's what started it. Sound decentralized money, it's what we needed. Second, and this is more related to the partners here, we have tokens that are created and are transferred across L1 and L2 rails. Tremendously important innovation on which we're all building now. And then finally, slightly more recently, we have the development of decentralized finance. So these are the 3 themes that when we take stock of what we've actually built, these are absolutely key. And we shouldn't be despondent about this. These are great world-changing and asset market-changing contributions. So when institutions look at this, they look at it and say, okay, Bitcoin, sound decentralized money, that's native collateral, got it, understood. When they look at the layer 1s and layer 2s, that's super exciting for them because it allows the tokenization of everything. On the decentralized side, they're like, okay, it's an evolution of what we do already, and it allows for on-chain services. It's real-time footage of institutions now paying attention. So I'm going to make 2 very uncontroversial predictions, and sorry, so far, this crowd is very savvy, you know what we're talking about. But I believe, 1, all assets will be tokenized. Every single asset can be tokenized. And 2, the future of asset management, given the fact that all chains are tokenized, is on-chain. Now that is an exciting statement. So to go with my 2 very uncontroversial predictions, I will make a controversial statement. Institutions don't really give a damn about your digital assets. That's unfortunate, and it's sad for me. I'm a bag holder as well. What they do care about, though, are better rails for their existing assets to travel. Cheaper, more efficient, liquid, capital efficiency. These are very, very important institutions. Now, if that means that they can interact with things like Bitcoin, fantastic. More real-time footage. Over the last 10 years, I've heard the refrain, institutions are coming, and that's what we've been betting on. They are here, and it's not what we thought, right? I think that definitely institutions now have their hand and their fingerprints on our markets, and the market structure has changed. So we have to adapt. We have to provide institutions what they need, but we also have to be cognizant that the market has changed forever with their entry. Institutional grade solutions then, they're now the norm. Custody, solved. Exchanges and liquidity, institutional grade. Venue connectivity, as good as anything you see in TradFi. Centralized and decentralized lending pools at scale, built on giants like Aave, Morpho, you name it. Vaults, however, slightly more gray area. Finally, 5 minutes in, 10 slides in, I'm talking about vaults. This is the money shot. Vaults, to me, are a 10, 100, 1000x opportunity. 10, because 10x better UI. You can spin up vaults from your wallet. It's wallet linked. It's transparent, real time, auditable, all those kind of features. 10x better than current asset management structures. 100x because we've already grown 100x. Vaults have gone from tens of millions 18 months ago to 20 billion at the high last year. Incredible growth. Again, hat tip, Morpho, fantastic job. Great exponents. Centaura was on the stage before. Fantastic job bringing it to the market. 1000x, because that's our addressable market. Every single asset will be tokenized. All assets will be managed on-chain. Let's look at what that means. Equities, bonds, real estate, art, you name it. The market cap for those assets, currently, conservatively, between 700 and 900 trillion. That's almost a quadrillion. And quadrillion we only ever use when we talk about Bitcoin Satoshi outstanding supply. Quadrillion's a big number. That's the 1000x TAM addressable market. Now the problem is, and this is not to be incendiary for the people here, but there are some gray areas of the way vaults are currently built, right? Some of the current vaults don't quite meet MiCA, and we're based in Europe, so we care about Europe, but they don't quite meet MiFID or AIFMD requirements either. And the reason for that is this. Any user, professional or retail, in many cases, can go to a vault provider, go straight in, deposit assets. First problem under MiCA. No KYC, no AML, no suitability test. Secondly, they're depositing funds into pooled vaults. Those, I'm sorry, very much look like collective investment schemes. Under MiCA, not allowed. So then you have the curators themselves who have variable levels, let's just say, of regulation and compliance. Under MiCA, not permitted. Now you might say, and MiCA says expressly, that DeFi is not under scope. However, the problem is that these are activities that are regulated activities. Asset management is a regulated activity. So you need to have a better look. And finally, the tokens that come out of these vaults are proportional investments in either regulated or unregulated hedge funds. Those are securities, no matter how you look at it. So areas exist in this structure, and we've created our dedicated client vaults to mitigate these. So the way we solve it is clients come in, KYC, AML, suitability test. They then create a vault that is 100% owned by themselves. The vault tokens that they earn, that they receive, are non-transferable beyond the institution itself. Therefore, it is a non-transferable asset, not a security. We ourselves are then curating or providing the asset management services in a completely appropriate way. Under MiCA, you have to do things on a client-by-client basis. Tick, because we've created a vault that's specific to that client. We are also able, we have all of the licenses that are required to do this sort of thing. So we have an asset management license, we have a custody license, and we have an asset transfer license. Those are the three components that go into the technical thing. So while there is no entry under MiCA saying DeFi, all of those activities are still very, very clear to anyone who's been in asset management for any length of time. So we solve it then effectively in a neat solution, compliant by design, whereby every single problem that exists in the previous setup, and that's not to knock them because this is a coexistence question. We're not looking to supplant everything that's been built. We've built these solutions simply to provide a solution to those institutions that have to solve these problems. So what this means for you, as I mentioned, we can deploy capital quickly through a compliant vehicle without some of the structural headaches that your compliance teams are seeing today, or the slight sort of rounding off of some of the concerns you have just because otherwise it doesn't fit we now believe that there's a solution that works for institutions that care about these things. DeFi protocols and builders should be excited as well, because this should attract more capital back into the ecosystem and allow more people to come into the institutional grade infrastructure you've already built. The institutional sandboxes that you've created can now have an actual place and a funnel coming towards them. Today, I'm here all day. My colleague's Adam Seville-Brown, the head of commercial. He's wearing a Tesseract cap. You can't miss him. It's blue. He'll be here all day, as will my colleague Adam Heems, our head of asset management. We'll be very pleased to answer any of your questions and discuss how we might be able to work together. Thank you very much for your time.
Thank you, James. Next, we have Stefan Daniel, who will be speaking on legal considerations of vaults and curators.
And I need a... Sorry.
We will just grab the clicker from James.
Thank you. So hello everyone. Thank you for being here at lunchtime. So yeah, I was just figuring out how this works. So just a quick word about myself. So my name is Stéphane Daniel. I'm a French qualified lawyer. I co-founded the law firm DNA Partners. We are a French law firm specialized in crypto and blockchain, currently with 16 lawyers. And we are full service, so we do cover corporate, regulatory litigation, tax, labor, and IP, IT, and data. So feel free to reach out after this keynote if you have any question. So for today, I will try to unveil for you the legal considerations regarding Vault. So I will just quickly present the facts that we have to address. Then I will cover MiCA. I will not cover AIFM and MiFID. I would have needed a new keynote for that, but it's also an important element to keep in mind. And then some recommendations for the curators in the room to mitigate your legal risks. Of course, Vaults have been going through an exponential growth, and we are seeing the emergence of a new specific status, which is the status of the curator. The status of the curator did not exist when MiCA was discussed, when MiCA was drafted. So we now need to look at what is a curator, what is the curator doing, and whether the curator is regulated under MiCA, depending on what he can do. Here, I'm sure you're well more knowledgeable than I am on the various type of vaults that are out there. But this is just to show that this is a very flexible concept and that you can do a lot of things with it. You can do lending, you can do restaking, you can do RWA, you can do yield, aggregating liquidity, etc. So it's very flexible, and this is a challenge for us as lawyers, because when we look at a protocol, when we look at what a curator is doing, we need to really go into the details of the vault and the way it works. Here, this is just an example, because once we understand what the vault is, we need to understand what are the different roles. This is just an example, because this is based on the Morpho architecture. But depending on the various protocols, you may have other roles, you may have other names. In the current presentation, I will mostly focus on the curator. So the curator here, for example, in the Morpho architecture, is the one selecting eligible markets and protocol, determining the allocation, defining the caps and risk parameters, and also taking the decisions. But this is not the only role. When you deposit into a Morpho vault, you have other roles. You have the allocator. So this one is executing the on-chain allocated orders. You have the guardian, which ensure compliance with the parameters that have been set by the curator. And then ultimately you have the sentinel, which is the one monitoring the system and triggering alerts. So as you can see, in a vault you have several roles. It raises another question, which is even more complex. What happens if you combine all those roles or part of those roles? So again, it is a very case-by-case analysis to understand the vault, but to understand also the roles of the vault. Last headaches for lawyers
I would say the nightmare for us is which law is applicable. Because once you understand the vault, once you understand who is doing what within the vault, then comes the question which law is applicable. So I won't go into detail on this slide, but just what's important to keep in mind is that at least we have a conflict between what the curator is based. For sure, the law will be applicable based on the seat of incorporation of the curator. But this is not enough, because if you have depositors from the US, depositors from the EU, you may trigger US law, you may trigger EU law, and even though you are offshore, and unfortunately for the moment most of the curators are settling offshore, you cannot circumvent MiCA, for example. If you have EU users in the vault, if you are actively marketing your vault towards EU users, you will need to think about MiCA. So now, when we need to talk about MiCA, so we have two layers. We have the infra layers, basically the protocol level, and then we have the application layer or the curator level, which is one more up into the levels. So if we look just at the infra, MiCA says in the recital, so MiCA is 200 pages long. We have just one sentence which says, if the services are rendered on a fully decentralized basis, then it's outside of MiCA. So it's basically two sentences, and the whole DeFi is relying on this one to make sure that we are outside of MiCA. We have no definition of what does it mean to be decentralized. However, building on the doctrine and building on certain publication from certain regulators, in particular the Danish regulators, we are able now to better understand what does it mean to be fully decentralized. And you have basically two levels. You have the technical level. So, and this one is enough, actually. If you satisfy the technical decentralization, then it's fine. And again, you have to assess really on a case-by-case basis. You need to look at whether the smart contracts are self-executing, whether they are control rights, whether it is built on a permissionless blockchain, whether it is non-custodial, and whether it is open source and verifiable. If you achieve all those criteria from a technical perspective, then we can say, okay, you're fully decentralized, you're outside of MiCA. If you're not fully decentralized from a technical perspective, then we can move to another test, which is the governance decentralization. And we know that certain protocols, like for other, I won't quote them, they are not sponsoring this event, but anyways, there is a DAO that is taking and adapting all the risk parameters. And you need to look at the way the DAO is functioning, whether there is a specific legal entity that can be identified, whether the governance tokens are well distributed, whether you have many wallets, many votes, people are attending the votes, whether the DAO is truly living. If that's the case, then it's fine. It's not totally fully decentralized from a technical perspective, but it is from a governance perspective. So those are how we currently assess decentralization under MiCA. And then we have the upper level, so the curator level, because the curator is building on a specific protocol. So maybe the protocol is unregulated, but the question is whether the curator using the protocol is itself regulated. The curator is very different because the curator is an entity. So definitely it's a centralized entity. We know who is operating as a curator. We have the names, we have the website, we can find the founders. So the question is whether what the curators are doing, is it regulated under MiCA? As you know, MiCA is regulating many services. You have custody, you have crypto to crypto, you have crypto to fiat, you have operating a trading platform, you have receiving and transmitting orders, you have executing orders, you have advisory functions, and you have portfolio management. For curators, if you look at the list, in our perspective, 3 or even 4 services might be characterized, again, depending on how the protocol is functioning, how the vault are functioning, and what the curator is doing. You have first the issue of custody and transfer services. Of course, you could say, oh, the depositors, they can get out of the protocol whenever they want. It's non-custodial, so there is no custody. But that's not enough, because for certain regulators, they adapt a very broad and large interpretation what is custody. And if you are able just to move cryptos from one vault to another, maybe you are able to transfer the cryptos, and so you are rendering a custody or transfer services. I'm not saying that's the case. I'm just saying that certain regulators in certain instances may want to adopt this very broad interpretation. So that's, in our opinion, it should not be qualified, but we never know. This needs to be tested. And then you have two other services that may be triggered. It's portfolio management, and you have advisory as well. Because since you are selecting the collaterals, setting up the risk parameters, maybe you are advising your clients. Again, according to our analysis of MiCA regulation, these services should not be qualified. Why? Because MiCA, for MiCA to be qualified, you need to do an individualized service. So you need to speak to a certain person that you know, of course, and that you need to, of course, sometimes you need to onboard, you need to KYC, etc. That's not the case for curators, generally speaking, in DeFi. Because usually what they do is that you have many depositors and you just have public addresses. You don't know who's behind the public addresses. The assets are pooled. So it shouldn't be qualified. But again, this needs to be tested with regulators, and we need also to wait for regulators to clarify all of that. Just for information, if you are qualified as a CASP under MiCA, you have to comply, of course, with many rules, including conflict of interest, handling client complaints, KYC, AML, etc. So while in a permission system, it could work, and Tesseract just before was explaining that they are designing vaults that are compliant with MiCA because they are permissioned, we don't see how you can make a curator working on DeFi with the public on a permissionless basis go into MiCA. That's not possible. So what are the practical implications for Vault, for the curators here in the room? So that's the most important thing for you. 3 ways of mitigating the risk. First, reducing the control that you have. For example, establishing a time lock. Every time you take a decision, a time lock allowing depositors to see what's going to happen and to withdraw from the vault. Predefining the allocation rule. Because of course, if you predefine all of this and you don't have to intervene anymore, then you're not actively managing the vault. And it's mostly, you're a technical intermediary, just setting up strategies, but then you don't have discretionary power about what's happening once there is a deposit in the vault. Separating the roles. As I showed, for the Morpho architecture, you have several roles. Avoid having all the roles falling into one single person, because then, of course, it is increasing the risk of falling under MiCA. If you do use multisig, ensure you have independent actors. And of course, so this is to trust minimization parameters, mitigating the control. Then you have the legal structuring. This one is a black hole. Usually it's not even addressed. Choosing the jurisdictions very well, okay? So if you're a curator, choose a place where you know first that it's not forbidden to do what you do, first thing. Second, terms and conditions. I very rarely see terms and conditions in relation to vaults where people can deposit. But it's super important because it says what the curator is doing, it is disclaiming their liability vis-à-vis the depositors, and this is, of course, then mitigating the various risks. Documenting the geofencing policies. You don't want to trigger US law? First, document it. In the TNCs, you put, okay, we are not actively, we are not servicing US users. And this, of course, needs to be in line with the marketing. If you say that you are not actively targeting US users, for example, don't go there, don't sponsor events there, don't try to reach the US community. So this is the legal structuring strategy. And finally, the third point is the public documentation. Act transparently. So publish all the on-chain strategy documents, the risk parameters, the smart contract audits, and do regular reporting, especially also on fees, because the fees are very opaquely structured. So again, to mitigate the legal risks with having depositor contesting the fees, for example, try to be as transparent as possible. So those are the 3 strategies that curators can do, which are complementary to mitigate the legal risks. And finally, and I have 1 minute left, from a regulatory perspective, we may be in a gray zone under MiCA, but things are evolving fast. The rumors are circulating that maybe MiCA will be refreshed, that certain part of MiCA will be removed or added, or even that maybe there will be a MiCA 2 addressing specifically DeFi. So there may be a window for curators and the ecosystem at large, also protocols, to get together and to start influencing the policies, influencing the lawmakers to maybe tomorrow have a regulated status for curators. Hopefully, one that will be in line with the way it works today, and to offer, to allow curators to act safely in an EU environment while, of course, preserving consumers' interests and depositors. If you have any question, feel free to reach out, and thank you for attention.
Thank you, Stéphane. Please give us a moment while we set the stage for the next panel. Up next, we have a panel on compliant vaults designing for institutional participation with our moderator, Margot from DNA Partners, our speakers, Darren from iPor Fusion, Joran from Centrifuge, Silva from SG Forge, and Max from Utila.
Thank you, everyone, for joining this afternoon. I will let each speaker present themselves, and then we will dive in this new subject on compliant vaults. If you want to, please go ahead.
Hello, my name is Darren Camus. I'm the CEO of iPor Labs. We build Fusion, which is an institutional-grade vault infrastructure. We announced yesterday, and you just heard from one of our partners, that we are partnering with Tesseract, which has the MiCA licenses for what I believe is the first MiCA-compliant asset manager and infrastructure stack going live.
Round of applause, maybe?
Hi, everybody. I'm Jerome, co-founder and CTO at Centrifuge. We've been focused on tokenizing regulated fund structures for 7 or 8 years, together with institutions like Apollo and Janus Henderson. We see vaults as really a primitive that's going to enable all of asset management to move on chain, where currently vaults are relatively simple vehicles allocating to purely DeFi strategies. But I see it as like the primitive that's enabling every layer of the capital stack to go on chain, from CLOs to structured products to anything like that.
Hello everyone, I'm Sylvain. I'm a co-founder and CPO of Société Générale Forge. So we are a stablecoin issuer. We issue the Euro convertible or Euro CV. We consider that DeFi is an important feature for stablecoin. And we validated a Morpho Vault for Euro CV, so we are quite involved in this topic, and we have a lot of discussion with compliance guys, so happy to be in this panel for that.
Max from Utila. We're an institutional wallet, a non-custodial wallet built for payment companies, asset managers, OTC desks, securing your assets, building policies, on and off ramp, AML, operations platform if you're a business looking to go on chain. I've lost my voice.
But we can still hear you just right. Thank you. I suggest to open this session with maybe Sylvain, you just mentioned that SG Forge has paired up with Morpho, and vaults have evolved from DeFi primitives to institutional infrastructure. Maybe you can tell us how it all ended up in this partnership to dive in this compliant vault panel.
Yes. Maybe to start, I would say that all elements about compliance and DeFi is very tricky. It's quite moving, to be honest. What things that has been accepted by compliance maybe 6 months ago, now it's changing. So I would say let's take it with a grain of salt. It's not so obvious. On our side, and so from my perspective, so there is some conflict of opinion, of course. On my side, I'm a product guy, and I want to integrate EuroCV as far as possible in the DeFi ecosystem, because I consider DeFi as a centralized exchange or a broker, as a distribution layer. So it's a way to have access to a user, for example. And so I'm more pushy to consider Vault as a technical interface, as a technical layer, and not as an entity or something that is holding by a curator or something like that. So all that is embedded in the Vault for me is a technical infrastructure, and the compliance thing is on top of this Vault. So it could change by the business case, but from my perspective, and with EuroCV, we need either to regulate or to do compliance stuff on the entities that will be given access to this vault, or on the underlying asset. So on my side, when we validated the integration of EuroCV within the vault, it was more on the underlying asset, because we don't have any link with the vault on our side. We don't seed the vault per se. But the main thing from our compliance is to ensure that the underlying asset, that is a loan asset, so EuroCV, is compliant with MiCA, with EMI, and so on. And so the main point would be to ensure that, because there is no KYC, AML, and so on at the vault level, as a issuer of the stablecoin, you need to have some tools in place to monitor the circulating supply. So all has been discussed with compliance about this operation level, and so we discuss chainalysis, real-time possibility to freeze address if there is some red flag, and so on. So all has been done as an underlying asset from my perspective.
Thank you. Maybe you want to share an opinion on what, according to you, does compliant vault mean? It also starts with defining words. Maybe you want to share your point of view from not necessarily a compliance or legal perspective. As a lawyer, I'm always wake up with my legal eyes. But let's leave that to another panel and focus on sales or development perspective or technical perspectives.
Yeah, maybe I can start. I think Vault is a very broad term, and really it originated, I think, originally from the 4626 standard in Ethereum about 4 or 5 years ago, I would say. And really what it means, right? Like a vault is ultimately a vehicle that accepts assets from one or more users, issues a share token against that, and hopefully that share token over time goes up in price based on assets that they are invested in. And really that is the entire part of, I think, from a technical and DeFi perspective, what is a vault? How you then take that forward in terms of what is a compliant, or let's call it institutional vault, for me it's about how do you take that technical primitive and how do you create new financial products that are compelling from an institutional perspective, both to structure and bring on chain, and also to actually buy and access and use and integrate on chain. And so I think that's a very broad definition. I think there's many examples of that. Of course, there's a lot of examples of what we've seen on Morpho with new curators stepping up and really creating, I would say, a new level of curation and asset management. But it's also on the opposite side. It's around how do you work with partners like Apollo that are bringing assets on chain and then integrating those into DeFi. Centrifuge has been issuing vaults for those kind of products from day one, from 2020, I would say. And really the purpose of those vaults have been to allow on-chain buyers access to those products and to distribute them more widely in DeFi, and then to create composability, which I think is one of the main reasons we're all building in DeFi. So I think it's very broad, and I think really it comes down to how do you create a better financial system on-chain through Vault as a technical product.
Thank you. Darren, do you want to?
Sure. So yeah, I mean, Vault, as you mentioned, it started as a kind of this DeFi native construct of how do we get assets into one vehicle and how do we socialize gas fees when gas fees were a big thing. But when you're talking about compliance, really quick history. I've been building in crypto since 2011, 15 years now. Very long view to the industry, and there has always been a very big regulatory gap. Now we have MiCA, we have different acts in the US, and we get actually some very clear regulatory views, which is a very nice thing. It's something the industry has always been asking for. When I talk to institutional allocators, the number one thing is compliance, especially on KYC. So when we're thinking about building a stack, we're not thinking about we're thinking about utility, we're thinking about architecture, we're thinking about gas efficiency, but we're also thinking about giving institutional partners anything that they need for compliance, and that includes whitelisting and blacklisting at the Vault at the Vault stack, an architecture that's flexible enough to meet their mandate. So, for example, we went back and forth with Tesseract, looking through different ways of actually constructing the Vault stacks as they go down to the market level. So, I mean, one thing that's very important, for example, is KYC of the client level assets, and also where does commingling of assets happen at the market level, if any. From a technical perspective, actually, this can be resolved depending on your Vault architecture. So we go back and forth a lot with the people that are actually building on the stack, because me, as the technologist, as a protocol provider, I'm not thinking from the regulatory perspective. I'm not thinking from necessarily the asset allocator's perspective. I'm thinking of building architecture and the scalable and secure protocol. But we get these very good client feedbacks to have all the features to bring in. So KYC compliance, transparency on chain, what's the auditability? We think a lot about, like, what are the trust implications? Again, a Vault is just a smart contract, but how is the accounting handled? How transparently can you see where the assets are? For example, if the assets are moved off chain, if the assets are moved from somewhere else, what kind of visibility, what kind of trust implications do you have? So a lot of these things, we take these into mind and try to build architecture that minimizes the trust that you need to have on the curator, on the provider, on the infrastructure. And so, yeah, I mean, I'm really glad to have actual partners. This is a very good product market fit, but it's also excellent feedback from the market. We get to understand exactly what we need to build for these institutions.
Yeah, and I think we're turning to this topic of what design features are in the end required to make Vault institution ready happen. And it's true that when we, as a firm, started to ask ourselves questions on DeFi and legal consideration, KYC was something very distinct, far away from the DeFi industry. And you mentioning those design, those feature, maybe raises a new issue when institutions come in the game. So if we dig into those features, any other thoughts on that?
I think KYC, like, what's really difficult, right, is like what we see in DeFi is really this layering of different products and different vaults and different assets, and right, like we're working with a lot of like regulated funds that are being issued on our platform through where every direct investor is being KYC, KYB, and AML checks and so on, like everything you would expect in a product like that. But then of course, like there's those products are being bought maybe by curators managing different strategies, maybe by stablecoins, and like the question then becomes like, where does that end, right? Like how do you think about like what the end user is? And I think that's a really complicated question that, I'm not the lawyer, but for me it seems like that's a problem that's still being explored. I think when you ask about like what's needed for institutional vaults, I think one specific problem I would say is, I mentioned 4626 at the start, the current vaults mostly are fully synchronous, and synchronous means like you put in some assets and you get some share tokens and you withdraw that liquidity at some point and get hopefully more assets. The challenge is that really depends on there being just-in-time liquidity when you want to withdraw your assets. And in a time of an incident like Resolve last week, that really means that whoever is first, like it's a first come, first served model. I don't think that's going to scale to trillions of dollars moving on chain, right? Like where it's really about whoever clicks the button or has the most advanced AI. I think we need a better way of like really determining execution, determining ordering of orders. And I think one element to that is an extension of 4626 called 7540, which basically enables like separating that into like submitting an order and then executing that order later. And I think at least on the redemption side and potentially also on the deposit side, most vaults will move to that because ultimately it will provide better guarantees to the users depositing because they will have more likely that they can get their liquidity out in a kind of pro rata or fair distribution way.
Max, anything you want to add?
More similar to Darren, we're an infrastructure partner. So we not care about compliance, but we ourselves are not regulated. But we do build tools to help people add value to vaults securely, compliantly. So through Utilitas MPC, through a partner of ours, you can securely access a vault secured by the MPC environment by not using like a Chrome extension. And then we also have like policies, which are very important for like smart contract policies where you can assign which wallets are able to gain access to the vault or how to reallocate within the vault. So like we can go down to the functional parameter level on a smart contract. And like Darren said, these are smart contracts, right? So that's the way that we protect and we help our customers gain access to vaults.
Maybe on KYC, because it's the TradFi is a hard question. So on our side, we consider that KYC AML, and I think it's on MiCA, need to stay at the intermediaries level, asset manager, and so on. That need to comply with this rule. On the vault level, the main question is on the curator side. That is quite a strange and a weird new beast. And from that point of view, I think it's quite important to be quite careful on this operator. We can consider, the debate is open, but we can consider that the curator is part of the role within the vault, and because of that, you don't need to hold this compliance and regulatory burden. And maybe the brainstorming that we can have is what is the impact if the curator need to hold some KYC or this kind of stuff? Is it could create a world where there is curators that need to KYC all the users that will deposit within the vault, and it could be not. It could be completely difficult to do because you will have some liquidity from asset managers that need to do KYC, and when you have a non-custodial user, you want to have access to the yield, to the strategy, and you cannot because you are not KYC'd, for example, by the curator. So you create a kind of non-fungible strategy. And from an institutional, so they want to have a KYC rule, compliance rule, but they also are quite sensitive to the liquidity. So if the liquidity is siloted because of the compliance rule, it will not bring institutional within the DeFi ecosystem. So we need to be cautious with the curator stuff.
And with this answer, did you also when partnering up with Morpho, did you ask yourself the question like who is responsible when the curated vault strategy may fail? Have you given thoughts about this? How to mitigate those risks?
Yes. We it was this kind of question what we have with compliance. So first, when we selected our curator. So we consider that it is limited. It has limited action within the vault. It cannot take the front. It's only a kind. We consider it as a operational strategy allocator. So I outline operational. It's not a strategy per se, but just an allocator, an operator that we allocate funds within a clear strategy. So it is really limited. We also stress on the governance light stuff. So we are all about time lock and so on was really important. And so because of that, we didn't go through the KYC route for the curator, but for a kind of service provider. So know your services. So it's quite different because it's a very technical provider. So it's the first point. And also we have a contract in place with the curator to ensure that what we want to have within the DeFi ecosystem, it's a premium vault. We don't want to take a lot of risk. And we want to ensure that it will be liquid asset and so on. And we don't want the curator to add exotic collateral because it really the risky stuff with the curator, because if you don't see it, they can put some shitty collateral and it could be drained by the it's already happened. So that's why we put this contract in place. We ensure that the collateral is selected by the curator but also by us, and that the strategy is clear and voilà.
Maybe I could take this also from building an infrastructure side. So you're talking about roles, responsibilities, permissions, time locks. So Fusion, actually, what we build is completely permissionless. You can spin up a vault from the Vault Factory smart contract. You can do whatever you want with it. But we were thinking from a traditional allocator's perspective and also like a fund administration's perspective, actually building different roles, different responsibilities inside of an organization, or actually cross organizations. So whether you're a fully decentralized organization or whether you're a centralized organization, you can actually split up and reduce risk within different roles. So for example, we have this, or the kind of the curator role, which we call the Adamus, which actually can select markets, assets, actually whitelist down to the asset and substrate level, which means it can go to a specific Morpho market, which has this specific collateral, or it can do cross-market, that same collateral on Euler. And you can actually separate these at the smart contract level. You can separate execution from selecting the strategies, and actually you can even subdivide that. You can add time locks across all of this. You can actually build a governance layer on top of it, so that you can build a fully decentralized fund. If we're looking at what are some of the potential requirements for being fully decentralized, or whether you're fully centralized and looking to actually manage risk inside of your own organization. So I think that a lot of people are overlooking these things that are very important to institutions when they're building technology, because they're thinking about DeFi native and permissionless, but you can actually build all of this infrastructure thinking of a traditional fund, and that gives you all the proper controls that you need for risk management, for governance, for security, for time locks. So yeah, it's extremely important part.
I do think what's really challenging, right, is like, coming from a technology background, I think there's a lot we can do with technology, but at the same time, there's a lot of limitations as well, right? Like, yes, you can say that fully on-chain strategy is safer than something that's moving assets off-chain, but then again, if a vault is investing only in T-bills, which are off-chain, arguably that's safer than most vaults that exist in the market today, right? So that if you just look at the on-chain perspective, that looks like an off-chain strategy, therefore it's less secure. But I think if you look at the overall risk perspective, I think that's a very different story. So it's very difficult, I think, to ascertain that, and I think that needs really risk underwriters to step up in the space, and I think there's a lot of exciting movement on that side. I also wanted to come back to what you said, which is really interesting around limiting to not having exotic assets. I think the reality of the market today in DeFi, there is quite a limited number of assets that really curators can choose from. And I think one of the things that we really need to move to a more institutional participation in the space is really bringing more assets on chain and creating more interesting financial products out of that, right? Really, we're not going to be able to create interesting and kind of broader user choice for different vaults if there's not actually more assets to choose from. If all of them are allocating to the same basket of 5 to 10 assets, you end up all having the same yields and you end up having all the same risk. So I think that's another element that's really missing, and it's really needed to kind of get to the next level from my perspective.
And on this risk, custody, segregation also, I would like to hear your opinion on can self-custody finally coexist within institutional compliance, and what are the key operational risks for institutions that you have already addressed, that you keep on addressing with the market evolution and the legal framework having, as we just heard with my partner Stéphane, being still quite uncertain with this phrase in MiCA.
I mean, vault infrastructure is actually non-custodial by nature. The smart contract is the custodian. It's not a registered custodian. It's actually not the person who is building the strategy. So it's a new paradigm. So if we think from the regulatory perspective, it's not thinking about necessarily this paradigm. So vaults are non-custodial kind of asset management infrastructure. So it is a different beast. When I think about DeFi, I think that the most beautiful things about DeFi are everything can be transparently read on chain if you're talking about DeFi native constructs. And when you think about trust, this is where everything can break down. So for example, we have two big exploits in DeFi recently. One was a minting issue, but last November there was a big fallout because you had a kind of what I would consider trust me bro tech, right? It was a fund that was marking its assets up on chain. They had a big loss and they kept it non-transparent. And when that came, there was all this spillover risk. The nice thing about vaults is actually you can map out the entire kind of risk surface inside of DeFi if you know what venues it can go to, if you know what collaterals it can touch, if you know the liquidity on those venues, if you know the depth of the market. So DeFi gives you all the constructs to actually assess risk transparently. For example, in a Fusion vault, you can set an agent that looks at the on-chain footprint and it knows what connected assets, what collaterals. And that means you can have like third-party risk raters. That means this can be insurable because the insurance provider can independently verify everything that is connected to. So when we're thinking about DeFi and risk, the thing that I like most about DeFi is that the risk surface can be fully transparent. What you come up to, obviously that depends on your point of view, but the transparency aspect actually can really reduce risk.
One point on risk, and I circle back on what you said previously.
We're having a real live debate here.
Yeah, it's nice. And so segregation, non-custody, and so on, I think is not really the topic. Segregation could work with Vault, but it's let's say a kind of tricky things just to comply with some rule. But at the end, it would be one liquidity pool or different liquidity pool, but it would be pooling stuff. But the main thing is today on Société Générale Forge we are comfortable with wrapping Bitcoin ETH that is, let's say, native to the ecosystem. It is liquid, so we know that the liquidation will work quite well. The real trick is when there will be a lot of on-chain economy that because I heard a lot of discussion about private credit and so on that could be included in some vault. And on that point, there will be some really risk monitoring to have, and it will be interesting. It will be quite funny, but it will be difficult to follow, and we need to have to ensure that maybe the new creator of tomorrow need to have a proper risk in place, and also the issuer of the vault need to be accountable for what is the strategy you want to do, and to mention the risk associated with that, and so on. So it would be quite great.
Yeah, I think I just want to say, I really did agree on those points. I think really what DeFi is doing, what vaults are doing, is extending the service of what an asset manager needs to do, right? They obviously need to look at all the risks that they're already doing, which is credit risk and insolvency risk and all the kind of standard risk that you're seeing when you're managing a fund or portfolio of assets and managing other people's money. But then also you need to look at what is the smart contract risk, what is the different risk that I'm taking on chain directly. Oracle risk is obviously a really important one. So really, I think it's adding to the total picture, and it actually makes the job harder. And I think what's also really difficult is right now vaults on chain are the fees are very limited. And there was this report on this where actually the curators are not making that much money, which really means I think it's quite difficult for them to build a business around this and really do a great job. So I think we need to expand. I think the ecosystem needs to mature where curators or on-chain asset managers, I would say, really have the resources to do all of the underwriting and all of the risk assessment that we would expect them to be doing for institutional vaults.
Yeah, if I can add to that. So we have partners like Hypernative, Blockade, right, that are able to understand and simulate what might happen either entering a vault or interacting with a smart contract. I feel like a lot of asset managers, curators have to like start there and make sure that they have those guardrails in place. If you're going to service an institution, you need like that real-time understanding of what the risk is.
Yeah, I think that's almost like one-on-one, right? In many ways, like, I mean, that's where you start.
Yeah.
I would say.
I see the clock is ticking, and maybe we should also address market evolution. And do we see institutional curators becoming a standard? And what are your views on this, on the evolution of the market?
I mean, you already see it. You see Gauntlet is the sponsor here. Centauro was up talking. Tesseract has been managing digital assets for many years. So I think, yes, institutional curation is going to be a standard. Bitwise announced it a couple of months ago. So absolutely. But all these guys that are coming on have some very strong familiarity with digital assets. So when we looked at building actually Fusion, we were actually really expecting the shift to come, and we wanted to build a technology stack. So if you go back to like the V1 vaults, which is like Yearn, you have to be a very proficient Solidity developer. You have to know DeFi in and out. You see on-chain like the Matrix operator, but when you get guys that are coming from TradFi to curate in DeFi, they know risk management, they know statistics, they can code in Python, but they've never touched a smart contract, and they probably never should. So when we looked at building Fusion, actually, we were thinking about this shift. So, you know, all of the infrastructure is kind of plug and play on the interface. We have a CLI, we have a Python SDK, so you can actually deploy, view, and manage very similar to like a BlackRock Aladdin. You're not sitting there actually getting into the nitty-gritty on the smart contract level. And I think this trend is going to continue, and I think that we'll see these like you see traditional asset management and vaults and on-chain markets and on-chain asset management. It's always going to come closer and closer together. So I expect the shift to very much continue.
So you don't think legal issues will be a main barrier? You think it will allow adoption, allow this market to grow?
I think that, I think you were talking that what was probably unfathomable for some institutions 6 months ago, definitely 6 years ago, is now becoming more a reality. So yeah, I think that the more somewhat kind of risk-taking institutions that are actually sitting at the forefront, they're gonna drive the industry, and everyone's gonna play catch-up.
I'll just add, I think, from my perspective, like curators the current curators will start to look more like institutional asset managers, and the current like institutional asset managers will look more like curators. From the perspective of having the former will build more expertise in-house for like underwriting, risk assessment, compliance, and so on. And then the latter will actually build more expertise in terms of like DeFi and on-chain and everything that's needed for that. And I think those will converge, and like who will end up there, I think it's a very difficult question. Certainly I would add, like, I think the collateral base of these vaults will expand to a much wider array of like financial assets, any kind of credit, fixed income, any equity, and so on will all move on chain, and that will require much more expertise and will require institutionalizing this process.
Yes, there is I think Curator in Vault is quite hype today, and when we discuss with a regulated entity, crypto native regulated entity, they all want to become a curator. It's quite incredible, and I think there is so the business perspective also, to ensure to attract user funds, they want to control all the value chain, and there is a narrative. Then you are an asset manager. You want to provide your user to DeFi stuff, and so you want to be curator because you don't want to delegate it to someone you don't control or you don't know. Of course, today the curator are a little bit offshore entity, something like that, so it's not really comfortable for this guy. So there is a big trend for that, yes, clearly.
Well, Thank you so much for sharing your opinion and your views. We can, I think, get a last round of applause for the panel.
Thank you.
Next, we have Anastasia from Blockworks Advisory. She will be speaking about Vault as a credit instrument. Welcome, Anastasia, everyone.
All right, GM friends. I'm Anastasia. I'm from Blockworks Advisory, and I focus on quantifying risk. And when I look at the DeFi lending, I look at the Vault as a credit instrument. I'm a little bit stressed standing here on stage talking to you, but it's not only me who can be stressed. Markets can also be stressed. We saw it last week, and we will see it in the future. Today, I want to talk about what can we do so we are not stressed in the future. The ecosystem made already a big progress here, because I will talk about how we actually assess the risk of the Vault, and Credora gives you a letter grade for the Vault. Gauntlet runs simulations to set safe parameters. There are also others who are doing serious job, and it all does matter. Today I want to talk about granularity that's still missing. Because when you look at the letter grade of the Vault, it's B+, but you actually never know what exact channel dragged it below A. You have safe parameters recommendations. Loan to value has to be 80%, but it doesn't tell the depositor what is the run risk this week. And what importantly is, it doesn't tell a risk curator before the event occurs which exact levers they can pull to proactively manage the risk and do not react. So I want to talk about and want to share my thoughts on how to decompose the risk into its components, where actually the Vault risk is coming from, and how can it be presented to every actor in the DeFi lending so we can collectively act before the stress events force us. Before we start, I'm completely sure you already know this, but I want to make sure that we are starting from the same point. I have not forgot risk curators here. We will come to that point. So in DeFi lending, we have three actors. There is a depositor who allocates the capital. There is a borrower who locks up collateral and borrows against it. And in between, there is a Vault. It is a code that enforces rules automatically without discretion. Now, in vaults like Morpho, vault and the market are two separate layers. Vault allocates the capital, and the market matches borrowers and runs liquidations. The role of the vault is to liquidate the borrower before the losses reach the depositor. And this word before is where actually the whole complexity lives. So actually, we are talking about a credit instrument. And in traditional finance, we have a very long history about a credit instrument. And we have a very well-structured credit tools about a credit instrument. And believe me, it is very tempting to apply those credit tools to DeFi. However, those credit tools actually are based on assumptions that hold in TradFi, but they do not really hold in DeFi. And these are the 5 assumptions. The coverage ratio above 1 means solvent. In DeFi, smart contract uses Oracle prices. However, if you sell collateral in the market under stress, the market moves against you. Oracle said you are safe, execution price says otherwise. Loss given default is a fixed number. In DeFi, the more liquidations cluster, each sale depresses the price for the next one, so the recovery is just super linear and the loss is also super linear. There is no lender of last resort that we have in TradFi. Banks runs on damped heterogeneous beliefs. In DeFi, we have an advantage. We have a public information. Everyone sees the same information at the same time, and it can be costly. Portfolio management responds in real time. In DeFi, governance requires time locks. During adverse market regimes, the rules and parameters of the vault are frozen. And the last one, the settlement infrastructure is stable. In DeFi, when you liquidate, and during the triggered liquidation events, the gas fees are spiking, and liquidators, which are bots, making their mess, and they only liquidate if it is profitable for them. So we have these 5 structural differences, and 5 of them needs a measurement response. So how actually I see this measurement response? I see it split into the different levels. The first level is about financial mechanism, about the vault. And it answers the question, can the vault survive market stress given that parameters and the contract are safe? The level 2 is a governance quality. Are the risk parameters set correctly? Are they updated in time? And the third level is about infrastructure and code integrity, and it answers the question, can we actually trust the code? All these 3 levels can have an aggregated score, but they can be also decomposed in the metrics that were observable for each of the actor, and it can be monitored in real time. All 3 levels are independent because the risk for each of the level has an absolutely fundamentally different source. Today we talk about the level number 1, and level number 1 is based on 6 propositions that are driven from the structural differences we see in TradFi to DeFi. So proposition number 1 is a price gap. And it gives you the first metric. This is actually the stress-adjusted coverage ratio that takes into consideration execution cost. Number 2, the cluster problem. We talked about this. I mentioned that the simultaneous liquidations and the more they cluster, you have a loss which is super linear. And the metric number 2 is covering expected shortfall of the vault and the recovery rate. Number 3, the run. Everyone sees the same bad information at the same time. And if the vault reaches utilization at 100%, the withdrawals are blocked. This gives you the metric number 3, which covers liquidity stress index. Number 5, line oracle. So the oracle says you are safe, but the oracle is wrong. Under-collateralized positions are not liquidated. The bad debt accumulates silently. And this is what covers the metric number 4, which covers oracle integrity. So it is pricing oracle stainless and manipulation. Proposition 6, missing liquidator. This is about how it is profitable for liquidators to execute liquidation position, and the metric is covering execution viability. This is how the metrics would look as numbers. I'm running out of time, but I would be maybe super short here. Each metric has 2 inputs, the one that we observe on chain and the one that is estimated with simulations, statistical procedures. We have raw metrics, and then this what you see here, these are normalized metrics from 1 to 0. 1 means complete safety, 0 means complete danger, and everything in between actually tells you how far are you from the safety. In this example here, we see 2 channels, recovery and execution, that are weak. And if we combine it in an aggregated score, and let's just look at the additive score, you would look at this and say, okay, I'm actually safe. But if you look at the multiplicative score, which is a product, and it treats each of these 5 metrics as independent variables, because if you have liquidity, which is kind of safe, it doesn't mean, or it doesn't compose that execution is actually your weakest component. So you actually can react on it. This is how we see the risk dashboard can look like for each of the actors. For depositor, risk curator, and the borrower, this is an example for the vault wrapped ETH USDC. The vault has reached 92% utilization. The borrow rate already crossed the king, and you have 80% available to withdraw. But you already see live metrics that you can monitor, and they already tell each of these 3 actors 3 different things, and each of them has a decision to make. For example, depositor, seeing the available liquidity to withdraw is 8%, but it also sees that the run risk, so the probability that the exit will close in the next 7 days, is 8%. And the depositor, having its own preferences, can decide now whether to manage the position, withdraw, or monitor further. The risk curator sees the cost. It has the asset coverage ratio and the stress-adjusted asset coverage ratio, which includes execution costs. So it knows that it has a tight buffer above it. It also sees the measure behind this one, behind the execution viability. This is the elevated stress test correlation. And it knows also what is the dollar amount of this execution viability cost. So the curator can already predict which levers it can pull, like increasing liquidation incentives or decreasing high slippage exposure. And the same for borrowers. Here is a health position having good buffer, but knowing that the recovery or expected shortfall of the vault is elevated, it can make a decision now whether to adjust the position, add collateral, before it gets liquidated. DeFi can be more transparent than TradFi, and when you have metrics to monitor in real time, and each of the actors can predict or act with respect to their threshold, beliefs, and preferences, the collective behavior can make the whole ecosystem safer. Here my Telegram and email. Would love to chat with you about that if you have critique and feedback. Thank you so much for your attention.
Thank you, Anastasia.
Sorry for taking time.
Next, we have Wojciech from Accountable, who will be speaking about proof of solvency, the missing layer. Proof of solvency, the missing layer in Vault risk. Welcome, Wojciech, everyone.
Yeah. Nice to meet you. When is your talk? It's just after him.
I think no, it's up. Pleasure to meet you guys. I'm the CEO and co-founder of Accountable. I hope you still have energy after this week to hear one more presentation. And today we're going to talk about, indeed, the proof of solvency, which is something that we believe is the inherent component of vaults, something that we specialize in, but maybe not many people know that we also have our own vaults that we recently rolled out. So that will be the main topic for today. Okay, so people tend to forget that what we see mainly in DeFi today with all of the vaults are strategies that originate on-chain. And obviously, this is a very much growing vertical, but the truth is the real money is off-chain, and majority of the strategies that are coming today, day by day, with all of these yield-bearing stable coins and parties that basically want to tokenize what they know in the old world, they are trying to bring it on-chain. And for that reason, if something is not on-chain, it would be good to know what that actually is, because in reality, we see APY and all of these different things like the name of the curator slapped on the vault, but not necessarily we know what's the underlying strategy, if the counterparty has the money, and whether they are actually following their mandate. So be prepared that the upcoming vault products will be mainly focusing on the stuff that is happening in the world that is inherently not transparent. And we know that very well, right? Like 2022 was a very brutal year. FTX, it's just one of the headlines, but Celsius, BlockFi, Genesis, Luna, Babel Finance, like basically this slide would be full of dead bodies that are no longer with us. And one thing was in common, like nobody know where the money is, what these people are doing, and it ended one way. Stream Finance was a good reminder of that in 2025, and I think this was the wake-up call for this industry that after all these years we didn't do anything to actually change how this market operates. And actually for a company like ours, it was the most bullish event ever because everybody wanted to become transparent overnight. And that's why you see us in a lot of these upcoming protocols that are utilizing our verification to show to their precious LPs that they actually do a good job with their money, at least in this particular moment, of course. So I was pointing to it before. You're going to come to a vault. You're going to see the APY, the higher the better, of course, because that's the human nature. TVL number, the manager name, maybe some reporting, maybe some credit rating here and there. But the truth is, the whole underlying strategy lives outside of it. And basically, people take your money, put it to off-chain venues, and usually act as hedge funds, where you're basically risking your whole capital to maybe get your money back one day with some interest on top. And we need to change it, because if we want to grow this industry, then these are not the right foundations to build financial products of the future, basically. So, you know, like if you're an institution with 100 million in their pocket, right? Like you're not going to chase extra APY percentage point just because somebody tells you they are amazing and they're going to do magic wonders with your money. We already observe that larger capital flies to quality and transparency. So APY, it's not the only metric that people focus on. The underlying risk and ability to underwrite these opportunities is actually even more important. I would use an analogy from 2017 where smart contract audits were optional. I remember from ICO days that effectively some people were doing it, some people were not doing it, and it was seen as a green flag that the chance that somebody will rag you with their money is smaller because they are signaling we did something extra and we have a smart contract audit. Obviously, today you wouldn't put a penny into a protocol that doesn't have it, and I think it's a similar analogy to what we do today with the verification. So back in the days, it was seen as an edge for counterparties to show I'm doing a good job with your money, and today you basically cannot really launch a protocol that is tokenizing some strategy if you're not proving to your curators, to your LPs, that you're actually following the job. And you can say, I'm gonna earn up to 12% APY, 15% APY, and everybody for the right reason will question it. So that's why we give people means to show what they have, and most importantly, prevent their secret sauce, because we also cannot ask for absolute transparency. That's not how the business works, right? Like you cannot show your secret sauce to an average Joe and expect that this is okay. You need to show enough to show your credibility, but in the end, your edge should stay with you. So this is what Accountable is today. So we have the data verification network, which is the foundation of everything that we do. It allows institutions to prove what they are doing off-chain and on-chain in real time without revealing their secret sauce. You see probably a lot of these proof of solvency dashboards that we do. So this is the public representation of the data that these underlying institutions wanna showcase to the public. We also work on the NAV computation, that it's actually verifiable and not like many protocols today. It's basically arbitrary, and they push this information on chain without actually checking if this NAV is close to reality. And end of November, we launched our Vault as a Service product, because if you know that you want to deal with particular counterparty, it would be good to materialize this deal tomorrow. And for that, you need a very flexible and neutral infrastructure to make the deal happen. We combine the verification with the Vault as a Service, and we create verifiable yield opportunities that are listed on the Yield App, which is our marketplace where effectively the institutions can create their yield sources that people can trust. So this is the data verification network where people that are using our software locally in their infrastructure, they are proving their off-chain and on-chain sources locally without revealing API keys, wallet addresses to any third party, including ourselves. In fact, they are running accountable nodes. And with these nodes, they can communicate with that information either privately, peer-to-peer, node-to-node. So for example, lender to borrower. They can also streamline this data directly to the public dashboards that I mentioned, or even semi-public dashboards, as well as they can put this information on chain that can be then used to determine the live collateral ratio that is used to price the collateral on markets like Morpho. So we are moving away from hard coding collateral to be one-to-one to something that is real. Vault as a Service, we always wanted to create a menu where basically people that know what they want to do with their business can basically curate everything end-to-end, whether you want to tokenize your private credit loan book, whether you want to run your tokenized CLO, whether you want to run your typical on-chain strategy like on other Vault platforms. You need to have means to do it, and we offer full flexibility end-to-end and constantly grow the options that people can choose from. We are approaching, like this number is already changing, we are approaching 200 million in deposits for the last 3 months, working mainly with institutional counterparties. This list is very encouraging because we see a lot of demand for this product, and every single opportunity on our platform is backed by this live verifiable data. We offer two types of vaults at the moment. There are credit vaults, which are basically lending arrangements between LPs and borrowers. So we can think about lending to Galaxy or lending to market makers in an over-collateralized fashion, under-collateralized fashion, sorry. As well as the yield vaults, which are basically using the underlying NAV to determine the rate or the performance of the vault. This list is constantly growing because, again, we want to act as a menu, as a platform that basically adjusts to the needs to our clients as opposed to dictating them how they should run their business, because that's not how the reality works. We verify over 2 billion in assets, working with parties like Galaxy, Hyperin, Kirok, Valos, and more. All of these parties are coming on chain. They need vault infrastructure to materialize their deals. And this is what you should expect from us in the coming months, that you're going to see more of those names being listed and available to all of you as LPs. Thank you.
Thank you, Wojciech. Please give us a moment while we set the stage for the next panel. Okay, and our next panel will be about managing vault risk through market stress, with our moderator Nadine from Particular and speakers Ethan from Upshift, Gail from KPK, Engineer from Yearn, and Alexis from Steakhouse Financial. Welcome our speakers, everyone.
Everybody's looking where to sit. Ethan, and then Gia. Great. Hello, everyone. Thank you for having us today. Thank you for also to our panelists for taking the time. I think we have a good crowd, and I think our topic cannot be more timely right now. Each of us sits at a different layer of the Vault risk stack: creation, security, analytics, Vault infrastructure, and myself providing risk ratings. And I'm very excited to have you all here, especially considering that, that this is an important time. Maybe also before we start into a little introduction round to everybody. I'm Nadine, I'm one of the co-founders at Particular. We are a rating provider for tokenized assets. And now I want to give the chance to the panelists to say a few words about yourself, the company you're doing, and then we can get right into the topic.
Sure. Good to see everyone here. I lead growth at Upshift. Upshift is general purpose vault infrastructure. So that means that we provide vaults with custom strategies across multiple protocols at once, across DeFi and CeFi, and also 30+ chains.
Yeah, hi, nice to be here. My name is Giel. I'm head of risk curation at KPK. We curate vaults on various lending platforms, including Morpho, Euler, Gearbox, and a few others in the works. It means we set risk parameters, do monitoring, And something we focus on a lot is having automated exit agents to get out of markets in case of stress.
Hello, everyone. I'm engineer at Urin. We've been doing vaults for many years now, one of the DeFi OGs. And at Urin, I'm all over the stacks, but also as an ex-security auditor, thinking a lot about risk all the time.
Hey everyone, I'm Alexi. I'm head of DeFi risk at Stakehouse Financial. Stakehouse Financial is one of the main curators. On Morpho, we create just under 2 billion of assets. And so we are also active on other vault infrastructure and happy to be on this panel.
Great. Maybe we start in with something to get into the mood of the topic. From your own point of view, from each of you on a different very stack level, so to say, what is the biggest risk you're seeing right now when it comes to vaults? Who wants to start? You can just jump in.
Yeah, okay, I'll go ahead. I think currently, like we've seen it over the past week with the whole Resolve incident, or a few months ago with Stream, I think these tail risk events are, let's say, the big elephant in the room, and how you can respond to that in times of stress, because typically you only have a limited exit opportunity. For instance, on Morpho, typically like vaults are allocating to markets, who are allocating their liquidity to borrowers. In a healthy situation, you have utilization at 90%, meaning that only 10% of the funds are available for immediate withdrawal. So there is, to me, important for curators to first of all make sure that their vault is in a healthy position, that they can always exit in case there is this market stress. And I would emphasize that that's one of the biggest risks for depositors, like their liquidity potentially being not available at the time they need it and getting into very tricky situations that could lead to losses like we saw last week.
Okay, good one. Liquidity not available. Who's next?
I would say the biggest risk is the risk. Do any of you know the exact risk of where you're depositing? Because I will say many of my friends in DeFi, they will tell me, oh, you can get 0.5% more APY over here on this cool vault that on a protocol you've never heard of. And I ask them, what's going on? Where's the money? Well, why is there 0.5% more? And I think this lack of knowledge around the risk is the risk. Because if you're putting your money in a place where you don't know what's going on with your money might not be there the next morning. So yeah, I would say the knowledge around risk is a risk.
Education.
I think I will second what have been said. Like, liquidity is a risk, is one of the main risks. And we've seen, so just to add another point of view for this, I think the risk, you mentioned lack of knowledge, I think lack of transparency is the main risk today, because in DeFi you interact with protocol that are exposed to DeFi token, other protocols that are exposed to real world assets. And you need to understand all the layer of risk that you are exposed to. And just a normal DeFi users that will look for better yield, you will not know all these risk layers, and also they will not be able to compare protocol between each other, to compare like the underlying exposure. So from the DeFi user perspective, I think transparency is key. This is why, for instance, we publish our risk rating. So this is the key factor to be able to understand what you're exposed to during stressed markets. And the stressed market, the stress periods happen more and more often right now.
Also good angle. So liquidity, education, transparency. Ethan, do you also have, what do you think is
Yeah,
the biggest
of
risk?
course.
Something else?
I'm surprised no one mentioned excessive leverage. A lot of these vaults right now, they also issue receipt tokens. These receipt tokens are on lending markets, and as we saw with Stream, they're being used to prop up TVL to make them look a lot less risky than they might be. And so whether you're a user or a curator, you need to be aware of how much leverage is being adopted in this vault, and also what is the collateral that you're actually looping against. I would say this is a very, very big topic right now.
Great. Maybe, and this is very spontaneous right now, because I'm coming more from the tokenized asset side, right? I think you mentioned all, like I would say the general risk. Are there any specific risks when you look compared maybe to DeFi assets compared to tokenized assets, which I see more and more vaults consisting of that? Do you see like additional risks which may come? Do you see risk change? Do you know, what are your thoughts?
Yeah, I do think like there's a lot more, let's say, off-chain components. We saw it also like with Resolve, like the compromise there wasn't an on-chain thing. It was like an off-chain key that got leaked, or we'll learn in the postmortem. But you have the same with RWAs. There, typically, you could have a very good oracle, but if the oracle's data is coming from, let's say, a fund manager or the API that they're calling, and that goes offline, or there's an error there, then you're flying in the blind. You don't really know what the real asset value is, so you cannot process liquidations. In Morpho, if the oracle is not working, you cannot liquidate them. So there's all these kind of edge cases that are quite specific also to RWAs that only update once every 24 hours, for example. You don't have continuous pricing, and it's also very hard as, let's say, an end user or even a risk curator to really assess or underwrite the risk in some of these products unless you have a really good understanding of what's going on underneath.
Yeah, especially considering different asset classes too, right? Okay, cool. Is there anybody else who wants to add on that? Otherwise, I go into the next one. So I think, especially you, Gil, you already mentioned the Resolve case. I think that's very recent. It was like, I think over a week ago when this happened. I think $25 million was lost, and the question is, I think they're still, of course, figuring out how the key was exposed, why is there no minting cap, and so on and so forth. What do you think, as an industry, we can do together to prevent such cases? Because it's not, when you look also at the other incidents which we had last year with Stream Finance and so on, it was a different reason, so it looks like there are always different things sometimes. Of course, there are some things which happened more often than others, but I feel like, how can we identify those gaps and how can we prevent it as a market together?
Yeah, I think there's a few things. Like, first of all, like in the initial due diligence when onboarding an asset, these things could be brought up. I know there's some, like Steakhouse wrote like great reports on this exact topic. Like, and it's great to put these things out there in public as well, like to share risk assessments within the curator space. I think the more transparency, the better. And I think then also from the operational standpoint, like for instance, for context, so what happened was there was an unauthorized mint. Then an attacker started swapping on DEXs, like Curve, to get 25 million worth of ETH. And then they minted a second time for some reason. And what happened, the oracle on Morpho was following the ERC 4626 of the underlying asset. So it couldn't really price that this DEX price was lower than what was shown in the contract. So what does this mean is, like, for the markets and the curators, it seemed like nothing was happening. So unless you have some monitoring in place that's also coupled to an action to get out of the market, for example, to make sure there is no chance of bad debt, I do believe, like, we as an industry should strive to go more and more into this automated risk management. So it's not enough to, like, use a tool like Hypernative and get an alert in your Slack. If it happens, like Resolve was like 2:20 a.m. Sunday morning UTC time. So in our case, like, we had a few minutes after the initial minting, when the DPEG started to take place, we got an alert come in, but we also coupled it to an action. So you have something that's called an exit agent. It sets the cap to 0 on that market. It updates the withdrawal queue. And as soon as liquidity became available again, we exited the market in full. So we didn't have any exposure anymore. Also shout out, like, Jörn didn't have any exposure at all. Like Steakhouse didn't have exposure. So we're, like, not the only ones not affected, but I think we were the only ones that actually got out of the position after the exploit took place. While other curators, sometimes they run a very simple yield optimization algorithm, and it will just add more liquidity into the market. So I think we should be a bit more smarter about how we handle these automations to not just chase headline yield, but also think about like withdrawing liquidity again.
And I think when it comes to monitoring, transparency, access, I think the question came way later, but maybe you can jump in here. How do you do it at Seikos? How did you monitor it? How did you see it?
So I think the answer is quite similar. It starts at the underwriting process when we realize our due diligence. And in the specific case of Resolve, for MorphoVault, so Resolve has two tokens. One is a junior tranche that acts as an insurance fund for the World Protocol, which is the RLP, and we decided not to get exposure to this token because for us it's the economical risk of the TPEG that will be a large default, low probability of large losses. And it's not risk reward that we want to have. So at first, this is the first criteria that we have within our strategy. We have this kind of filter, the funnel that we also share to the protocol some requirements that some technical requirements, even economic requirements that they need to reach in order to be part of our vault, like to get their collateral accepted in their vault. So, for instance, on the technical side, it's things about the multisig, the time lock. You'll be surprised that some protocols are not at this level today in the DeFi space. So we engage relationship with the asset issuers to make sure their level of security match our requirements. And in the case of Resolve, the monitoring as well. So we have the same type of tool, like we detected the price anomaly within the minute of it happening on chain, and we exited our exposure, which was really small, to the second asset, so USR of Resolve, within a few minutes, because we've got this automated incident response on our end. And after that, we quickly engaged with the team, and we also shared the information with other curators. So the monitoring side is about knowing how the asset works, where the economic, what are the economic workflows, and what can go wrong. Because for your previous question, how can we prevent that? We also take the assumption that we cannot prevent that, but we need to react and we need to assess, okay, is there a risk on the reserve, so on the asset backing the protocol? If there are some risk of large economical loss, then it's not interesting for us. So and then how will the risk materialize that that there will be some event like affecting the price of the token in which magnitude, and so we will be this is part of our like monitoring stack to check what can go wrong and be able to answer to it.
Okay. Maybe to go to you, Ethan. Given Upshift's focus on launching vaults across 30+ chains with a policy engine enforcing constraints, how would you design a market stress mode for vaults so that your risk controls can tighten automatically and consistently across chains during a volatility or liquidity shock or whatever? What do you think? How can you, maybe from a vault infrastructure perspective, support on that side?
Yeah, sure. So firstly, I would say it's not necessarily a mode that you switch on and off. A lot of these things are small details, small architectural decisions that all build up and combine into an effort to prevent these sort of incidents and also to communicate the risk transparently to users on the front end. A lot of what we do is somewhat different to how these curators interact with these vaults. We focus primarily on enforcing policies that keep the curators within the mandate of the vault. So for example, we have an on-chain policy engine, which means that curators are restricted to deploying capital across specific chains, protocols, tokens, and smart contract functions. And this is enforced on-chain. You can verify these policies yourself. And so, this is an important mechanism that we have to ensure that whatever mandate that the curator has over the vault is actually enforced cryptographically. The other things that we have, for example, we have a max percent change mechanism on the vault nav. So the nav can only be updated so much in a specific time frame, which means that if there's a huge loss, then there's time to address this, and it goes the other way as well. And in general, like I mentioned, we try to keep the risk as transparent as possible. I think we've done a lot of work around this relative to maybe other providers. If you go to our front end today, you can see all of the positions on the front end that each vault has, and this is across DeFi and CeFi. And so prior to this panel, we, if you were here, you heard a talk from Accountable, who have been doing really great work on the verification side. We've spoken to them too, and you can see a lot of the off-chain stuff, for example, on Binance. If we're doing a basis trade on one of the vaults, you can see that on the front end as well. And then the last thing is not just in CeFi, but we have OTC stuff as well. So if some of our vaults have OTC loans, then all of these parameters and metadata is also visible on our front end, so you can see the health factor of every position as well. And so I think it's a combination of low-level mechanisms that keep nav updates in check, that keep curators in check, and that also empower users to transparently do due diligence on each of the vaults and hopefully understand some of the risks that they're getting into.
Thank you for sharing. Now coming back to engineer, having heard all of that from the curator standpoint, the vault infrastructure standpoint, you've also written that security experts miss the forest for trees. A protocol can be perfectly implemented but poorly designed. So what are your thoughts when you hear all that, when you saw the incidents happening? Yeah, please share your 2 cents.
Well, let's first start with the worst case scenario for anyone is 100% loss, unless you're like leverage or I don't know, some crazy scenario. So really the worst case scenario, getting that 100% loss, if we talk about bad design. If a risk curator curates the risk in a way that they choose a collateral that will go to 0, and that was part of their design, and you say, that's terrible, why are you doing this? They will say, well, that's part of the design, I'm sorry. Like that we intend to have this as our collateral. I think this is a great example of the design being flawed, but the implementation matches the design. And we have unfortunately seen this scenario of poorly chosen collaterals. I'm not sure this was intentional, I don't think it was, but not doing sufficient due diligence or risk analysis on these collaterals that end up going to 0 is terrible. I will just add to, let's say, one of the previous questions earlier, the idea of having a single point of failure anywhere in the system is an operational risk that hopefully teams will start to think about. This can be a key that's leaked or a key that's compromised. This can be a front-end issue that is not monitored. Anywhere that there is a single point of failure, this is a risk that teams should think more about.
Yeah, thank you so much. I think the points you raised, I was reading a lot about that on Twitter too, that some people blamed the curators, that like they're not doing their job good enough, so to say, even though they're trying their best. I think it can be fair to say. And I think this is a good point also where I wanted to bring in this angle to doing this ongoing debate, which I'm also seeing also between these verification providers. I see also a lot more underwriters specializing in that, but also like rating providers like us. We're assessing the risk versus curators who are doing self-assessment. I think our view is that specialization and collaboration is leading to better outcomes. Independent firms can, for instance, rate the asset, they can do the due diligence, right? They can provide the assessments to the curators, and the curators are there for the management. And it would be interesting to hear your, and it's all to all of you, your point of views. Do you think there should be specialization and collaboration, or do you think, and I see that very often in DeFi, that multiple players try to do everything by themselves to solve? And my opinion is like we should maybe now focus on like what can we do best, and what should be the job from every single market participant be?
I think you see this as a rating agency for tokenized real-world assets. Like, access to information is quite difficult. So for the end DeFi user, it's almost impossible to get information, for instance, on tokenized real-world assets. So it's impossible to get information sometimes about the workflow, the subscription and redemption workflow, which is the main factor of liquidity in real-world assets. And so the access to this information is limited. As there are more and more curators on chain, or asset manager even, the team that issue these real-world assets might not be able to give access to information to everyone. So as at Stakehouse, we all have a TradFi background. So we all come from private credit, hedge fund, insurance. And so we spend a lot of time discussing with the issuers on their strategy and to assess the quality of the real world asset. But sometimes it's even hard for us to get information, and we need to kind of escalate and things like this. So what is really useful for specialization in this rating, in this underwriting process, is that to be able to trust some companies, that some intermediaries that will have access to this information, that can summarize it, identify all the key elements that will answer to the risk, to the tokenization risk, for instance, the technological risk, the economic workflow, and how it flows to the asset, things like this. So as there will be more and more players on chain, you need this agency to get access to the information as a collective. For us, we develop our own internal risk framework with our internal risk rating. So we consume data from external provider, but we prefer to have our own framework in the end to present our own conclusion to the other team member and decide on the underwriting of the asset or not.
Maybe before somebody, I think also maybe to add there, I think this is also where contracts are there, right? Because I had another discussion with a more, I would say, DeFi native risk team, which were also like saying like, oh, we have like trouble to get all the information, especially when it comes to tokenized assets of their of the underlying funds and so on and so forth. And then I asked like, but do you have a contract with this company? Because in the contract there are, you know, traditional world like duties, liabilities, and you also can write in like, hey, you have to inform us in 24 hours if there are any material changes, for instance, or you have to inform us immediately, otherwise we can take actions. I think you can write that in a contract, right? And the question is always like, who has the contract relationship, right? And which are the information which can be public, and there are informations, unfortunately, which are not allowed, so to say, or which they don't want to have public, right? But I think with maybe contractual design, it would be possible that you can at least say, okay, we can trust because there's a contractual relationship. Otherwise, you know, if you hurt the contract, you have an issue, right?
So just on the contract, if we speak about NDA are just
Not an NDA.
Yeah, exactly.
Then real contract.
No, but I know, but just as a personal take, it's a waste of time. But anyway, because we are between salespeople, so we just lose time in the underwriting process. But it's paperwork that needs to be signed. So curators, yes, they are intermediary. They are the intermediary that will need to get this relationship with the issuer. And in the tokenized, in the real world asset, like talking with regulated institution, you need to have an entity that is onboarding with this issuer, that has a contact relationship with the portfolio manager, and that has access to the information. And so this is why we have a legal team that onboards Stakehouse Financial as entity with a lot of real-world asset issuer, for instance, or DeFi protocol.
Yeah, if I can just add to that, like I totally agree. Like anybody who is in the curation space, like I feel like the best motivation to do a good job is to use your own products. Get exposure to the assets you are curating. For instance, with KPK, we're also like onboarding into RWAs as collateral right now. We are authorized to mint them, to redeem them, to liquidate them. Like we are comfortable holding these assets, otherwise we wouldn't be curating them. And I think that's a very important thing. Like it's very easy to like accept people's money and put it somewhere and yeah, it's gonna be a good yield. But if it's your own money, I think it changes the game a bit. So I know like a lot of, most people here on the panel, like we are using our own products with our own treasuries. And I think it's the only way you can actually be motivated or like be somewhat incentivized to do a good job. Because you often see it like with the risk ratings, there might be some specialized entities or even risk creators that have like a preferential deal with a certain asset issuer, and they might not be incentivized to actually provide an accurate reading on the market. But it's different if you're lending against it yourself. Like you will do a good job or you will lose your own money and depositors' money.
But also to add there, because of course, I think it's what you can say to every, also to the traditional rating agencies, right, who get, where you have the asset issuer pays model. I think the only thing there is, or how we see it, I mean, we have an internal code of conduct where you can also say like, okay, you can maybe break it, of course, but the reputational risk you're taking is everything. You can have the best methodology, the best product out there, but once your reputation is gone, you're dead. So, and this is how we see it. We would not risk that because then I don't have a business. So that's why we are having such a high, such a high standard on that. But maybe engineer would be interesting as how you see it. Do you think there should be specialization? Do you think it's good how they did it before or until now?
Yeah, I guess since Jeroen has been around a while, I want to just zoom out a bit to like the history of DeFi. I have to say at this conference, I don't think I've heard the word rug pull once. And 5 years ago, that was not necessarily the case at any DeFi gathering. I have heard the word risk dozens of times. So I really think this is an indicator of the maturity of the space. As for the exact solution, I think we're going to find out where we end up. I know there's a lot of experimentation around how we are doing risk analysis, which approach is going to work for which people in the space. But I really just want to highlight how far we've come and the fact that so many people are talking about risk now. I don't know if this is because yields are compressed and people are really analyzing details now to understand where to allocate, what's going on. But I just want to say overall, I have a good feeling about how things are going.
Great summary. Great. Then maybe getting a little bit also to the topic of AI. I know that you, Gil, at KPK do a lot on that side too. You have agent-powered vaults also on Morpho, I read, with automatic rebalancing and exit agents. How do you trust those agents, or do you also interfere when there's market stress?
Yeah, so first of all, they do help me sleep at night, which is quite important in this space. Secondly, they're not fully AI powered, I'd say. So they're very advanced tools. We call them agents because they kind of run autonomously, but they're not based on, let's say, AI inference models. Now they're like algorithmically based on very specific input parameters that we can put in, like exit the market if utilization goes above a certain percentage, keep risk to, let's say, maximum 10 or 20% of the vault for an individual market. But you can go very advanced with it. So yeah, I do trust them a lot. To give an example of like how far you can go with this, like the latest market we onboarded on Morpho, which was a collateral by Origin protocol. We have over 300 monitors, so over 300 smart contracts we're monitoring, including things like major slashing events on the Ethereum chain, on the Beacon chain, like key compromises in a multisig of Chainlink or changes in ownership. There's a lot of like edge cases that as just a human, you wouldn't be able to catch. Like you really need this automation or a synthesis of and a categorization of events. It can be medium severity, it can be high severity. I think an example happened this morning. We saw an alert go off. It was an informational alert, like nothing too crazy, utilization spiking on the cap money markets. Actually, Stakehouse was pulling all the funds from the market. And I think it was good risk management in a way, because I believe, but correct me if I'm wrong, I don't have eyes in your internal kitchen, but the CoinGecko price was reported to be under $1, like $0.9. It was a fluke because they have the PSM, so it's like a one-to-one. So on-chain, the price was still 1. DEX liquidity isn't really available for that asset, which is why CoinGecko also displayed the wrong price. So in that case, like our emergency situation goes off, we review the process, but we didn't find anything that was out of order. So we kind of just enjoyed the high yield this morning, and situation has normalized again. But these type of things you would not be able to catch very easily if you rely on, let's say, alerts in your Slack channel and then have to go through this. You really need to like have what we call agents. So these are EOAs that have access to a Gnosis safe multisig where we have a roles modifier. It's a bit like with Upshift. You have very strict roles, you whitelist one specific function, and even in that function you can say, okay, we can reallocate on Morpho, but we can only reduce exposure, like pull funds to the idle market, not even reallocate to other markets. So it goes a bit further than the roles structure in Morpho itself. So we can go really advanced with, to us, like our bread and butter has been infrastructure. We've been doing curation privately for major DAOs for over 5-6 years now, managing big treasuries. And now, yeah, we want to open this up to the broader public. But I think the same risk management applies as in these older portfolios we've been managing, also relying a lot on automation to get out of stress moments.
Alex, really quick.
Yes, I think first of all, we are happy to provide a yield to the market. And as you can see, we've got automated response to different incidents. So yeah, we've been running on this type of incident response for the last 2 years since we started curating. And I think this type of automation allows us to protect liquidity during market stress. So our depositors are during market stress, we want our depositors to be able to withdraw their liquidity, and so this is why we preserve, we are able through automation and incident response to preserve liquidity. On the underwriting parts, when we review a protocol, and on the use of AI, it's obvious that it helps a lot in analyzing the protocol, and then we carefully review like all the worst outcome that can happen, and we mitigate them. So like it's all the serious creator jobs today. So, and you told me short, so I will end up here.
Great. Okay, we have 3 minutes left. Unfortunately, I had to skip so many other really amazing questions, but I think this was already super insightful. So let's maybe jump to the last question for our panel here. What's one thing, and please, guys, only answer in one sentence. I know it's a challenge, but what is one thing Vault infrastructure needs to ship in the next 12 months so that the next market stress maybe can, I know you said it cannot be prevented, but maybe how we can get more smooth, reacting to those incidents. Starting with Ethan.
Yeah, sure. So I would ask the question, who is curating the curators? And probably something that's very much needed in the space is something like an L2 beat for curators and for vaults. I have no idea why it's not being created yet, but something like this would help bring a lot more transparency to risk across vaults.
I'd also say transparency for what risk curators are doing, their OPSEC methods, and avoiding situations that can bring depositors in danger. It can even be off-chain things like a DNS takeover of the website or other things that can be quite dangerous.
Yeah, I think a lot of the time I hear people say, well, the data is on chain, but for a lot of people, it's not so easy to just jump into bytecode and understand and read it. So visibility into what's happening on chain.
Two things, good separation of off-chain risk and on-chain security. And the next, what I wanted to say, I think we need more transparency when a bad event happens, how the curators are affected and how the vaults are affected. And we need flags on, like explicit flags on who's affected and what will happen, because people don't understand the gravity of what will happen when there is a DPEG that is not priced within in a market, within a vault. Like it should be, and we've seen this, it's a rush, it's kind of a bank run, because the last, the depositors that are still exposed to this vault, they are exposed to direct losses. And so, we need more transparency on the exposure of the vault.
Amazing. Thank you so much. I think it was super insightful. We need more transparency. Thank you for listening to us. I hope you enjoyed it too and took one or two things with you today. And let's see how the next 12 months will develop for the world of vaults. And please applause the panelists. And panelists, please stay for a second. I would love to take a picture with you all on stage. Amazing. Thank you.
Please give us a few minutes while we set the stage for the next session. And next up, we have Shiv Shankar from Boundless, who will be speaking on confidential on-chain finance for institutions. Welcome, Shiv, on stage, everyone.
So, afternoon shift. So hopefully everybody had lunch, maybe an espresso. It's always difficult to follow such an entertaining topic like risk management. But let's see if I can pull that off. So just a little bit about me. I'm Shiv, I'm the CEO of Boundless Networks. This is my resume in case I was looking for a job, but I ran compliance and onboarding engineering for Coinbase, one of the worst jobs in the world. I hope Brian is not listening. Also compliance and onboarding for Lyft. I did a lot of custody work at Ava Labs, the team behind the Avalanche chain. I did some of the original agentic commerce work for Alexa, basically pushing voice shopping. Been an engineering lead. Basically, I've been working in Web 2 and Web 3, building systems, compliance, understanding all of this, and now I work at Boundless Networks. What is Boundless Networks? We invented the ZK VM. If you are walking around EthCC, they talk about the lean ZK VM, they talk about the next gen ZK VM, real-time proving. That all started with us building the first ZK VM. But today, I'm actually here to talk about finance. I see some of you, and I recognize some of you from the DAS conference as well in New York. Hopefully these numbers don't really surprise you. In fact, I expect someone to raise their hand and say, like, oh, that number is actually quite less. It's actually like 123 billion or something like that. But the real numbers are that billions of dollars are flowing into tokenized real-world assets. Nearly more than half the firms that I talk to in Wall Street and in Europe in particular as well are engaging with DeFi in one form and another. Some of them moving towards different chains, different products. They're just trying to see where the money is, how is it flowing, and how do they actually participate. And that's what we are here to help them with. Walls, right? So that's the vehicle that institutions are using across the board to put capital to work on chain. We've had so many interesting conversations, billions of dollars flowing, but our take is that we barely scratched the surface. Right? I saw some tweet today from one of the more famous media personalities that walls are ETF killers. Which is a fantastic phrase because it's an easy mental model to like put in your head that, oh, Vault is like an ETF or a managed fund, and that's how we get on chain. But we barely scratched the surface. Of course, this event organized by Morpho, and they paid out nearly $250 million last year to lenders. And they've been growing at a drastic rate, right? So I think this is something I pulled out from Galaxy Digital, and this is the curve that they feel like is going to get drawn. It's a very optimistic curve. There doesn't seem to be any dip. It's a constant curve that just keeps growing till 2030 until they get to $2 trillion. But folks who've been talking to banks and financial institutions who manage highly regulated assets and not just stable coins that are moving around, know this to not be true. There is, in fact, something we call the transparency tax. Essentially, let me tell you actually a story here. So I met one of these bankers at DAS, and as it happens to be, I bank with them. They manage all hundreds of dollars that I have in my bank account. It's not a good token season. Just have like hundreds of dollars. So anybody buying me coffee, it's totally fine. I was talking to her, and I just made this passive comment, like, since all the transactions are available on chain, she was like, wait, what does that mean? And I was like, well, the transactions are available on chain. She's like, you can't read them. I was like, I absolutely can. Go to Etherscan, you can see all the transactions, address 1, address 2. Yeah, but you don't know that's like Bank of America settling with JP Morgan. I was like, I absolutely know that's Bank of America settling with JP Morgan. In an age of AI and tools and data analysis, all of this can be mapped out. And this is one of the things that banks realize. The smarter bankers, or the CISOs, the CIOs, the CTOs, know this for sure. A public ledger exposes you to every single thing that happens. Every single public position creates market risks. Every single compliance gap. There's no way to prove that all the compliance rules were followed, and everything that is on chain creates more and more data for people to analyze you. Right? So in case you are building a B2B product where you settle payments between vendors, I've spoken to a large e-commerce setup based in the US that sells me toilet paper, and they have a large number of vendors with whom they want to settle on chain using stable coins, but they're like, hey, I don't want to tell my competitors that this is my annual payout. I don't want people betting on my stock to know this is how much I paid my vendors. They want all of this information. Private, but compliant. They want payroll is a very, very interesting scenario as well. One of the first things that I realized is a classic fit for the Vault architecture. I know this room isn't like particularly enthusiastic about payrolls. You want to talk more about RWAs, but as it turns out, vaults are extremely useful in like different scenarios. Again, people don't want their salaries to be a public record. You don't want all of this exposed out there for people to analyze. So vaults are ultimately the foundation. It's here. We all use it. We all talk about it. I think the last question in the panel before me was, what is the one thing that we need? And everyone talked about transparency. I'm going to flip that narrative a little bit here. what we actually need is confidentiality and compliance. It's not actually at odds with transparency. Applied confidentiality, applied compliance leads to the right kind of transparency. You can't just, there's this old adage, like when I was to work at Amazon, like people say that all the information at Amazon is available to every employee. Yeah, it is, but there's like petabytes of data. What the hell am I supposed to do with that, right? You want a certain framework within which transparency is created. You just don't throw everything open. Someone said we need an L2 beat for everybody managing vaults. Sure, but now there's a centralist authority who's creating the rules around it, like confidentiality and compliance is the name of the game. So this is more or less an unveiling. What we're creating now is a concept called a shielded vault. What we essentially did is take the vault that all of you love and use and build on top of and add a compliance and privacy layer on top. Our expertise being in ZK technology, keeping things private, selective disclosure, and all of that. We decided to put this wrapper on top of a shielded vault, provide compliance at every stage using a policy engine that uses ZK technology to enforce compliance, selective disclosure, right? So this is the part that most banks are very, very interested in. So I've actually been working with lawyers for the past 8 years of my life. This is why I'm so funny and upbeat. Sorry, just a lawyer joke there. One of the first things that happens when you work with a large institution is that your product manager is excited, your engineers are excited, everyone goes in and the lawyers pour cold water on it, right? They're like, hey, what about the travel rule, SARs? What happened to MiCA? What happened to CCPA? What happened to GDPR? And everyone's like, okay, too many words, maybe just kill the project and let's just go home. So we decided to rebuild the vault from the ground up with a compliance-first approach. We're actually focusing on working with financial organizations in building all of this out. One of the first sort of product principles is you don't build in isolation. You talk to your customer, give them the basic concept of what we're building, and then get feedback from them on how exactly they want this to be built, right? So the first point of difference between like a regular vault and a boundless shielded vault is that it is configurable for any financial use case. We talk to you about what you want shielded vaults to do for you and build that out. It takes us roughly a day to tune a shielded vault stack to like perform in the way and manner that you want to, and we can have all of this out in a week or so. So one of the key taglines which my marketers really like talking about is that shielded vaults are built for capital that can't afford to be visible. And as it turns out, most capital can't afford to be visible. We make Ethereum and every public blockchain accessible to this capital. Yeah, so there are like a few cases that we've already started building out, and they're in the different phases of being rolled out. The first one is confidential stablecoin payments. This might be a surprise to a lot of people in the audience that like I'm using a vault as a primitive to like do payments, but when you actually think about it, it's perfect for private payments. You don't expose yourself. You can run KYB, and merchants receive their payments in USDT and USDC. This is a fantastic use case for how we started our journey. And we're seeing incredible traction. Now, the interesting thing is, if you are using a vault to facilitate all of this, it does not preclude including Morpho or their other named competitors in activating yield on these like vaults as well, which creates a new mechanism for people to like manage their finances, which is why we went on to the next set of like customers, which are treasury management. We spoke to some VCs as well as like large treasuries of L1s and so on, who manage huge amounts of money. As much as like this is a down season, most foundations are still doing pretty okay, and they want to like move money around, except they don't want everybody on the planet to see what they're doing with their money as they create more yield and manage their finances better. Again, a completely untouched market with vaults, something that we are opening up for everybody. And of course, the one that everyone here is very, very interested in, which is confidential RWAs. We're working with a very, very well-known bank in designing this product. We want to actually give it a special name and like have that out and have like the T-shirts and stuff. But that's for the next talk. Here is a QR code for you to scan. Like I said, I did work at Coinbase. I was also the person behind the QR code ad, not the marketing, the engineering, when it actually came out. We couldn't make the QR code move because it's a Google slide, but maybe next time. We also have some team members out here for you to meet, our head of engineering, head of marketing, and myself. Please talk to us. If you are interested in building something future-proof, if you are interested in building something that works well with banks and their expectations, we hope to be good partners to you. Thanks so much.
Thank you, Shiv. Next, we have Nassim from Rockaway X, who will be speaking about Curation Reimagined, Risk Through Every Side of the Trade. Welcome, Nassim, on stage, everyone.
Thank you. Hello, everyone. So I'm Nassim, leading the curation department at Rockaway X. And today we're going to talking about what does it mean to be on every side of the trade. But before that, who are we? Like, who's Rockaway X? Probably some of us knows Rockaway X more on the investment side, liquidity, or infrastructure. So we're not definitely a new entrant in this industry. We do exist since 2018, mainly serving institutional needs and their demands. And here now we're, for a few months now, entering the curation game to kind of bring something, all the expertise, institutional expertise we have. And we've been like early Morpho backers. So what does it mean in practice for us? We always believed and we're convinced of the Morpho value proposition that the risk needs to be managed by sophisticated and professional actors, and sometimes even specialized in certain field. Either for institutions, even for RWA, more leverage and risk assets, and so on. So Rockaway X, a Curator 2.0. Why do we think that we are a Curator 2.0? We basically address our due diligence and how we act through main 4 pillars. The first one is, of course, mainly transparency. We're talking about a lot about transparency this week and risk management, but so on-chain parameters, verifiable risk metrics are already on-chain, so everyone can check them, but do you know how your curator is really assessing the risk? When you redeploy, you mainly trust curators on reputation, which is quite important, of course, but you have probably never seen any methodology, any published reports of most of your curator on how to do this, and that's something we would like to change. We'd like to publish this performance report on how we address this, of course, combined with all the risk discipline we have at the institutional level. But what matters once we said all this is also the execution. If we are able to do all this and publish all this methodology, but we're not able to execute, it doesn't really help and matter. So Rockaway X on Morpho, so we have 3 vaults for 3 risk profile here, something for every risk appetite, and of course, all this with the same underlying discipline. So the first one is Rockaway X Prime. You probably all know these Prime vaults. They're mainly addressing people who are on the safe side of the risk curve and the needs of neobanks, fintech, and so on to address new needs in terms of yield distribution. You have the Rockaway X yield. So this is more like moderate on the risk curve. We basically here it will be a focus mainly on RWA and high yielding strategies. And then the Rockaway X wrap ease that is mainly listing each denominated assets and people who wants to leverage their LST and LRTs. But vaults are only as good as the assets inside them. So let's talk about RWA opportunities. If we look at the Morpho growth, even though in the current market conditions, the deposits are still coming, and Morpho is doing way better than their competitor in terms of TVL retention. And why this? Mainly because Morpho is also tapping into a market that's not only based on the on-chain yield. They're able, thanks to many curators here, to list a lot of RWA as collateral, so people are leveraging against them, and that's kind of sustained the lending yields. But the question could be why we don't have way more. So the issue is not the token issuer like Centrifuge, Midas, Securitize, and so on. These players are already here. The main issue is the RW underwriting. How to make sure that the underwriting is well done, the Oracle is properly set according to how the NAV is updated, how the reports are done, what's the jurisdiction, the legal challenges that we have. And so RockawayX here brings three things. The main thing is our TradFi background, our institutional expertise, so the credit analysis, the legal structuring. We have a team that did that, that's our background, and of course, all the Morpho expertise we already have. So mainly for this, our goal is also to not only list RWA, but really to support them in their integration. The goal is not to assess the risk and then list you, but really see how we can help this RWA issuer to have a better integration. So that's why we're happy also to support, for example, Prime from Figure that has just been announced yesterday on Ethereum mainnet. As for now, we were also active on Solana, so there is due diligence, there is risk assessment that has been done, and we're happy to support those that are moving from chains we are to other chains we are too. That's how we support our partners. Of course, there is way more partners to come that will be announced in the coming weeks. But what matters for us is really like the quality of the assets, what's the proven track record, and of course the institutional integration. But who really have an access to this? Like, let's talk about who can have an access to these vaults. I think today, in terms of distribution and access for any creator on Morpho or any other platform, it's when you're listed on their UI, it's not the end, actually, it's really the beginning. Like Morpho is an infrastructure platform and not really designed as a distribution one. Could be for the B2C, but that's it. So there is three main channels, like the B2B with direct institution that will have exposure to your vaults, B2B2C, as we've seen with a lot of integrations through even white label solutions, or for fintechs, neobanks, and so on, or of course the B2C direct rail. But how we make this, like how it's really happening. So for this, you have to convince the different institutions, and we've seen that in 2025 and earlier, like the first part of this year, Morpho is by far the most adopted solution by the different institutions to offer new yield integration. And that's really how and where we want to have our focus to distribute this product. So Morpho is one thing, but what will make these vaults, and not only our, go to 1 trillion and more, is definitely distribution with the main actors. But of course, this distribution only works if the risk management underneath is bulletproof. So how we do this and how we make it bulletproof. So we have best practices and multi-agent system. And by risk management here, it also includes incident management. So you have three layers. The first one is mainly Hypernative on our side and also our internal tools to monitor all this for real-time threat detection and multi-agent system with rebalancing, optimizing, and of course, exit events. And all this is based on 6-pillar framework. So these are not like static, it's not a static checklist. The main point here is like how this is a live operating system 24/7. So that's thanks to this, since 2021, we've been able to have zero exploit, zero default on this, and it's not luck, it's mainly architecture. How are you addressing and managing your incident live threats and all the incidents you can face? Today, you probably saw what happened like a bit more than a week ago now. There was some curator code, some others know, and this is not luck again, it's mainly thanks to their architecture. These take times, sometimes years, but now we're evolving with something even more sophisticated, and I would say the more advanced curator they have their own agent, trained, and that's where we go. But I wanted to do like a specific slides for the agent that are powering the system. We have mainly two here in terms of risk at RockawayX. So the first one is the smart contract monitoring. Again, on our side, like, of course, we rely on tier 1 auditors, and this is like the most reliable part. But it's a snapshot of the smart contract. Most of the time you have upgradable parameters, upgradable functions, or functions that rely on multisigs, EOA, and sometimes multisig that could have a quorum that might change over time. And that's what we kind of have a live monitoring for. And every time, of course, this live monitoring is every time you have something upgraded, something that changed, a full re-audit of the smart contract by the agent is done, and then he flags us if there is something that is high or critical to check at, as a EOA, for example, meeting access. And then the second one is more adversarial, what we call adversarial agent. So what does it mean in practice? This agent is always scanning what's the sentiment of a certain project, on a certain asset. Is there any change in the governance? Is there any change in the team? And all the stuff you can imagine around a team and a project that are not relying to the tech part. And this is 24/7 also happening, and there is no human lag or human manual action for this. So that's how we plan to bring more transparency and risk, and mainly I think the thing I wanted, like the main word is incident management on top of risk management. Both are as important in what we do. So that's it. So thank you everyone. If you have any question, I will be available after. And if you want to discuss about distribution, RWA, and collateral, I'm more than happy. Thank you. Thank you very much.
Thank you, Nassim. Next, we have Mehdi back again from YO Labs, who is speaking on DeFi yield today, returns, strategies, and risks.
Hello again. Can you hear me well? Well, I'm excited today because I'm talking about the thing that is the most exciting to me, which is the main question of DeFi. Where is the yield from? Where is the yield coming from is a question that's interesting because it changes every year. And so this is basically a macro view of DeFi yield, looking at the strategies, but looking also at the risks. It's always important to do that and to have a good understanding of where we are as an industry. My name is Mehdi Lebar. I'm the CIO of the Yo protocol. We receive a lot of pitches all the time about things to whitelist. And so we have a very good understanding of all the yield strategies and opportunities that exist. From a macro perspective, it's interesting to know that 5 years ago, there was a lot of yield opportunities that were really great, double-digit yield, with somewhat low risk. But we have seen a lot of yield compression. Actually, we have a lot of capital and capital efficiency in DeFi. And the issue is more on the demand, which is actually surprising for most people because everybody's like trying to get TVL and TVL to grow. But given the demand for DeFi services, there is not really a need for more capital at this stage. And so that's interesting because if we look at the efficiency of the market has elected two sources of yield that have product market fit, that make sense, which are lending, actually secured lending through Aave or Morpho, and staking as proof of stake makes a lot of sense. Now, if we look at trading fees, which was like basically market making, that was representing about 20% of the yield. Today, it doesn't represent much of the yield. And that's because there is like much higher concentration of liquidity, there is more efficiency, and basically Uniswap, by launching V3 and V4, made the capital much more efficient, so you can have a lot of trading with the same capital. The good thing here is that it's mostly actually a very mature market. We have been saying that DeFi was not mature for many years. In terms of DeFi yield, it's maturing in the sense that it is allocating to the things that make most sense. Now, you'll see RWAs there. I'll get back to that. That's the new source of yield, and it's very interesting, of course. All right, just to look into a small deep dive on lending. On lending, we have BTC-based lending that grew a lot. It grew by $1 billion over the past 24 months. And hats off to Morpho for that and Coinbase that came together and created like a new demand for yield, a new yield source by having Bitcoin used as collateral in order to have more yield. Another second source of yield is a little bit more degen, but it's still like interesting, which is the yield-bearing stables. It's mostly looping. It's looping like Stirrup USDC or like any type of stablecoin to get more USDC and to get like leverage yield. ETH-based is actually the most ancient. It's basically MakerDAO, how we started to create stablecoins. We created them with DAI and like having ETH as collateral, and so that's a good one. So here again, same perspective. It all makes sense. It's good. Now let's get into RWAs. What we see is that over the past 15 months, private credit has increased 40x. And there are two types of RWAs. There is the US Treasuries, or RWAs that are really easy to understand. The counterparty is just the state. There's a question about who's the custodian, but there are not a lot of risks involved. It's like very clear, very easy to understand. However, as the CIO of EO protocol over the past 6 months, I have received dozens of pitches for private credit that I could not understand. I would ask where the yield comes from. They would give me like a very vague answer. And so that's worrisome. It's worrisome for the industry because back in 2007, I was an investment banker at Credit Suisse, and we went through like that whole like great financial crisis because we didn't understand where the yield came from. And here we have the same issue. We have like a lack of transparency. The transparency is perfect in DeFi, but once you get into the RWAs, you rely on counterparties. And so it's very important to understand these two differences between tokenized treasuries, which make sense, are providing a good new yield source, and we should like have more of these. And another extreme, which is more like private credit that needs to be audited, that needs to be explained, where the transparency is not necessarily there, where the redemption rights are not necessarily there. Because this could be the pain that we will all have in a year or two as the macro trends change. The legality of redemptions when a real world thing is involved, when a company is involved, when lawyers are involved, when the judicial system is needed, is not the same as when you have a DeFi thing. And so that's something that we need to keep in mind. Counterparty risk is increasing. So basically, if we look at the risk spectrum, we started with secured lending, Aave, Morpho. We moved to tokenized T-bills, that's all fine. But now as we're starting to look into like more and more risk, be mindful and be careful with all the other two, the tokenized private credit and the secured lending. One of the issues that we're having is that there is adverse selection potential when it comes to DeFi. There is an asymmetry of risk when it comes to DeFi. It's easy to go to a retail user and say, well, we have $100 million of TVL, let's get to 200 million, let's get to 500 million. But nobody is checking because no one has the incentive to check. And so this asymmetry of risk comes back when, as I was seeing like more private credit come in on chain, I was also seeing TradFi starting to have issues with private credit. And so if you look at the recent news, BlackRock and other very renewed funds, like BlackRock is one of the best counterparties that exists out there, blocked redemptions. And so what happens when they bring it to DeFi? we have a cascading effect where it creates a lot of pain, hemorrhages inside the DeFi ecosystem. So this comes back to an asymmetry of information, obviously, where there are things that we're not used to ask. We are used to ask if the code quality is good. We are used to ask who has the rights to upgrade the contract. We're used to ask whether there was a hack before and whether this thing is battle tested, is the protocol battle tested, and so on. But there are a lot of new questions that we need to ask and related to the, how pricing works, how the NAV is calculated, who is the counterparty, and these are not in our risk frameworks in this industry. So it's going to be hard to bring them in because the information is not out there. Nevertheless, this is an amazing opportunity. If you look at McKinsey, they are saying, well, everything is coming on chain, everything is getting tokenized, and private credit is going to be part of all of this. So I'm not saying we shouldn't do it. I'm just saying let's be careful. Let's be mindful of it. And I think that's already going to be a win. Also, let's keep it aside. Let's not mix things together. Because if you keep private credit aside, if you speak about private credit as something that is a little bit more dangerous, then it's all fine. Thank you. And yeah, this is us, Yo Protocol.
Thank you, Mehdi. Please give us some time as we set the stage for the next session. Okay, next session will be a fireside chat moderated by Andy from the Rollup, and our speakers, Christine Moy from Apollo and Paul Frembo from Morpho. Welcome them on stage, everyone.
Yo. Hello. Whoa.
Hello? Test.
Hello.
No, we can't.
How we doing today, guys? What's going on here?
Yeah, okay.
Vault Summit.
Oh, no, we can't hear you. No.
She was giving a guy a mouthful about private credit back there, and I think they had to mute it. There we go. We're going to stay off that topic here today. All right, we're going to get right into it then.
Let's get into it.
Here we go. Ladies and gentlemen, welcome to Vault Summit, the future operating model of institutional asset management. Christine Moy of Apollo, Paul Frambot of Morpho. Guys, brief introductions, please, for the audience. Christine, please.
Hi.
Still kind of not working.
Hi, I'm Christine, partner at Apollo, $900 billion asset manager specializing in private markets, including high-quality private credit. Also must know that we are also the largest buyer in the public fixed income markets. So, you know, we can do it all across the entire credit spectrum. But it's confusing, so we don't really talk a lot about that. Additionally, have spent the past decade putting traditional finance on chain. Previous to Apollo, built and led JP Morgan's blockchain program, invented JP Morgan Coin, which was supposed to be bank-issued stablecoin, created intraday repo, which has now transacted trillions of dollars on a permissioned blockchain that no one knows about or has heard about or cares about, but actually was one of the first TradFi implementations of Borrow Lend. This is all to say, like, have spent my life's work trying to figure out what does the future of finance look like on chain and with DeFi.
Awesome. It's actually my I don't know how many panels I've done with Christine over the last 2 weeks, but probably number 4 or something. I'm Paul, co-founder and CEO of Morpho. So you guys probably know about Morpho, but we do on-chain lending and borrowing stack. We, on one end, let people earn yield through vaults or by directly allocating to specific borrowers, and on the other end, we let people get some financing for whatever they want, right? Including, crypto collateralized loans, but also RWA-backed loans, and soon, more than that. So yeah, excited for this panel.
Awesome, guys. Been talking to the Bitwise folks ad nauseum. It seems like had their entire roster on, and they keep pounding to me that vaults are going to do to ETFs what ETFs did to mutual funds. In that we have these ETF products today in traditional brokerages that have an active and a passive form. They operate as the largest kind of place where traditional investors put capital across index funds, commodities, metals, and the whole sort. Do you agree with this, Christine? Are vaults kind of this next iteration of ETFs? Why not? And what could that look like?
Yeah, let's just take Morpho, for example. This is actually why, Apollo has found Morpho to be so compelling. You have the capital aggregation part, and you have, essentially a role of allocating capital to, in various ways into borrow-lend markets, essentially. And, basically the next evolution, from what currently exists is essentially on-chain credit. And so, when you kind of take that all together, what does that look like? It actually looks a lot like asset management, and it looks a lot like borrowing and lending and the type of business that we do at Apollo. I think that as we've heard today, there are broad definitions of vaults. There are many different types of implementations. And I think even, in some of the discussions, you will see different vault curators, portfolio managers, asset managers, however they want to call themselves, do different things with this technology. I certainly think that the automation, the scalability, and some of the controls will definitely set the foundation for, asset management in the future. I don't want to be very specific on the definitions of what a vault is and what it can be or what it is, because, like I said, people will have different implementations, and certainly the regulators will have views as well. But I think that the idea of having real-time transparency and data, having automated asset and risk management, this is all incredible stuff, not only for traditional finance as we sort of transition asset management on chain, but we're kind of at this really interesting intersection point of the acceleration of stablecoin adoption and also AI agents. And so I don't want to be super hypey, because there's definitely more wood to chop in terms of actually kind of enabling AI agents to be able to move value at scale. However, I think this intersection is a really interesting one where, essentially a lot of what people are doing here today, in this community, really will set the framework for what asset management of the future looks like, which will be mostly automated and digital and real time.
And Paul, kind of on your side, if this evolution, is to play out, how would you describe the core upsides and benefits to using a product like what you have at Morpho with your vaults comparatively to the traditional finance ETF or kind of anything in that range? How do you see the actual benefits of using your product?
Right. I think at the end of the day, everything that's on chain comes down to two main value proposition for users. It's about control and network effect. And so I'll explain what I mean by this. Is when you're on chain and you're using your vault stack, right, and you have the opportunity to control end-to-end the asset management stack, down to the bottom, right? That means like configuring risk parameters, configuring compliance parameters, like which type of investment that you're going to do. And you can operate this in like one global shared computer, which is the blockchain, in which you have direct access to every single opportunity that's out there. And so, you know, technologically, like you benefit from like the standardization of the interfaces, which allows you to access a breadth of opportunities in this global computer, which is unmatched compared to traditional finance, where in traditional finance, you know, when you think about it from first principles, it's a bunch of different computers, databases that need synchronization. You need to build the connectors with each of them, and there's no standardized interfaces. And this is why you have so many intermediaries when it comes to payments, when it comes to investments, etc. And so now you have this shared layer where this sort of like common ground where people meet, right? And so the people that have demand for capital that are ready to pay, like, you know, people that have ambitions that need to be funded, they come directly to the chain and they match directly without intermediaries through standards with the actual lenders. So I think that's the first benefit. And so the first benefit being having this sort of like on-chain code stack that you can configure and control end-to-end. The second benefit comes also from the openness of the chain, meaning that you're going to be able to aggregate all the intents, whether that is the lenders, the borrowers, the traders, like option traders, spot traders, etc., in a single place. So think of it like a single order book to rule them all, right? Like you don't have anymore like 10,000 different exchanges with like different order books that need to trade and have their entire DevOps team and then needs to be arbitraged, etc. Now you have a global shared book that allows multiple players to meet at the same place, and that allows for deeper liquidity, better pricing, etc. Concrete example. If you take Coinbase, for example, and how they integrated Morpho, Coinbase used to have a centralized like lending and borrowing service, right? So users could borrow on the Coinbase platform, but it was really limited in terms of pricing and liquidity. Now Coinbase directly borrows from the chain, right, from Base on Morpho. And what's interesting is that the Coinbase borrowers, they borrow from a liquidity that is global, and it's actually coming from Binance, or it's coming from Kraken, or it's coming from Gemini. Like literally, so Morpho integrates with every single exchange at this point, and so we sort of reaggregate the intents of the different exchanges in sort of one shared backend that's going to unlock new levels of efficiency, of liquidity, that's going to end up being like better financial products for the end users. So what does that mean concretely, to answer your question, is that the spreads are going to be thinner, the pricing is going to be better, so lenders are going to earn more, borrowers are going to pay less, right? And what that means concretely is that the cost of trusting each other, the cost of believing in people that have ambitions and funding those ambitions is going down, right? And when I think about what I get excited about, what Morpho is going to bring to the world, is basically this collapse of the cost of trusting each other at like global scale, right? Like how do we enable people to basically believe in each other and discover new opportunities to fund at scale? And so I think those are like the two main value props of like moving on chain for lending and borrowing infrastructure, which is enabling control. Like if you're a fintech now, you have the opportunity to not only control your distribution but your entire financial stack. And the second one is you access global liquidity that has no boundaries. And as a result, provides better pricing for users and better breadth and diversity of products.
Christine, do you see
and that's, by the way, like just to like add on to that, that's actually super disruptive.
It is.
Like especially to like asset managers or lenders or private managers like us, as an example. But I think that when you think about technology, like if it can happen, it will happen. So then it's really about like, how do we participate in that change? I feel really fortunate to be part of a firm and working for leaders who think about change constantly. And, our North Star is actually like the way that Apollo has been successful in the past 3.5 decades is absolutely not how we're going to be successful in the next decades. And so, we're embracing the change, we're embracing the disruption. We are, I guess in some ways, maybe even accelerating it for ourselves by leading the charge. But, the hope is, we, like, despite that disruption, which, will result in better outcomes for both borrowers and lenders, Like we will actually learn enough to figure out like what is the next business model, what is the next alpha, besides and beyond like what the current models are.
And I want to double down on this because I think this is exactly the game theory of what's happening is that the value that is kept centralized in like the traditional financial infrastructure is going to be pushed to the edges of the network. That's basically what blockchains are for, is like pushing value to the edges of the blockchain networks. And so overall, this is immensely disruptive for traditional financial institutions. And the only way to benefit is to actually be first and be early, and like basically what Apollo is doing, and actually disrupt your own business and be first to do so in order to take a larger market share eventually. And I do think the people that realize this too late I think the consequences for them are going to be absolutely immense. Like I think it's going to completely disrupt their business end to end. Because once you get it, like once you get the notion of like an open global order book and with better pricing, etc., it's just like it's inevitable. This is going to happen. There's just a lot of activation energy to get there, but it's obvious that the optimal state is this one, and that this is what we're all marching towards, right?
Yeah, Paul, I mean, on that note, when it comes to the onboarding of a lot of these assets on-chain, I think that it's very clear, as you say, like this kinetic energy is flowing. We kind of got through the potential energy part, a lot of the regulatory side, a lot of just kind of like this, what we're calling institutional FOMO is now happening, if you will. And a lot of these new types of what we call high-quality assets are coming on-chain. Anything from a tokenized T-bill to an equity, to a metal, et cetera, and they want to come on chain, and it's quite easy to explain why. It's just do more with these assets, borrow against these assets, earn yield on these assets, get access to these assets 24/7. It's very simple value propositions, and it's very clear. When it comes to the way that I think a lot of investors have thought about products like yours, it's been solely for crypto assets. It's like, okay, we're going to borrow against Bitcoin and ETH. We're going to do an over-collateralized strategy. There's a couple $1 trillion here. Okay, so this protocol is going to be a facilitator of perhaps a couple $100 million on chain, or tens of billions at most. Now that we're really going through this tokenization process, it feels like the TAM of these protocols is blowing up in people's minds, such that they're kind of realizing that this is not just a layer for crypto assets, it's a layer for global finance. Talk to us about what that expansion looks like.
Right. So there are $200 trillion of loans, in the world today, and crypto-backed loans is a very tiny part of that. It's $60 billion, to your point, and it's frankly quite uninteresting to build just for that, right? When I think about Morpho and what we want to do is we want to become the open credit network for the world, right? And we want anyone that has ambition and a reason to be trusted to be funded. Right. And that reason to be trusted can be crypto collateral, it can be RWA collateral, it can be an identity, a payment history, a credit, score, whatever, right? And so Morpho's role is to provide a language for people to express why they should be trusted, and then let the curator network actually assess that and fund people, right? And the market should fund the people, right? And for what it's worth, at Morpho, we've always thought that the crypto-backed loans only was a very limited market, and so we've structured, and you could tell like of how Morpho is structured, we're not originating the loans. And if we were to only target a 60 billion market, we would have decided to just be a crypto bank, and we would have done the underwriting ourselves. It's not, like we would have done it. But what we're looking after is the 200 trillions and 8 billion people. Right. I'm not going to underwrite 8 billion people myself, right? I need thousands and thousands of vault curators, asset managers that constantly, go to every single person in this world and like fund their ambition, right? And so I think this is like the key thing and realization. Now there is practical realities of how do you get there? Like how do you do like, truck loans or like, whatever, type of loans you could imagine on chain. I think you have to be realistic and pragmatic about which type of loans you go after, one after the other. Crypto-backed loans was a very natural fit. People had Bitcoin, it was on-chain, we had a price feed, a liquidation engine, that makes sense, right? RWA-backed loans is also something that makes sense. But now we need to think about what are the on-chain trust signals that we have that allows a curator to effectively trust people with their money. And for this to happen, you need to give the curator the ability to set the rate, right? Which is more what we've been working on for the last year and a half, and like our next release is about like fixed rate, fixed term lending protocol to allow them to basically set the rate. But you also need the borrower to show stuff about them. And so, maybe they have a receivable, maybe they have an on-chain RWA that has a correct price feed and that can be liquidated, et cetera, et cetera. And in order to access this entire TAM, the flywheel is the following. We bring in more distribution, right? More fintechs, et cetera. They bring in AUM. That's exciting. So new asset managers come in and they're like, hey, you know what? That's a lot of money. I want to curate that, right? Those asset managers bring in expertise, right? That are going to create new types of loans, and they're going to, not just do crypto-backed loans, but are capable of underwriting a bunch of stuff. Like when you look at like Apollo is like, the largest private credit fund in the world, like are capable of like underwriting like pretty much like anything, right? And this create better products on chain, which attracts new distributor, which attracts new asset manager, blah blah blah, right? And I think this is really the flywheel that gets us from $50 billion of crypto-backed loans to 200 trillion of credit all on Morpho.
Yeah, and to add on to that, at Apollo, our mission, on one side where we take in investor capital or where we underwrite our annuities is to help our investors retire better, like save better and retire better by, generating the returns that we do as an asset manager. And then on the other side for, our lending business, like helping to build stronger businesses, helping businesses grow faster, right? Through lending into the real economy across hundreds of businesses, underwriting things from mortgages to aviation leases and trade receivables, and we actually have like 16, 17 like independent companies that specialize in all sorts of proprietary credit originations, and the opportunity that we see here is to essentially like bring that to the on-chain economy. So, as you think about stablecoin adoption, like those are, basically the conversion of the investors, the savers, and the retirees that we currently serve, but the next generation being on-chain. And, like the language is different. Like, rather than be part of a pension or retirement, sort of program, which is how we typically service our off-chain investors. Now they're coming through earn programs because stablecoin wallets or crypto wallets are kind of like the new sort of venue and bank account or financial account, if you will, of the future. And so basically being able to generate the yield, the income and accelerate the income that these investors, or I guess what we're calling vault depositors, want and need for their own savings, earnings, and retirement goals. And then on the other side, like a whole next generation of lending on chain that will accelerate the businesses that are growing on chain or at least adopting on chain. And I'm super bullish, not only about Morpho, but also about this next generation of credit-focused companies like Valinor, Tear, 3F, Credit Coop or Co-op, Steakhouse. Basically, there's a whole genre and generation of on-chain credit right now that is growing that, I'm super bullish on that. I hope that the technologies that they build are essentially going to be the foundation of what we end up using. So this is all to say, as it relates to the expansion of assets, I see it in two different categories. So, we are a $900 billion asset manager. We are constantly, doing this proprietary origination across all types, across all industries, and lending to all these various companies. And one sort of iteration is that we take that from off-chain and we bring it on-chain, in a real way. And that's going to take time. The first iteration of that you've seen as tokenized funds, but soon over time getting closer to the asset level, soon over time the actual lending facility on chain. We have to take it in steps because, to be honest, it's an evolution, and a lot of these technologies are not built, but the companies that I mentioned are building it. And so we're going to see that progression, if you will, that iteration. Think about the tokenized funds as almost like V1. And so what you get there is that you have the conventional credit that has the superpowers of being automated, having the better like security around like repayment and, you know, kind of a more transparent structure. And then there's a new genre of credit originations where maybe someone like Apollo would not have been able to underwrite that credit before because it was too small or it was too fast, or, you know, it was like kind of like not something that matched either with our capital characteristics, or was not at the scale that we, you know, would have the resources and capacity to address. However, when you put it on chain, being able to aggregate it, being able to digitize and like sort of have an interface to scale it and monitor like all of the, you know, minute parts of it, that would also create new types of lending that we've not even seen before, that was not possible before, that was not scalable or economic for us to address before, that, you know, basically this technology can bring. So like I'm super excited about, you know, sort of the asset universe of what's possible on chain to essentially generate yield for on-chain stablecoin depositors.
And then just on the underwriting side, Christine, what would that look like in practice for kind of like one of these more extraneous examples, an aviation license, right? Like understanding why that's not possible today, and then some of the benefits. You talked about transparency. You talked about just the ability to get liquidity on these kind of illiquid assets. What does that look like from Apollo's side to actually step in and start to underwrite some of these more extraneous types of assets? Is it just doing that on Morpho in a vault that you guys are curating, or that a partner is? How does that look?
Yeah, I mean, first of all, we're already doing aviation leases, but cool. Like, you know, like I'll just give you a tangible example, since this is one that you know, Chris from Credit Group like talked about. But like credit card receivables as an example, like that is also something that we already do. But in order to structure that deal, that is with one counterparty, it's usually sized at about $5 billion or more. And it's a tenor of like multiple years, like call it like a 5-year facility, right? And like, you know, like we do them, but like how many of them can you do, right? However, you know, what's possible when you have a standard language on chain, when you have, you know, essentially, you know, clear, trusted data on chain, is that rather than just face one counterparty and then, you know, essentially underwrite one monolithic deal with like a really long tenor, because that's what matches your capital, then there's the actual opportunity to aggregate like smaller, you know, let's say merchant acquirers, that all like will follow the same standard language, and maybe they're all small in pieces, but they all aggregate into like a larger, you know, I guess borrowing need, if you will. And then you have Vault Capital that, you know, is different than existing fund capital, and it can be more suitable for something that doesn't, you know, require like a 5-year tenor. May actually even just be over the weekend or just a few days or a shorter tenor. So that's an example of how, you know, credit can change, that essentially you can have more on demand, more like you can have like the attributes of having something that's more on demand, but then you can have the attributes of more like scale and sort of aggregating, you know, capacity together.
And Paul, last thing for you on this point here, in this example, why is the Vault and Curator model the best for this kind of $200 trillion vision, not kind of like a pooled model or other models of lending? Why is this model specifically made for this expansion?
Right, so just to make sure I understand the question, is like basically the Aave model where like you have centralized underwriting by a DAO versus like the Curator model. I think for me it's just like a scale thing. Like if you're actually serious about targeting the $200 trillion that we're talking about, there's just no way that you can scale and underwrite everything yourself, right? The Curator model is about basically leaving the responsibility of underwriting to the market, right? And providing a stack for anyone to come in and underwrite. And I think this is, in my opinion, very clear that this is the only way you actually underwrite 7 billion people, right? And I don't think it's even, I actually think it's dystopian to think we would have like one single DAO underwriting the entire world. Like I think that's actually very grim. I think it should be the market giving the fair price for everybody's like, you know, ambitions to effectively fund them. And I think the curator model, like put it in another way, is the free market approach. Like, well, basically the two models is like really free market versus central planning, and curator model is just about like living underwriting to the free market.
Amazing, guys. Guys, give it up for your panelists, please. Thank you so much.
Thank you. Thank you. Please give us some
Thank
time
you.
to set the stage for the next session. Okay, our next session will be starting in a minute. The topic will be on-chain money market funds versus DeFi vaults competing for the base rate. We have our moderator, Redwan, from the Enterprise Ethereum Alliance. And please welcome our speakers, Raphael from Franklin Templeton, Merlin from Morpho. We have Paul from Spico and Lancelot from Highly.
Hello. I think that's a very French panel. There's some French name and less French name, but I think there's going to be a lot of French accent today, right? Right? It is? It is? I think everyone is... Tout le monde est français, vous êtes tous français, les gars, c'est ça, hein? Yeah, no, we're not going to do it in French. Imagine that. Okay. Well, thank you very much. Very excited to be here with you guys. So we're going to talk about, like where does the yield come from? So we have a financial institution. We have one of the best players in Europe, like Spico. Is it Spico or Spico? How do we say it? Okay, okay. We have Morpho. Also, I'm not sure how to say, like, Highly? Highly. Okay, okay, perfect. And so I guess I'm going to start maybe, like, I think everyone knows the company here that are around the table. But I will probably first, we have 40 minutes, so we're going to have like some time to discuss. I'm going to talk a little bit, but actually I want you to engage and to discuss between each other, because I think that's what can be interesting for the audience. But let's go straight into it. There is some debate about like, should now, when you put like some asset on chain, should it be like just the yield of the T-bill of other financial instruments, or should it be something that we build around that? And I think you have all like different perspective on that. And I would love if you could start by just giving it straight on how you think it should be done. And then we'll start from here. And I hope you're not going to agree with each other and be very French so we can have an exciting panel. Raphael, do you want to start?
Yeah, let's go. Thanks. Well, the yield curve, it's a currency thing. So if you are denominated in USD, you're expecting like at least that the risk rate should be T-bills, treasuries, and repo. Then the question is, when this is on chain, will there be a risk premium on that? Well, if it's well tokenized, if the token is actually the asset, if the token is, for example, the money market fund, then there should not be any risk premium on that. I think the blockchain just make it much more efficient. So now this simple, let's say, yield that you have is much more efficient. You can reuse it, reallocate it, use it as collateral. So potentially on those structure, on top of it, on those repo structure, potentially the yield could be lower than on traditional markets, because there is a lot of inefficiencies and a lot of intermediaries that you don't have on blockchain.
And I guess for you, Franklin, like the Benji, the actual token is the registry. You don't have something on chain. So what we have on chain is the registry, right?
Yes, indeed. So the shareholder registry is on-chain. So when you hold the token is the share of the funds, which means that when the token moves, the legal ownership moves with it instantly.
Okay.
Yeah.
Which is the same with, I think, with Spyco, right?
Yes,
Okay.
correct.
Okay. Maybe you want to jump in next?
Yeah, happy to. So at Spyco, we launched the first ever approved UCITS money market funds on chain in mid-2024. Since then, we've launched new products together with Amundi very recently. And to dig into the topic a bit more, maybe there is indeed the world of on-chain MMF. So this is just bringing on-chain the risk-free rate of traditional finance. And then there are the DeFi vaults. And DeFi vaults grew with crypto-backed loans, as you guys know very well. And there is indeed, I think, a yield curve derived from these crypto-backed loans, which is right now different from the yield curve of traditional finance. I think the two will probably not converge. There will always be a specific yield curve for crypto-backed loans, and this is something that DeFi has built, which is very interesting. But now, definitely, we see more and more RWAs, so tokenized T-bills, but also other strategies coming on chain and entering vaults and bringing new source of yields effectively to these markets.
Well, I guess for you, I'm curious, like how you approach this at Morpho.
Okay, great. So maybe I can talk a little bit about the Morpho's design and how we built the current protocol. You have isolated markets where you can set a collateral asset and a loan asset. And each market has its own interest rate model and it's actually its own rate. And why we did that is because we think that for each type of collateral, each type of credit worthiness, then there will be an associated rate. And you can't really merge those rates together and have for high risk collateral you should have higher rate, and for low risk collateral you have lower rate. And Morpho is providing that infrastructure where anyone can build a broad product or land product on top and select the asset they want exposure to, and then you'll have a given rate that reflects the risk that you're taking. So sometimes you'll get the risk-free rate because maybe you're borrowing against T-bills, or you're converging maybe toward that risk-free rate because the collateral asset you're borrowing against are considered as almost risk-free, and some the risk is a spectrum. So you have that low risk, and if you go higher on the risk spectrum, you'll find higher risk collaterals I don't know, Pepe, but also private credit fund that have been tokenized and put on chain and with higher yield 8%, and people will be willing to borrow at a higher rate than against T-bill as collateral. So everything to say that we're providing that infrastructure, and what we're going to see is that a numerous type of product and risk tier, and then rate tier, and we'll see that evolve thanks to the market fluctuations.
Yeah, and so on our end, on Highly, we're doing more settlement and privacy infrastructure to make DeFi projects compliant in the eyes of regulators and bringing fintech on-chain. And I've always thought it was curious that we have to ask on-chain where the yield comes from, because you'd expect that everything is transparent and on-chain, and so we know where the yield comes from, and it doesn't. And the reason for that is that most of the stuff actually happens off-chain. And what I think I'm interested in is the future of this whole industry is seeing more and more stuff actually happen on-chain. I think it's kind of unfortunate that both Franklin Templeton and Spyco are actually representing the ledgers on-chain, because that's a good direction to move in, and very few people are actually doing that. The problem here is that, well, you can see what the positions are on chain. There's no privacy at this type of protocol. And so if you're trying to actually do lending, do leverage, this kind of thing, it can become complicated from a risk perspective, or from a privacy, or from a strategy privacy perspective. And I think this is where we get into that missing piece of privacy for financial infrastructure that people keep talking about. If you want things to be actually happening on chain and have short-term loans fully on chain and things like that, you're going to need this type of technology, and we'll know where the yield comes from. We won't know who is getting it.
Okay, so infrastructure, both Morpho and Highly one on privacy, one on actually offering the Sunny. You kind of sell services almost like not directly to Spyco or Franklin, but offering them to say, hey, you can bring some product on chain, you can access to that global market. And I guess I love what you mentioned about privacy because it's a topic that I see often coming back. And I'm curious to know like how actually like you approach that when you deploy some new product on chain, and if it's and how like what's the constraint that you see for privacy like in what you want to achieve to gain more users.
Yeah, I just wanted to say something that we're always used to floating rates in DeFi, and fixed rate I think will be something really interesting to see, and will build a whole lot of new use cases that we're not used to use around in DeFi. Around privacy, obviously it's important. Blockchain at the moment, at least Franklin Templeton has built always on public chains, and there is a lot of transparency, but indeed institutions, hedge funds, treasurers, they don't want you to know what they're doing with their money. So that's why, for example, we're building on Canton, but like all the blockchain, Ethereum also is looking actively to a roadmap to integrate privacy. So I think that at one point we'll not talk anymore about privacy because it will be embedded in systems, either directly on the chain or maybe on the protocol. But obviously, like no funds allocator, no treasurers wants all this information to just be available to the market at any point of time.
On privacy, I must say, I think it matters a bit more when it comes to payments than financial markets, although that's debatable, but that's my view. To this point, we have several thousands of users. It's a mix of corporates, institutions, retail, so quite a diverse set of users. And privacy has been, transparency, sorry, has been more like a feature than a bug from our perspective. Bringing like real-time transparency on the shareholder register of a fund is actually quite valuable. When you are a CFO, you want to know how many investors use the money market funds you want to allocate treasury to. What is the investor concentration? So what is the largest position in the fund, et cetera, et cetera. And when we show this information to CFOs, including from traditional finance world, right? Some of them have nothing to do with the crypto industry. They find this super interesting, actually. Because they are used to the world of traditional finance where non-tokenized MMF are a bit black boxy, I must say. Now it's clear that when it comes to payments, when it comes to collateral management, privacy will matter for sure. And I'm pretty bullish on the different infrastructure and technologies that are being developed in the space. But up to now, it hasn't been much of an issue for us, although I'm pretty convinced that it will become at some point.
Yeah, I have something on that because I think it was 2 talks ago. You know, people have privacy. The curators on Morpho have privacy because we don't exactly know what their strategies are, and you know, people are sometimes talking about this as a problem because you don't exactly know where the yield comes from. And so there's like privacy as a fully on-chain thing where you can see what things are happening. I mean, I'm not saying it's all of it, of course. And then there's like this other, the other interest of this technology that we use to do privacy on-chain, which are zero-knowledge proofs, is that you can prove that what you're doing is actually what you claim to be doing. And so I'm quite interested not only like privacy as anonymity, but also like being able to prove that you're using the algorithms that you claim to prove, being potentially able to prove your funds through selective disclosure, being able to prove the provenance of your funds without having to reveal it. There's been, it's not in like DeFi, but Google just did something really interesting 2 days ago. They released a paper on like quantum improvement, change an algorithm thingy. I don't understand it. They used the ZK proof that the algorithm exists instead of showing the algorithm, because for them it was like essentially critical to the infrastructure of the world to like, you know. So this type of privacy for your strategies, for this type of thing, for curators potentially is quite good because it improves transparency, which is great, both from like a regulatory perspective and just a user perspective, but it gives you still what you want so far.
Just one thing I want to clarify at the Morpho Vault level. Actually, the strategy that the curator put in place, that the caps, relative or absolute, are actually on chain. So you can see on chain and verify, and this is what you were saying. This is actually a feature and not a bug. to have that clarity on what is the strategy that is being run by the curator. And as a user, as a depositor, I can see on chain, check that I'm comfortable with that strategy. And then there's an allocator role that can actually reallocate the fund at any point in time, but it will play around within those bounds that have been set by the curator. And that won't change unless it goes through a time lock. So that gives like trust and what you're, where you're parking your money. So I just wanted to say that. Second, on privacy, what we're seeing is when we are talking about with very large partners, asset managers, etc., the first question is not really privacy, it's actually how do we build that product? It's the first question. It's how do we jump on chain, because we have tokenized assets. Yeah, now it's super easy to tokenize assets. It's like bookkeeping, accounting. You go to a third party or you can do that in-house. It's pretty simple. But then what? Like, what do you do with that asset? How do you make it productive? And that's a good question that this is the first question that they are asking. And we are taking a lot of time to educate, onboard them, understand what are the tech, legal, business requirements, and come up with what's the right solution to put that at work. And then after you can figure it out, okay, now we need privacy, we need insurance, and we need a better tax reporting systems, etc. But that you can figure it out once you have understood like what is the type of product that you really need and how to build it.
One important point about asset management allocation, and I think that's why asset management is so highly regulated. Like, you don't want to invest in the money market funds and the day after it starts investing in equities or something else. And for a long time in DeFi, when there were no boundaries, you can invest in a vault where it seems risk-free, low risk, and at that point, at one moment, a new asset is added or a new strategy, and then this vault risk-free is becoming high-yield vaults. And I think that's why it's important to have programmability, but also to put boundaries on each strategy. And I think that's where asset management and DeFi, also DeFi allocators, creators, are becoming to be really institutionalized, because it's not just about having the tech infrastructure, but they're also managing risk much better and managing mandates, because at the end, that's what it is. It's a mandate. You've got a mandate to invest in risk-free allocation or low-risk allocation, and you don't expect it to be highly volatile or to be exposed to high yield.
I love what you just said about risk mitigation and also having some productive assets. We've seen like for a long time, as you said, Marlin, like they're tokenizing something is not technically complicated. You get your class, you extend, you do like a lot of, but how you get those assets once they're on chain, like actually doing something. And that brings me like, where do you think actually like the adoption of all those, new, I would say, financial product that we put on chain can be driven? What do you think are the main driver of adoption? So we have actually, assets, because we can have like some beautiful headlines, tokenize 20 billion or whatever. You can tokenize way more, frankly. This is really like a drop in the bucket. Same for Apollo, but I guess the question is like, what actually makes after, like those assets, like being alive on chain? I'm curious to have your perspective of all.
So quickly is just crypto backed loans are very sensitive to the market. So once the market is bearish, like at the moment, yield tends to compress, and then there's kind of a flight to, if you want to increment of few bips, then you need to take a lot more risk on that risk spectrum. And if you bring reward asset, actually you can like provide like better rates even in bearish period. And this is what I think we're seeing, is that 2 years ago there was clearly no PMF on reward asset as collateral because the yield in DeFi was quite great. You could have like 5-6% without taking much risk. Now if you want the same rate, you'll need to go way higher in terms of the risk that you're taking. But with reward asset, you can stay quite in the same range of risk that you're taking, and maybe target that kind of rate as lender. And this is offering a new opportunity for investors to park their liquidity, and within like a year or something like that. Now there is 850 mil of total deposits on Morpho against reward asset. And there's like credit fund, money market fund, blah, blah, blah. And all those markets are actually yielding more than classic crypto-backed loans. So I think this is what is actually like incentivizing liquidity to move from crypto-backed loan to those markets.
Yeah, maybe a few points on that. I would argue that tokenization is indeed pretty easy because it's like open source standards. Anyone can access this, and there are many proof of concepts and now tokenized assets in production. But that being said, and we are seeing that on a day-to-day basis increasingly as we grow, managing the shareholder register of a fund and several funds on chain across several networks at scale is not that simple. You don't have that many issuers of either tokenized money or tokenized securities that operate at a very, very significant scale and really understand the technical challenges of that. You have the largest stablecoin issuers, Circle, Tether, clearly in that category. In the tokenized security space, I think it's a very, very limited number of players who have this infrastructure at scale with all this, all what it implies. What if like a blockchain stops working? How do you operate the fund? Because you have a legal duty to manage your subscriptions and redemptions on a daily basis with a money market fund, for instance. And building that infrastructure is not that simple. We at Spiko, we consider that we've reached a scale that is rather significant. We managed hundreds, sometimes thousands of subscriptions, redemptions on a daily basis. But this can scale a lot more as we grow and onboard like thousands and thousands of users. And it's not that easy to do. Now, when it comes to the use cases, I think one very simple use case is access. You have many jurisdictions. I'm not talking about the US, but I'm talking about other jurisdictions, including Europe, where opening a securities account and accessing securities is not very simple. And what we've built at Spiko, first and foremost, is a much better infrastructure to access money market funds than what you can find out there in Europe. If you have to go to your bank, open a securities account, manage your subscription, redemptions order, the UX is really bad, actually. And we've built that in a much better way. Now, when you have that, you think about the use cases that you unlock with tokenization. And one of them is the transferability of the fund shares. And with the transferability of fund shares come a lot of things. I'll give you one example that we have with our clients. When you are an organization, a corporate structure, for instance, across several jurisdictions, and you have to manage cash, move that cash across borders, it is a pain point with the existing infrastructure. With tokenized money market fund shares, which are a cash equivalence, effectively, you can do that 24/7 without any restriction in terms of size, in terms of jurisdiction, provided that the jurisdiction is compliant, right, and can be onboarded in the shareholder register of a fund. And then you have all the things that you can do with automated infrastructure like Morpho when it comes to direct access to repo markets, right, on-chain, access to cash, to refinance your position, everything. So that is like step 2 for me. We are already into that, having like real customers using these features. But I like to remember that even like the access part of the equation is interesting in and of itself. It's sometimes hard to grasp, especially from the US, where the capital markets are really developed, really efficient. But even in Europe, they are not as efficient as they are across the Atlantic.
Yeah, and I'm going to talk about step 3, I guess, which is that, sure, for now you get very good access on-chain, but not everybody has access to it because for compliance reasons, you need to know who you're trading with, essentially. And I'm going to talk about ZK again because I'm going to talk about ZK every time. I think there's interesting things to do about with ZK here, where you can prove that you are actually like a financially accredited investor. This wallet belongs to me, but you don't need to know about that. And so you keep the instant composability because of like very fast settlement on chain versus traditional financial infrastructure, which gives you like high velocity of money, these type of things. We don't have that right now, but you can get that if on chain you manage to get either the full chain, which I don't think is very realistic, or like areas where people are open with the regulators, but not with the rest of the infrastructure. So you can trade at the speed of the blockchain, but you don't need to prove every time, make your transaction time locked, something like that. And I think that like the fourth step in that way would be not the ease of acceding to financial products, but potentially the ease of creating new financial products. We have some startups in France around refactoring, things like that. If you have indeed an invoice and you want to be paid, right now you have to go to somebody doing this kind of thing. Potentially in the future, it would be, if it's possible in the future to go directly on chain and tokenize this yourself and proving your funds, proving some information about the asset, and then the asset gets automatically classified, you know, in a vault as some type of asset or something like that, in a tranche. Then you get instant liquidity and you don't even need to know who your counterparty is because everything is secured, everything is automated, like this is the real power of composability. If we can get there, like this is pretty far away in the future at this point, but I think it would be, like it needs more work on the infrastructure side, which is, and it needs privacy because obviously you don't necessarily want to show your competitors that you're currently selling 5,000 GPUs or something. But like, these are very interesting type of questions for the future.
And blockchain is so efficient that you can always go deeper and improve the product. So when we built this money market fund fully on chain and we had the shoulder registry on chain, okay, you can move it 24/7, that's good, but then the next question was, if you can move this asset that is yield bearing 24/7, well, the yield also should be accrued 24/7, because you want to be able to receive the money market fund on your wallet, keep it for 1 hour, and then send it to someone else to settle a trade or make a payment, and you want to receive this hour worth of yields. And the thing is that blockchain and the data management on chain is so easy that now you can basically accrue the yields block by block. So when we built the money market fund, and now it's available across 10 or 11 blockchain, this money market fund not only moves 24/7, wallet by wallet near instance, but it also accrues the yields by the block in a way that even if you hold the asset few minutes, few hours during the day, you're sure that you will receive this part of yields. And that's what makes it so efficient, so good. And I'm pretty sure that as the time goes, and also as those assets are possibly and can be made available on DeFi and on new, let's say, protocols, we will see much more advantage and improvement on that.
I have a question for you again, Raphael, because you know around the panel, like you represent like the organization that have like couple of billions dollars of asset that you could also still put on chain. And I'm curious, you know, from your perspective, what do you think is like the next step that's going to really make organization like Franklin and to really be able to unlock like more, like, you know, more assets on chain? And what are like the current blockers, and what do you think, like, for instance, like the people all around the panel like could contribute to that?
A lot of that is regarding integration. So our first customer were fintechs, small companies. Then we had a lot of inbound from market makers, hedge funds for use as collateral. So they trade on exchanges with collateral off exchange that earns yields. And at that point, the idea is not just to bring the products on chain and let's say, bring the liquidity that is already on chain. The idea is take all those trillions that are on traditional finance, and because the product is better, make them move with an asset on chain. And the thing is that they're not ready. So they have to onboard the wallet, they have to integrate it, and also they have a lot of legacy operation and legacy system that are all built on top of each other and that are all interconnected. So when you want to make them move on chain, they don't want to use a separate, a new protocol or a new infrastructure, a new web platform. They would like to have it inside their own systems. But we're there. I think we've built the building blocks. We have the product. We have DeFi protocols that make it easy to settle. And now what we miss is a bit of UI UX and also much better integration with legacy system.
Maybe to add a little bit on that, our strategy at Morpho is we're a B2B2C kind of project, and what we're doing is that we're going to all wallet providers, and they're integrating earn and borrow product natively. So I'm speaking about Dynamic, Privy, Turnkey, the Fireblocks of the world, because they're like you, Franklin Templeton, and all other asset managers are already client of those type of wallets, like some custodial, some non-custodial, and if we allow them to just like clicking on a button and having access to earn and borrow products so that they can offer that to their customers in just one click out of the box without having to build them that ourselves, this is the best path to put all that liquidity on chain. So we are doing a lot of work on that front, and we are going to have like many announcements to come on that. But this is the groundwork that we should do as DeFi protocol, so that we ease the path as much as possible and make the best. We provide the best experience to institutions.
I mean, I very much share what you guys said. At Spyco, we have pretty much the same strategy as what you described, Raphael. Going to like fintechs, small companies, small institutions that have more ability to move fast. And now, as we grow and start having increasingly larger customers, we see the need, as you said, for like these integrations with the legacy systems, but also like the SaaS, you know, the software basically that they use to manage their treasury, the treasury management systems, et cetera, et cetera. As these integrations, you know, are put in place, I expect to see a lot more adoption as well, because that's typically we have to embed into the CFO stack basically across companies.
Yeah, I realize I forgot to speak in a French accent. Very sorry. I lost my train of thought doing that dumb joke. No, what I wanted to add was also, yeah, ZK, sorry. No, actually for once I'm not going to talk about ZK. There's a pretty simple fact, which is that if it's, you know, if it makes them money, people will go to some level of pain to unlock it. And like the simple equation that we haven't seen however many trillions of dollars be tokenized on chain yet is that the cost of the technological upgrade is too big for now for the yield that would unlock probably. There's like a time component and the market efficiencies as well, but that's also a thing. I think there's also a question of not everything is on chain yet. Yields are moving pretty fast, but Hyperliquid just barely, pretty recently upgraded to portfolio margining, this type of thing. So if you're doing trading on chain, that's when you get comparable efficiency to actual exchanges off chain. So for trading this type of assets, we're tokenizing real world stuff. We want to trade them, not just get yield on them sometimes. But the infrastructure wasn't necessarily there. There's not so much for options on chain right now, as far as I understand it. Derivatives are we have perps, we don't have everything else. So there's some things missing so that the whole of the financial infrastructure potentially moves on chain as its financial rails. And if you look at the regulatory aspect on that side is moving a bit slower as well. I know the European Union context better, but the European regulation around settlement, delivery, clearing, and this type of thing is kind of unclear right now. We don't know exactly what that's going to mean from a blockchain perspective, and that probably slows things down a little bit as well.
Yeah, and I want to mention what you said, that there's no fixed rate market at the moment in DeFi. And we think also it's a blocker for bringing in more institutions on chain. This is exactly why we are releasing Morpho TBA. And it would be a fixed rate based lending protocol. And the reason why is just institution, if they want to do tax reporting, accounting, plan in advance, you can't really have a variable rate. The primitive in the legacy financial system is a fixed rate, and DeFi has been built the other way around, just because it made sense at the very beginning of DeFi, because the gas was expensive. Building fixed rates required much more sophisticated users and entities in the space, and now we have all those players. Hello? Oh yeah, okay. that can actually make that possible, and each version of the Morpho protocol will try to time what was the maturity of the market. So the first version was really simple, same experience as overlanding pools. Second protocol was externalizing the risk management, so what we can scale to many other assets and many different products. And the third version will be externalize the price discovery, the rate discovery, and with fixed rate, and the people own the capacity to quote, make offers, and other people to take offers, and have that really TradFi-like experience around credit. And so we think that this will unlock a lot more potential, so that we can not only borrow against crypto assets, but against receivable, maybe like secured by ZK, but also like reward assets, whatever that can be tokenized, even credit score.
I think we have 5 minutes left. Do we have time, like maybe some question? Some people from the audience that want to jump in? I have more questions for those guys. I can keep like asking, but I want to give an opportunity if anyone want to add anything in the audience. 1, 2, 3, 4. Okay, who is gonna win the World Cup? What's the question? France, of course. But otherwise, now I guess one thing I've heard you saying, and also for you, Lancelot, Succinct also was the one quoted, and Justin Drake from the Ethereum Foundation included that paper that was released like 2 days ago, saying like actually the time for quantum computing to crack like the I think Bitcoin elliptic curve is going to be faster than expected, 2029. I think that's what they said. But you mentioned something about like, you know, compliance and having the whole tech stack, and I think it's super interesting and very, very exciting to see like a DeFi panel like this one talking about this, and being more, you know, engaged in how actually we can bridge the two. Because I think the TradFi, you know, you said $200 trillion of loan. I think there is $600 trillion of asset, 123 trillions of cash, M1 and 2. DeFi is a drop in the bucket, you know, I think 300 billion of stablecoin. The whole like DeFi market is maybe 140, something like that, last time I checked. And so bringing like really like the DeFi innovation to the DeFi, it's gonna go through, you know, also compliance. Compliance is not a constraint, it can be also like a source of innovation. And I was talking to a stablecoin issuer recently, and someone that worked like Tony from Ubex, 20 years in Citibank, or actually maybe more than that, but I don't want to make him older than he wants. But and he said like actually the entrance for, you know, adoption is the wallet, and so exactly what you were saying, because we need to provide that infrastructure to abstract the complexity of our ecosystem, and I do think in effect that's what I hear also like left and right, that, you know, like the wallet is going to be also like a key part. I know you've been building your own app. You have your own app. You're also running your own infrastructure. I think Franklin is one of those rare like big asset manager. Like really, like you have like your hands under the hood, and I always like appreciate that. I'm curious if you're also, you know, maybe for you at Spyco, an infrastructure level, are you also like looking at that from like the whole stack, at how you can facilitate, you know, like abstracting, working with some maybe wallet provider, but also like for some of the clients to integrate that.
Yeah, I mean, totally. At Spyco, we work with like traditional issuers and traditional distributors mostly. What I mean by that is that like traditional issuers are asset managers, tomorrow governments, corporates. They want to issue their financial instruments, bonds, equities, whatever, and they need to pick the best infrastructure to do that. So we need to build that infrastructure. That's what we are doing. And then distributors want to plug into the best infrastructure via API, anything. So that's what we are doing. We work with like traditional asset managers like Amundi, traditional distributors, I would say, like, you know, fintechs providing payment accounts for businesses, wealth management platforms. Some of them have nothing to do with the crypto industry, but they value our infrastructure because it's linear than the traditional one. And because it abstracts, as you said, the complexity of the blockchain, the wallet, the network, etc. It lives there, of course, it is there, but we make it very, very simple, including via our API, so that if you don't understand anything to the crypto networks, you can, you know, use them as any other database, basically.
Yeah, I'll drop one final buzzword. The problem is that most of the banking authentication infrastructure was built for humans. And to a certain extent, it's true that blockchain stuff looks more like the things we need to build for AI agents anyway. We're going to need passwords. We're going to need IT first, authentication systems, and that's just what wallets are at the end of the day. So some of that complexity might get a boost from the fact that these digital AI agent, commerce, whatever thingies will be adopted more.
I think we have 30 seconds. Do you want to just drop something we should follow and know about you for the next couple of months? A little bit plug before we let the stage.
Morpho, universal credit layer. I have 10 seconds.
Waiting for the fixed markets.
Go on. So Highly is the privacy layer, making DeFi projects compliant for regulators and bringing fintech on chain.
Well, for example, Templeton, we are a traditional asset manager, but we decided to build everything in-house from the node operation across 10 blockchain, the wallets, the tokenization infrastructure, and obviously our core business is managing assets, and that's what we want to do, but we want to do it better and improve just the solution that we provide to investors.
And I had something also about Franklin, because I've had the chance to see the whole team, and I've been really, for the DeFi crowd and more Ethereum-centric here, you've always been a voice of accessibility to a financial market, and I've been really impressed by how really this is from you to Mike Reed and Sandy in your leadership, always saying, hey, we're building that so we can make this accessible, and I think that's also a value that is shared by everyone around the table, and I'm really excited about what the future is going to entail. I think we're up for time. Parvina, thank you very much.
Thank you, Redwan and our panelists. Please give us some time as we set the stage for the next session.
Il était juste éteint. Merci.
Okay, next. We have Ethan from Upshift, who will be speaking on Earn 2.0, what BlockFi got right, what Vaults fixed, and what's still missing. Welcome Ethan on stage, everyone.
Hey, testing, 1, 2. Perfect. Amazing. So, hey everyone, I lead growth at Upshift. For those that don't know, Upshift is building multi-strategy, multi-protocol, non-custodial vault infrastructure. We tailor mainly to neobanks and retail distributors like exchanges and wallets, but we also have an institutional side because our sister company is a prime brokerage. So the interesting thing about Upshift is that we actually take a lot of that prime brokerage mechanism and bring it over to Vaults. So today, as you see here, we'll talk about what BlockFi got right, what Vaults look like today, and where we're going next. So hopefully you guys actually recognize this chart here. This is the rise and fall of BlockFi, which is obviously one of the biggest exchanges around the start of 2020, 2021, 2022. You can see they reached a peak of 15 billion TVL in the Earn product, which is, if you compare to the TVL of DeFi protocols today, the third largest DeFi protocol behind Aave and Lido. Yeah, super huge. One product, you deposit your crypto and you earn, I think it was 7%, maybe more. Is the fastest growing product, or one of the fastest growing products in crypto history. Now, what did they get right? Well, three things. One, simplicity. It was very easy to click and deposit and start generating that 7% yield. Two, it was very abstracted. Users didn't need to know what was Aave, what was Morpho, what was from Euler, what was from Uniswap. They just started earning yield. And lastly, it was curated, which is obviously a big trend these days, but back in the day, this was also a key innovation of BlockFi, is that somebody else was deciding what strategies the vault deployed into, and you could decide whether you wanted to earn from that. But we know how the story ended. This number here is approximately how much was lost across BlockFi, Celsius, Voyager, and Gemini Earn as well. All of it from the same underlying issues. One, they were custodial. Two, they were opaque. And three, there was a lot of re-hypothecation, something we spoke about on the risk panel earlier today. Demand was obviously super clear, but the infrastructure was not ready. And this is a number that you should remember, because on the next slide, you'll see an even bigger number, which is the total assets under management across yield products in TradFi today. So this could be bonds, this could be wealth management, asset management, and so on. The stakes are much higher this time. When BlockFi launched, crypto and DeFi was still a niche industry, a niche get-rich-quick scheme. Now we have a couple 100 million flown into IBIT every single day, the Bitcoin ETF from BlackRock, and we have Larry Fink openly shilling tokenized assets on CNBC. And so the opportunity for on-chain earn is huge, as you saw with the rapid growth of BlockFi, but the risk and potential losses is even bigger today. So what does today look like? This is a very simple diagram that explains how the space is moving. You'll see that primarily the vaults today are single strategy. So you have lending and LPing. Obviously, if you're more DeFi native, which I assume some of you are, you will also begin to see there are plenty of discretionary multi-strategy vaults too. But the vaults that most of retail interact with on, say, Coinbase, they would be single strategy, very conservative lending. Two, they are a lot more transparent. You'll be able to see where the strategy allocates, what exact markets are deployed to on Morpho, which you definitely did not see with BlockFi. And finally, but probably most importantly and the biggest change, is that these vaults are, generally speaking, non-custodial, which means that you can withdraw at any time. The vault curator and the vault infrastructure do not custody your assets. And this is a very important distinction between what we have today and what we had with BlockFi. Now, at Upshift, we believe vaults can do a lot more, especially if we were to bring institutional adoption into the space. One, we're going to see a lot more on the RWA side. So these might be deposit tokens from JP Morgan. These might be private credit, which I've spoken to a lot of teams in Cannes about this week. It might be PayFi as well. On the credit side, there's much more to be explored on the under-collateralized and uncollateralized areas. And obviously, much of lending on DeFi today is over-collateralized. Compressing the back and middle office and bringing that on-chain. Today, you have the smart contract, which essentially functions as a transfer agent, and you have the curator, and you have the vault infrastructure, which are usually one and the same. And this is obviously a big no-no in TradFi, where the fund admin and the fund manager can definitely not be the same entity. And so we believe vaults have a long way to go in this area. And finally, as I mentioned today, vaults today are primarily lending or single strategy. And at Upshift, we're building towards a much more custom, flexible model across DeFi and CeFi, multiple chains, multiple protocols at the same time. So what's still missing? Let's dive deeper. Firstly, something that was mentioned on the risk panel today, who is curating the curators, right? You'll see here a screenshot, which is of L2 Beat. That's because there is no equivalent for vaults or curators today, which there 100% should be.
Yeah, vaults are transparent in theory. I mean, even at Upshift, we show all of the positions in real time on our front end, but it would be amazing if we had a product like L2Beat, which compared Upshift vaults with other vault providers, and also curators with other curators as well. And yeah, this remains an unsolved problem. Secondly, redemptions. It's super easy to deposit into a vault at one click, but redemptions are still time-locked, often with a lot of queues, and users have to wait, which is not a great experience. At Upshift, we're working with PayFi companies, we're working with exchanges to build atomic redemption layers and also credit facilities where users can spend and earn yield up to the point of their transaction. And either they can borrow against their position or they can atomically redeem at the point of transaction. And so that's a core innovation which we think will proliferate across vaults, and especially as they embed more into other front ends. And then finally, which I began to allude to, distribution. So 90% of users today are definitely not in DeFi. Most of them are coming on chain through exchanges. More and more are coming on chain through neobanks and the stablecoin crypto cards. And this is where vaults have to go if they're to expand to the next era of crypto users. In fact, most of these users are definitely not DeFi native. So this also begs the question, how are they going to be able to underwrite the risk on these DeFi apps if they don't even use these products day to day? There needs to be a much more effective way to communicate this risk to this type of user. And so today at Upshift, we have the Upshift SDK, which lets third-party apps like Tria, which we work with, a global neobank, to very easily integrate our vaults. But despite all this, vaults are obviously working very well. I mean, these are some of the metrics. You see 28x vault TVL from summer 24 to summer 25, and now we're in Q2 of 2026. So you see that a lot of vaults, a lot of TVL are coming into vaults at a rapid pace. Last year alone, we launched in April, and we subsequently launched 40 vaults at Upshift across 30 plus chains. And a last one I added there was RWA growth, which is not really vault related, but at the same time it is, because again, a lot of these vaults are going to be RWA related, and I'm sure we're going to see a lot of private credit vaults come live as well in the next year or two. And so just want to go back to this number, which we saw earlier, 120 trillion in asset management today, earning yield in TradFi. A lot of this is coming on-chain through vaults, and that's why we're building Upshift. Thank you very much.
Thank you, Ethan. Next, we have a panel which will be moderated by Simon from Gauntlet, with our speakers Thibault from Maven 11, Wezo from CAP, and Anlin from Gauntlet on the topic of making credit yield composable on chain. Welcome our speakers on stage, everyone.
Hi everyone. Ooh, this is loud. Sorry, I apologize. I'm super excited to be at Vault Summit. I think it combines three of my favorite things. First of all, working with great partner like Party Action People and Morpho, being in Cannes, although beware of the seagulls, they're feral. And then amazing panelists here that we have. So I'm very excited to host this awesome panel on making credit yield composable on-chain. I'd love to do like a little bit of a round of intro. I'll start with Simon. I work at Gauntlet and partnerships, starting with Thibault, kind of like a little bit about what you do and what M11, CAP, and Gauntlet does.
All right. Well, thanks a lot for inviting me, Simon. So I'm Thibault, working at Maven 11. I'm mainly focused on the credit side of the business, so we're known to be a VC fund for like the past 10 years, but as we went through the space, we expanded the business and went for more credit opportunities. So I'm adding the DeFi credit space and everything we do with the M11 credit entity, risk underwriting, capital connection mainly. And we also have now a yield fund, so credit fund as well, which is just going for the market neutral exposure in the space. And yeah, that's it.
I'm Wesso. I'm the CTO and founding member of CAP. CAP is a insured private credit system that utilizes 3 parties. One is the liquidity provider who mints our CUSD stablecoin. Second is the unsecured credit partner who is borrowing from the system. And then third would be the underwriter who is taking on the collateralization of the loan. And that's what CAP is.
Hi, I'm Ann Lin. I'm a senior protocol strategist at Gauntlet. I do a program manager role running our ERA strategies and also earn integration with different partners. Gauntlet, we manage over 1.3 billion in TVL across our vaults on lending platforms and ERA. Yeah, super excited to be here.
Thanks all. So credit yield kind of set the context. Historically, it's kind of been a static, like hold to maturity game, but really this new stack of strategies and products and infra is really emerging where private credit is tokenized, basically made composable on chain. And RWAs have grown a lot. There are over 35 billion total RWAs right now. And private credit is more than half of this at 19 billion. But when we look at active RWA assets in DeFi, it's only 2 billion. So it's still growing a lot. But it's still very early. Thibaut, I was wondering if you could kind of from the perspective of M11, an institutional allocator, they can access private credit off chain. They can access through Apollo, Blackstone, a lot of different providers. What is actually driving the on-chain growth of credit yield?
Yeah, well, credit yield, thanks for precising the tokenized credit part, out of the private credit opportunities. Because if we talk about RWAs, there's a lot there, especially these tokenized money market funds and so on that represent the most of the volume and so on. So I think for us as an allocator, if I talk from an allocation point of view, there's all these fundamentals from, the crypto days and just less... I have to say more transparency, better, execution and efficiency in the access of these assets. And yeah, you trust less the counterparty, but more what you can audit as a fund specialized in crypto, And then from there, we just also go for the more sophisticated strategies. And that's, in the title of this panel, I think the composability of it. That's literally why we go for these on-chain exposure. So I do think that for the tokenized, very specific private credit space, their composability thing is very important, and that's where the growth of the volume and the utilization on-chain is definitely defined right now, I think. But if we talk about, for example, the tokenized money market fund, I don't think that the leverage strategy or the composability is right now what makes it that interesting. I think it's a lot more on the operational efficiency, transparency, and maybe for some, other RWAs, like more niche ones or tokenized credit ones, capital access, even if for now this is infinitesimal for most industries. So yeah, there's a lot there, but yeah, distribution first, I think.
Thanks a lot, Thibaut. Wesso, I remember when I first started reading docs about CAP, I got really deep into the rabbit hole. I think it's fascinating the way that it works. And recently, I was obviously brushing up on it because of this panel. And in one of your latest article, CAP is described as like a covered credit platform. And there's a lot of moving parts, right? There's CUSD, staked CUSD, there's the credit engine operators, delegators, the financial guarantee market. Can you break down a little bit how it works and why you describe it as this covered credit platform?
Yeah, so I think one of the problems with stablecoins and what we've seen, I think, recently is a lot of them blow up because the decision making's on a team.
So you give them liquidity, USDC, whatever stablecoin, they mint their stablecoin, and then they go and do some sort of proprietary strategy, whether it's lending it out, running some sort of like high frequency trading, doing a basis play. But then you're trusting this team. You're basically saying, hey, I'm going to give you this. I'm not insured against that. And if you guys blow up, then I'm out of luck, in which we've seen that happen. There's also like a lack of transparency with some of these. And so we wanted to build something a little bit different, something that's going to protect the liquidity side. So it's like, hey, you give USDC, but we can make that insured. So we could still have access to a lot of these strategies, which creates quite large scalability because we're not isolated to one specific strategy, right? So it's not just like we're doing the basis trade. If you wanted to borrow from us and do that, you could. But we're not isolating and doing that specifically. So what we could do is we can offer essentially this liquidity bucket where people can come and take unsecured loans, and then they can go and use it for whatever they want, right? Institutions, we've seen payment financing, inventory financing, people running trading strategies, people using it for LBOs. Like, so there's all of these opportunities now for you to use unsecured lending. We don't really care how you use it, but we have liquidity for it. So now how do we protect the people who are putting the liquidity into the CUSD token? So we just create an over-collateralized market. Essentially taking underwriters, people who have some sort of collateral with low risk premium, and then they guarantee the loans of the unsecured credit lines. So now we're mostly just like a matchmaking solution where we're saying, hey, we have this party, wants to borrow $10 million, use it for whatever service or whatever they're trying to do with the funds. We have somebody who has Bitcoin, and they're okay getting 2%, 3% on their Bitcoin. They're underwriting that loan, over-collateralizing that loan. And so now, let's say there's a default, the loan has to get liquidated. We're actually going to liquidate the collateral, pay back the loan, doesn't hurt the USDC depositor. So that's what we're saying when we're saying insured private credit, essentially allowing you to have access to unlimited strategies via the unsecured marketplace without having to take on all the responsibility and risk.
Thanks, Wes. So I still think it's a really fascinating way to structure like this kind of platform. Enlin, question for you. So, TradFi call them leveraged strategies. DeFi degens call them looping. It's one of the things that DeFi is great at, just because of the on-chain Rails efficiency. Applying that to tokenized credit is kind of like a different proposition from like crypto native assets. There's a lot of considerations. Before we go into these in a little bit more details, I would love to ask you what makes credit such an interesting asset class for those leveraged strategies?
Yeah, I would say in short, it's because credit has yield. If you look at equities or other types of assets, they don't really come with native yield. But private credit, for example, the large asset managers credit ETFs, they are yielding 6-7% right now. And this is due to lending to corporate credit, right? So these sub-IG companies may have high yield bonds or loans that pay a spread 300, 200 bips above the risk-free rate. But they are paying yield, and that's what makes it interesting to tokenize. And then in terms of looping, you can go to lending platforms and often get a better rate than the underlying asset. So this spread, if it's positive, creates an attractive trade for a lot of LPs. And I think a lot of the DeFi native users are probably used to looping permissionless assets, but permission ones like credit are possible on chain as well.
That's great. Weso, CAB is partnering, I think you mentioned some of these use cases where you're partnering with M11, you're partnering with WisdomTree, you're partnering with FalconX, and a few others. And I know there's a real breadth of use cases for those partnerships. What's driving most of the demand, and where do you feel like this is really coming from?
It's different parts of the system. So for WisdomTree, it's a money market fund. You can deposit it in mint CUSD. What that does is it gives any institutional borrowers that want to complete the KYC flow the ability to borrow a permissioned asset. So if they don't feel comfortable borrowing USDC, we'll have the money market fund you can borrow. Goes, WisdomTree, then obviously you can send out money market fund, gets the funds directly into your account, and completes that flow pretty easily for them. So that's more on like the institutional borrow demand side. For like, I'd say the underwriting side, this is like a new category we're sort of pushing out there. Like there are people that do risk and that can identify like unsecured loan risk, but I don't know that we have a whole lot of people in the DeFi ecosystem that are doing that yet. So we're kind of creating now this like new opportunity where people who have that skill set can come in and do that, right? And so we're working with a lot of different partners that are essentially assessing risk for people maybe who don't have that capability. We have a lot of asset issuers in the space. They're able to get the liquidity, and up until recently, the only yield was essentially like risk-free, right? So like looping and earning token incentives and selling it and getting that. But as that's starting to dry up and it's not there anymore, the yield's gonna have to be a little bit more risk on. So we're gonna have to see more real yield. And for that, there's gonna be risk involved, and there's gonna have to be somebody doing the risk assessment. And so I think now we're working with a lot of different partners, either ones that wanna come on and manage the assets for the asset issuers, or well, at least help them identify the different risk opportunities, or ones that are going to take on that themselves, right? Maybe they just want to be a risk manager and take on the asset curation part of that as well. So yeah, there's a ton of ways for us to work with a whole bunch of different people.
So many areas. That's actually crazy, yeah. Thibaut, so M11 creates the FalconX structured credit facility on Pareto. It's kind of like the first institutional grade, like tokenized credit product on this platform specifically. Can you walk us a little bit through like what you build and like more broadly, what do you think good infrastructure looks like for bringing like credit yield on chain? And what were like kind of like the design choices that mattered the most here?
Yeah, sure. I think first of all, why we built it was mainly addressing a need for like these institutional to borrow, and we weren't comfortable doing anything unsecured anymore. So we teamed up with FalconX and their prime brokerage engine and margin loans, basically covering these type of funding to these institutionals and tokenizing this leg on chain. But the thing is, and the way we approach that is literally from a very TradFi credit perspective, having this partnership and relationship with the FalconX team. We literally built a credit agreement, took a year long to build and structure everything. We have a credit agreement, the SPV, UCC filed in the US with all the risk mitigants and covenants you can think about, like a CLO type of product. And then the idea was to turn back to the ecosystem, especially on the DeFi side, being the Maven even buy-side originator and so distributor of this deal, and say, okay, who's going to be willing to tokenize that with us? And also who can adapt to this deal we have? Because in a way, we are looking for a tokenization partner, right, before everything. And all the terms in the credit agreement were already there. The event of default, the cascade events, and everything you need to support as an infrastructure needs to be covered. And it's kind of a tailor-made process then we did with the Pareto team. And so I think, first of all, there is a need for access control, obviously. So these KYB, KYC layers and so on, that's something that we built with the Pareto team for this product. And also, there is something a lot of people underestimate is the entire operational support and backend support that the team is providing. They're meeting the NAV, they are managing the entire netting of the flows. It's a monthly cycle liquidity, so they needed to adapt the smart contract to respect its terms. And myself, or the team as a risk manager, is basically inputting these parameters, just like on any type of other, Morpho smart contract or just smart contract where you have risk parameters. There's nothing like custody and so on, right? It's literally just adapting to the entire credit agreement, tokenizing a price share, and then the Pareto team, I would say the last type of, like the last characteristic we were looking for was on the composability and the knowledge of the team to make it the asset that we have right now on Morpho and so on. So we spent a lot of time also on Morpho. We did curation before with the team and so on, and we integrated the asset, very well aware of where we wanted to go with the assets.
Thanks. That's actually a great leeway into my next question, because what you can do, so if you're an LP into that vault, so you get credit vault tokens, so CV tokens, and then basically what Gauntlet has built through our Era Vault infrastructure and leveraging Morpho markets and Morpho vaults is basically an engine to lever these tokens by supplying them into Morpho markets and borrowing stablecoins against them and basically amplifying the yield. So it's grown into the biggest RWA market on Morpho right now, this FalconX Credit Vault token. And it's grown from, I think, when it launched, it was about 1 million in TVL, now it's 25 million, which I think is total 51 million size. And it's arguably one of the most, sorry, a little bit of shameless plug here, successful RWA yield strategy on the market, because it's right now sitting at about 13% APY. Anlin, what are the factors that made this work, and what's kind of like missing to like really take it to the next level?
Yeah, I think what makes it work is obviously the partnership that we have here with M11, FalconX, and Pareto. They are really great at putting in good loans over collateralized ones, where we're very comfortable with the risk and lending to it from the curation side, right? So as all curation teams do, we underwrite risks of what we lend against and supply liquidity to. I think being completely over collateralized has been a good reason why we got in so early and are able to make this leverage loop trade really work. I think generally like the borrow rate has fluctuated between like 4 to 7%, while the underlying APY has ranged from 9 to 15% over the last 8 months or so. So that positive spread is something that the looping strategy can really take advantage of. In terms of how we can make this better, I think one thing RWAs struggle with is there is very limited secondary liquidity. This in part is due to just like liquidity profiles of how RWAs are structured, because you don't want to make the issuer have to process redemptions every day. Like it may not make sense from the fund structure, but also this is a thing that people in DeFi may be used to. So that is something just in general, I feel like RWAs, there's a bit of a duration mismatch that the industry is trying to solve.
Thanks, Evelyn. Throwing it back to Thibaut, because you just talked about like curation and different types of curations. Like what's different between like curating private credit versus like, for instance, curating a vault on Morpho?
Yeah, there is obviously a massive difference there, I think. So on the role that M11 Credit has here on Pareto is literally to create and underwrite the off-chain partnership and the off-chain deal that we structured, right? And give back this lender report and give back this lender registry to the market. So we kind of, if we speak very like parameters, like we input the duration of the loans and we also input the rates, negotiating everything with FalconX, and then we give back the lender report with the loan mix and so on. So it's a lot more risk underwriting based, I'd say, on the TradFi credit knowledge. And when it comes to Morpho, we did it by the past, and yeah, there's a very different aspect to it, which is the risk parameters are also, in the smart contracts, you can input a lot there, but there's a lot of permissionless aspects to it, especially in the current version of Morpho. And I think that this is a complete different management and relationship-based management, essentially, because there is no, for example, access control was one of them. Access control is there on Pareto because it's KYB-gated access. On Morpho, with the current version, for example, the Gauntlet and Stakehouse team supporting this asset on Morpho, they face borrowers that they know because we know them, because the one that are minting the principal are KYB'd. That's not true for every asset, right? And then the reallocation knowledge that comes into play, the monitoring of this interest rate model, adaptive curve of Morpho, and the different listing of the different markets based on if they are DeFi assets, if they are RWAs, the type of strategy you want to deliver as almost asset manager, should I say, on the Morpho curation side, is a complete different knowledge and also a complete different ball game than tokenizing a private credit deal and pipeline. You master from A to Z and just focus on that only. So you tokenize an asset and put it on chain. You don't tokenize a vault, even if a vault, ERC-4626 Morpho vault is still maybe a token in a class share tomorrow, or maybe you know, anything going this way with a regulation question mark. But the strategy as a creator is completely different.
Yeah, and even setting the, like actually creating the permissionless immutable markets on Morpho for this token is very, very different from crypto native assets. And Lynn, can you talk a little bit about like the differences from like a Morpho curation and market creation perspective?
Yeah, I will say for RWAs, when you set up a market, typically the risk parameters are set a bit more conservatively. So things like LTV may be lower, caps may be set lower to start with, things like that. The liquidation penalty or the liquidation bonus for the liquidators will be higher. And this is just because the people who typically are able to liquidate these assets also have to be KYC'd in order to, you know, obtain the RWA. And we still need to incentivize and reward them for using their balance sheet capital and take on that duration risk there. So overall, RWAs, you know, in short, see more conservative risk parameters on chain.
So we've been talking a lot about like markets on ETH mainnet. That wasn't obvious so far. But Weso, CAP recently launched on Mega ETH, and you have bridges with Layer 0. And does that mean there's like demand for credit yield just beyond mainnet? Like how should we think about cross-chain credit overall?
Yeah, I mean, I think like insured yield, where people feel really comfortable with the yield source, is a demand everywhere. So the cross-chain strategy is more of a distribution play than anything else, right? So it's getting it into more different users. There's users maybe that use some side chains way more than they would use Ethereum for a variety of different reasons, making it accessible to them, both on, you know, actually like holding the asset side, but also giving them the opportunity to utilize, you know, Morpho for looping. And we obviously have a really close relationship with Gauntlet also to help seed those markets. So that's really the cross-chain opportunity when it comes to the actual like CUSD liquidity token. I do think it's very interesting for the possibility to utilize underwriting assets cross-chain. So maybe assets that aren't native to Ethereum, maybe like native Bitcoin, or other assets that exist maybe on another chain, in where we can still utilize those as the underlying collateral, be able to draw the loans on Ethereum, giving essentially a better opportunity for more liquidity on the collateral side. So we're also sort of like looking into those. So it's a multifaceted approach to a cross-chain when it comes to CAP.
Cool, that's very exciting, this partnership, by the way. And so when we talk about like tokenizing off-chain private credit and bringing it on-chain, like these do not behave like crypto-native assets. Like we have infrequent NAV updates. I mean, and Lynn, you talked a little bit about those factors. Illiquid secondary markets, liquidation considerations, obviously. It's very widely different. And how can you work around these when you operate like an on-chain leverage strategy? Like how does it play into what changes in the risk framework? Because obviously like it can't be like a real-time feed on some of those assets. And kind of like what happens when the strategy kind of needs to unwind gracefully?
First, I think reporting is quite important. Giving frequent reporting and regular reporting to LPs and making sure like LPs are comfortable with what they're lending to is quite key. In addition to that, I will say, in terms of like for RWA specifically, what we've done is we've had bespoke agreements with certain parties in order to make sure things can unwind if they need to. Again, like with RWAs, a lot of these agreements are just with KYC parties who have sufficient balance sheet and are quite trusted and are able to do so.
Cool. I've got a question for the entire panel this time, which is like, it's still very small in terms of like comparative size, like credit yield on chain. what do you think is kind of like the biggest blocker for like more demand to be driven from institutions at this stage?
Yeah, that's definitely a very good question. You mentioned the gap at the beginning, right? In the reports, 35 billion to 2 billion. I think that subscribing to such assets is definitely a fund subscription. So the fund unit that you subscribe to needs to be very well regulated. And the thing is, there's obviously my answer will be focused on the regulation, right? So I think there is a mismatch there in between on-chain asset managers or any type of players looking to distribute with like vault layers. Even nowadays, we're at Vault Summit. And the thing is, there's still a lack of clarity, and you need to be very non-custodial based, breaking down, giving out your entire strategy at first, all the risk parameters, LTV ratios, and so on. If you're in money markets, and you need to put everything on paper so that you don't fall in a gray area in the regulation side of things, and that should be okay. Otherwise, you need this SIMA license in the Cayman, or you need a CASP nowadays. And I think that's a distribution strategy and so on for the tokenized asset. Otherwise, a tokenized asset himself, there are leaders on the regulation side of things with Securitize, Spyco, and so on in Europe. I think these guys, they go for the fund unit on-chain, literally, and they don't go round like we did, having an SPV and a credit agreement of 100 pages with a joinder agreement that lenders have to sign in this SPV to participate to the liability, right? So, yeah, the fund unit is tokenizing the fund unit is one thing, tokenizing the asset is something else. I think there's a mismatch here on-chain people going for regulation, off-chain people waiting for regulation. But the pipe, I mean, the bridge pipe should be around the corner, hopefully. At least that's the conviction we want.
I think it's two different things. One is like tokenizing it, right? Like tokenizing maybe something that exists off-chain, and you're just like tokenizing that asset or that instrument, right? For us, it's actually like, how do we get institutions to actually borrow? How do we get them to use crypto? Which is, I think, found to be difficult. Some just don't know, right? They don't know how. They don't have maybe very deep crypto teams. But we've started to achieve that. So like for the first time ever, Susquehanna has borrowed from CAP as an unsecured credit line. So we're starting to make headway into that category and get those introductions and show them what the capabilities are and try to break down those barriers a little bit. Some of it has to do with privacy, right? Like traditionally, they're very private, right? A lot of the institutions, and the blockchain is not very private. So I think we're a little behind in that space in order to give the ability for people to maintain their privacy on chain. I also think size, like we just don't have the liquidity. They want to borrow in size. And so we have to kind of grow a little bit and start to build these products up a little bit so that we have enough size for them to make, actually like want to come in and borrow, and they can borrow at size. So I think that's some of the things we've seen. It's like one, they don't know. 2, they need privacy. 3, they need size.
I think in addition to legal and compliance related things like AML, sanctions, all that, right now credit on chain, there's a lack of benchmarks and there's a lack of fixed income ratings, for example, right? Like when institutionals think of constructing a fixed income portfolio, they typically look at metrics in the public market, like the public U.S. equities and fixed income markets. There's a lot of diligence and ratings and such, and that might be missing, and that's some of the feedback that we've got when talking to institutions, like how can you really tell what a loan is rated on chain? It just like doesn't really exist right now, so I do think there needs to be a bit more infrastructure built on that end as well. However, I do see like institutional firms like increasingly wanting to talk about lending platforms like Morpho. So I do think they are coming and they are interested.
Really good diversity of insights, thank you. Wesso, you mentioned, I think, growing like both the borrow side and the liquidity side. I mean, CAP is like a really good example of a multi-sided protocol where you have different kind of like sides that need to scale together. I think you mentioned 2 of those kind of like, I wouldn't call them bottlenecks, but like area of growth where it's still kind of like limiting. What kind of are your plans to grow those areas?
So what you just mentioned, essentially assessing the risk, is like a major issue, because Like I mentioned earlier, we have a lot of asset issuers, but they can't appropriately assess credit risk. So people are coming on, they're saying, hey, I want to borrow. They're well-established institutions, have a lot of history, but people don't know how to assess that risk. It's a little bit of a blocker for us because we need access to that over-collateralization for the loans. And in order to do so, the LPs have to feel comfortable and they have to have some sort of like credit risk ranking. And it's like right now, it's just not a market that there's a lot of participants in, but we have wonderful partners that are helping us and stepping in that space and doing a great job. And then because it's a three-sided marketplace, it's a little clunky in the beginning because at first we had a lot on the liquidity side. We had a lot that minted CUSD, but then the borrowed demand was there, and it took a lot of redlining when it came to legal on the agreements between the underwriters and the borrowers. And so by the time they were ready to go, it was like the yield wasn't as interesting because of just market dynamics, and so the liquidity sort of left. And so now we're left with a lot of underwritten already collateral that's ready to underwrite loans, a lot of loan borrow demand, and now it's kind of filling back up that liquidity side. So I'd say for at least a little while until there's a growth in the protocol, there's always going to be that balancing and the rebalancing that needs to happen.
Thank you. So in April last year, Gauntlet launched the first levered RWA strategy with Apollo and Securitize, and now we have this strategy with FalconX, M11, and Pareto. And it's kind of like the pattern looks a little bit similar, right? You have the tokenized credit, you have the awesome Morpho permissionless infrastructure that is powering the vault, and then kind of like the layer on top with the levered strategy. Enlin, how close are we? I know there are lots of considerations which we've talked about for RWAs. How close are we to something that's repeatable for new kinds of tokenized asset classes to come on chain and be composable for these types of strategy?
I think it is quite repeatable. One thing that I'm specifically also excited about is fixed rate lending and loans with Morpho V2, and there are other platforms as well. But I do think if this type of credit product is a rate set on a monthly basis, which does make sense for this prime brokerage type of setup, then maybe we should do fixed rate loans for a 1 month duration as well. So I think there are definitely improvements to the current strategy. There are benefits to variable rate as well, but there's also a lot of benefit to fixed rate lending when the duration is already known. So yeah, very excited for that.
Very excited for Morpho TBA, which I heard is related. Thibaut, what's next for M11? What are you planning for the next area of growth? What's the next frontier for you guys? And driving that institutional demand?
Yeah, sure. We have this focus on the allocation side, but maybe more on the risk underwriting side, and linking the dots with what Wizo just said. I think the risk underwriting need is clear. CAP, for example, shifted the risk model, and now we have this supply capital freeing up liquidity coming from the risk-taking industry, probably the best AVS usage so far. And us have a new position where these people in need for yield trust us as a risk underwriter, while there's still the same borrower demand, and the same borrower demand can only access this free liquidity, new liquidity, because these new risk takers trust us before everything to secure the loan. And this type of new improvement and innovation, thanks to DeFi, is definitely where we want to be positioned as the leader when it comes to sophisticated tech-enabled credit, let's say.
Thanks a lot. Thanks a lot, everyone. We're at time, but maybe we can we get 1 or 2 audience questions? One. We can get one question. We can get one question if anyone has a question. But maybe no one does. Oh, that's great. Saves us, and we're right on time. Thank you so much, everyone. Thank you so much to the great panelists. And come talk to us afterwards. Thank you.
Thank you. Please give us a few moments for a quick stage change. All right. And our next session will be about operational infrastructure for on-chain asset management with Patrick and Charles. Please welcome our speakers on stage, everyone.
Hello? Can you hear me? Okay, yeah. All right, yeah, thanks for coming today. So super excited to have Patrick here with me. He has...
We are doing digital and we have some problems.
Yeah. He has an incredible history of working on DLT technologies before blockchains were cool. And so with the first question, with your 25 years inside just fund operations, when you look at on-chain asset management, what's the single biggest gap in where you see the infrastructure today and where it needs to be? And what will it take for institutions to see it as superior versus just new and novel?
Okay. Good afternoon here in Cannes, or how we say here, bonjour Cannes. And thank you, Charles, that you make me a little bit younger than I really am. So it's 27 years now that I'm in the fund industry, but okay, it's a long time. So I'm really the, let's say, the traditional asset servicer, the traditional banker. And yeah, about the infrastructure and the gap that we see currently, you have to know that we will adopt blockchain and we will adopt on-chain asset management. That's for sure. So blockchain is there to stay. But all the asset servicers, and I'm coming from Luxembourg, so it's one of the greatest, the biggest industry, fund industry in the world, #1 in Europe. And the thing is that the infrastructure is quite monolithic. So we have very heavy legacy systems, a lot of Excel sheets, spreadsheets under these legacy systems, and a lot of human power. And we are experiencing, we are implementing, and we are analyzing to integrate on-chain management on that, but we cannot take out the monolithic block one by one and replace it by another one. So the gap is simply in timing, analyzing the different activities that we have on the value chain, and to see what are the immediate activities that we could put on chain or that we could digitalize. So I'm working on this already more than a year or nearly 2 years now, on analyzing all the activities of the value chain, which is quite segregated, but put it into one monolithic legacy system, and to see who are the best providers in the market for us to replace one by one the different activities and to put them on chain without replacing immediately the full legacy system. And we are doing this step by step. Tokenization is a topic for us, for sure, but tokenization is not the ultimate goal today, because it doesn't make sense, in fact, to tokenize an investment fund when at the beginning of the value chain, my investor still needs to fill in 20 pages of an application form. So we need first to digitalize the investor identity before thinking about putting all our investment funds on chain.
Oh, that's really interesting. So, I mean, if you had to choose one area, whether it's custody or a regulatory breakthrough, or even like a specific protocol or blockchain, which piece do you think is the first to unlock the actual institution adoption, or which piece means the most to you in terms of what you're building?
From my point of view, from my personal point of view, you mentioned all the ingredients that are there and that we can use. But it's difficult for us currently to use them all together and to create our perfect value chain, okay? So I will take them one by one. The regulation is there, and the regulation is strong. Okay, so I'm coming from a country where we built it already in 2019, the first blockchain law. We were in Europe the first, together with Malta, having blockchain laws before MiCA, and I was around the table for consultation of this blockchain law. So I have seen all the 4 blockchain laws in Luxembourg for consultation before MiCA, and in fact, MiCA is just regulation on top of all the others that are already there, because we can tokenize, we can create on-chain management, asset management, with all the regulations that we have already on the ground, on the foundation. You have AML, we have MiFID II, we have payment directives. They are there, and these are the foundations. We put MiCA now on top to say who is allowed to do what. Okay, so regulation is very strong, and we can use it. It's just a question of interpretation of the regulation. And I'm experiencing currently a case in my bank where discussions about a tokenized money market fund, for example, create a lot of discussions on that point. But the regulation is there strong. You talked about protocols. Protocols or standards is something that is very, very difficult for traditional institutions, because we don't have the knowledge. Well, there are some guys that can discuss about it. So I am 3 decades in the traditional finance and 1 decade already in blockchain. So I have my connections, I have my sources, I can work with them. But when I go to my, let's say, to management level or to top management level, they always tell me, Patrick, we don't understand what you're talking to us. Okay, so you are in a kind of a galaxy and we are still in the village. So we don't talk about protocols. So, but we onboard companies, or we discuss with companies who fully understand it, who can, and we trust them. Okay, and then you touched a very important point, and which is for me the holy grail of the future of finance, which is the custody. And the custody layer, I call it the digital custody layer. And this will change for me, in fact, the full value chain of an asset servicer, because I am particularly working in the transfer agency department. There is also, you have the depository department, you have fund accounting, and in fact the digital custody, this will be the single truth in the future of the finance industry, not only for investment funds, because on the digital custody layer we will put everything on it. We will put results that are coming from different modules that have digitalized things into this layer, and this layer will serve later on the regulator, it will serve the auditor, and it will serve, of course, the business lines. So this is really something that is becoming urgent to look at for us, because, for example, in Luxembourg there have been in February 2 so-called FAQs issued by the regulator. So regulator is very smart in Luxembourg. They are not only issuing regulation, they are also issuing FAQs. That it's easier for them because the interpretation of them is on our side and not on their side. But what is the essence of the FAQs? First, in Luxembourg, asset managers are not now allowed to put 10% of the NAV for UCITS funds into, so indirectly into crypto assets, and private market asset managers can put 10% directly into crypto assets, which will change a lot of things for us because our infrastructures are not ready for that yet. And the second and more important FAQ for me was the FAQ about stablecoins, because the regulator, through this FAQ, allows now that subscription redemptions into a UCITS fund can be done by stablecoins. And this is something, I say there is an urgency for us, and I said it last Friday before coming to Cannes to my top management, that we need urgently to see how we can now create this infrastructure Because the day will come that our investors or our clients will come to us and say, hey, I want to pay now with stablecoins.
I mean, speaking of stablecoins, the term institutional grade gets thrown around a lot, I would say, and it usually means it's just like a permission system with whitelists, user controls, and many other things. At what point do you think creating these institutional grade products is kind of against the purpose of building on the blockchain in general, and it just becomes a glorified, expensive database?
For this, you have to see the wording, institutional grade, or the term, in two different ways. And it was when I've written posts and articles about this topic. And for me, institutional grade is not only the code. Okay, it's not the protocol, it's not the infrastructure, it's not the software. This is one thing, of course, and a lot of builders have used this word just to put them on their website and entering into meeting rooms with traditional finance institutions to discuss with them. Okay. We look for core, of course, we look at the products and we will see if they have a kind of institutional greatness, you know, to see if the protocol is in line with our internal rules in the bank. This is one thing. So this is about the code and the technology. But for us, what is more important is the builder or the company itself. If this company is institutional grade, and what does it mean for us? There are different criteria. So first of all, we look at the governance model of this company. So we are very open for startup companies, that's for sure. But you have to understand, when you have a startup company and the grandmother is the only shareholder of the company, it's kind of a problem for a traditional finance institution to work with those builders. So we look really to companies that have a governance model, that have an org chart. We look at financial statements. So we analyze DeFi companies like a traditional company. It goes through a due diligence process, and there we define if the company is institutional grade or not, meaning if it fits into our internal rules. That's all.
So, I mean, on a similar note, like you had mentioned, I think it was 2016, your first project, FundChain. Yeah, it was one of the earliest deployments of like a chain-backed fund subscription model. What assumptions, when you were building it then, have changed or have become obvious now over the years?
That's a great question. No, because you touch a really important point of my career, which was back into 2015. That was the starting point of blockchain for me. I was at that time, in fact, director at PwC. And the only persons who talked about blockchain were, in fact, the guys in Bitcoin. That was it's a fact. And it was also at a management meeting of PwC that we invited a startup company from Luxembourg called ScoreChain. They are still in the industry with an AML compliance software, very known. And they were on stage and talking about blockchain, Bitcoin, things like that, in front of the whole management, partners, directors group of PwC Luxembourg. And so Bitcoin was far away for us. And but immediately I saw a potential in the technology itself. So I went to my partner and said, we will analyze this technology if you can use it in the asset management industry. So we started a project, an initiative. I was the project manager for this initiative with 8 asset servicers in Luxembourg, with big names, Société Générale, ING, BBH, HSBC. And we took ScoreChain as our tech provider or tech advisor, and they built it with us, in fact, the first smart contract for an investment fund transaction. And those guys had no clue about the subscription into an investment fund. So I remember a very funny story that I was with them in a meeting room of their company, explaining how works a subscription into an investment fund. And it was 4 p.m. in the afternoon. I left the room, I went back to my office, and I said, guys, I come back at 9 p.m. tomorrow morning, at 9 a.m. And at 9 a.m. In the morning, they showed me the first subscription on an Ethereum test chain. So that was great. And then we continued the initiative. To shorten the story, we had at the end, we had a full pilot for subscription and redemptions on dummy funds. So we were the first initiative in Luxembourg having a subscription on blockchain. There was a parallel initiative called Funds DLT. Well, the guys always tell me, or they tell publicly that they had the first transaction, but when I am out for lunch with them, because we are all friends in Luxembourg, they tell me, no, Patrick, it was you. And we wrote a white paper. Now comes the important part of my answer, because we wrote a white paper about the initiative with all the results. So, and then we tried out of this white paper to continue the initiative, but well, it stopped at one moment because the participants were called back by their headquarters to make own initiatives, but okay. But in fact, everything what we wrote in this white paper at that time is what I see live today. And this is important. It was a little bit our crystal ball that we had. So we detected, in fact, some showstoppers to say in 2017 or 2016, 2017, okay, we go live with tokenization of investment fund. Because we were missing at that time the cash layer. We had no cash layer. Today we have stable coins. So we can today combine a stable coin with a tokenized money market fund to create the killer use case. That was not possible at that time. At that time, we had no distributed AML KYC, but we put this in the white paper. It's all written down. And yeah, it's for me, I'm a little bit proud to see what we have written there, because everybody told us you are crazy guys. I remember that I was on stage and there were people from the regulator in front of me, and they were telling me, Patrick, this will never fly. Now when I meet them, they say, hey, yeah, we're right. And that's great.
Yeah, I mean, that's an incredible foresight. And as we approach time here, with that foresight, what do you foresee for everyone in this room who's building towards the future of infrastructure for institutions or just DeFi and whatever? What do you think is the area that's most needed to pay attention to, or like the biggest opportunity? And like, it could be something like custody or non-custodial, or risk standards and risk scoring frameworks for institutions to understand these asset classes better. What's top of mind for you for people to focus on?
The most important for me is in fact the convergence and the bridging of the DeFi world and the TradFi world. It's not about which product, which protocol, or whatever. It's really, and it's important to see events like here in Cannes. I was last year here. I saw more techie people than today, because it's amazing to see here now that there are also a lot of institutional people that I haven't seen last year. And all the conferences I'm on stage, I always see half of the room is institutional and half of the room is DeFi. So now they don't talk necessarily together. And this is very important for me. It's a call to action for all the Web3 guys that go directly to traditional financial institutions. Don't make some pass-through through contractors, introduce us, things like that. No, go directly to them and try to make some partnerships with them. So what we are looking for in the industry is that, for example, we want to do proof of concepts. This is how it works today. We will not, for example, for myself, my technique is not to do long RFPs with 180 questions, but I want to see how could it work in my architecture. So let's do proof of concepts together. Don't call me now today, everybody, okay? Because I have no time for everybody. No, but engage with the industry. So I think that it's not DeFi wins or TradFi will win. We will be all together in the next generation of finance, in fact.
I mean, I couldn't agree more. As someone who's built protocols in DeFi for the past 6-7 years, I wish retrospectively that I would have built alongside institutions instead of building a protocol and then trying to fit it into a circle, into a square peg. So anyway, that's it for today. Thank you for your insights, and thank you all for listening.
Thank you, Charles. Thank you.
Thank you. Next, we have a talk by Jeremiah from Open Cover about Vault native risk transfer challenges and key role for mainstream adoption.
Thanks, Parvina. Hey, everyone. I'm Jeremiah, co-founder and CEO at Open Cover. We specialize in complex and embedded DeFi risk transfer. And today I specifically want to talk about Vault native risk transfer. So Vault insurance, Vault cover, why it matters, why it's hard. And I also want to share an exclusive preview of the new Vault native risk transfer primitive that we'll be announcing publicly tomorrow. So if we think about Vault risk management, from fundamental principles, there's 3 pillars: risk assessment, risk mitigation. We've talked about these today. These help us minimize the amount of risk on a vault, but they cannot eliminate tail risk. And our industry's current approach to tail risk is just accept it, which works well in 90x% of the cases, except when USR depegs, except when XUSD blows up. And that's where the 3rd pillar comes in: risk transfer. Insurance and cover specifically exists to take these unknown tail risks and turn them into known fixed costs. No news, insurance underpins most of TradFi, a lot of the off-chain world. You can't fly a plane without insurance. You can't build a skyscraper. You can't even organize a conference without it. But in DeFi, we're still taking our chances. Less than 1% of DeFi is covered today. Why does this matter? Well, fundamentally, zero risk does not exist off-chain. It's not going to exist on-chain. So we need to give institutions, fintechs, general users, the same risk transfer tools they rely on off-chain, on-chain, if we want them to come in large numbers and be comfortable allocating capital at scale. This isn't a marketing thing. It's not a checkbox exercise. Over 7 billion was lost in DeFi to exploits and hacks. So I'm not talking about scams, malicious smart contracts. I'm talking about legit protocols that did not behave as intended. That's about 7-8% of DeFi's total TVL today. And what's worse is that composability increases chances of contagion when things go wrong. I'll give you an example. We did some payouts after the Stream XUSD incident in November, and about 80% of our claimants had no idea they were exposed to XUSD. Why? Because they had provided liquidity to a yield aggregator vault. The yield aggregator vault was farming an underlying yield vault, which itself had a lending protocol as part of its strategy, which had a market with XUSD as its collateral asset. And so the problem is when things blow up, users blame the interface, usually not the actual folks or thing responsible for the damage. And I think that's something that's quite important for some of us in this room, building vaults, distributing vaults. There's liability, or at least perceived liability, when you do those things. I saw this tweet a couple of weeks ago, which I think sums it up super well. It's the founder of a DeFi neobank discussing the risks of DeFi vaults offered by fintechs. And they're saying, from a legal standpoint, we are not liable. But in practice, that would be an untenable position. We would be forced to bear part of a loss, if not all of it. And so really the insight is that the best way to protect our users is also the best way to protect ourselves, which is to give them the option to transfer their tail risk if they want to. right? So hopefully we are all convinced that Vault native risk transfer is important for Vault adoption, for DeFi adoption. And that begs the question, if it's so important, why isn't it readily available? And the answer is that DeFi risk transfer, DeFi insurance is hard by itself, right? It's new risks, it's a constantly evolving threat landscape, and Vault native risk transfer is even harder. Because what you mean is Vault composable protection, right? Like you want protection that you can turn on and off on a Vault position anytime programmatically. Could be part of a backend flow, could be like a toggle in a UI, perhaps something like this. But really the point is you want policies that are arbitrary in length. That means that you cannot ask the user to prepay for a protection. You need to stream cover fees as, as the actual protection is delivered. And that is challenging for traditional insurance because traditional insurance is mostly built on yearly policies where you pay for premiums up front. And it's something that's quite tough to do. And in fact, if you're trying to transfer Vault risk natively, you actually need to look at about at least 10 challenges. We don't have time to go over them right now, but they fall into the category of underwriting, binding, so going from the user intent to protect, to kind of add protection or remove protection from a Vault position to actual underwriting capital being locked or unlocked, and claims, right? You're potentially looking at hundreds of thousands or more in claims if you've got a covered Vault that is, that is impacted and you need to do payouts. And the insight here is that doing Vault native risk transfer at sort of POC scale, like small scale, is doable. But the minute you start thinking about 8, 9, 10 figures of protection per Vault, things start getting exponentially harder. And that's the reason why it hasn't been done before, up until now. We spent the last 9 months working with core partners to solve these very challenges. And I'm happy to share that we've built, or we have now, the first Vault native risk transfer primitive that's live in production today. We can do up to $50 million worth of cover per Vault, and we're scaling that to $100 million plus, leveraging restaking capital later this year. I want to show you exactly how this primitive works. We're calling it a covered vaults. I'm going to show you on a Morpho Vault on base, where the net covered APY, so what you get after the protection fee is taken, is 4.21. So it's your sort of raw Morpho, like Morpho yield unprotected minus a fixed cover fee of 1.32% on this specific Vault. And this is the 1x unedited, uncut walkthrough. So first, you deposit to the underlying protocol. So we're not trying to change the primary point of deposit. We're just trying to augment existing vaults, interfaces, and infra to add this protection, right? So what you do, you would put, say, $1,000 into Morpho. You can use any interface, including the official Morpho one here, and you'll get some Morpho Vault shares in exchange for your deposit as a proof of deposit. Once you have those Vault shares, you come to the covered Vault, and you effectively stake them to start protection. You'll see this is an async flow because it's an ERC 7540. And the reason is that we need to make sure that there's enough capacity to actually cover the protection request before we accept the Vault shares being staked. So here we're using Nexus Mutual to, in real time, check there is enough capacity. And if there's not enough capacity, we immediately purchase it. And then once we have enough capacity, we actually accept the staking request. And you see now the user has $1,000 covered in the Vault. Very important, what is actually covered. We're basing the policy on the protocol cover wording of Nexus Mutual, which has been battle tested over billions in risk protected and millions in payouts. So there's an annex plus a core set of terms, and together they define the policy for every Vault. Of course, every Vault is unique, so every annex document and every overall policy is unique. And to check whether you're actually covered, you basically look at the TVL of the covered Vault, the amount that's been staked, and you compare it with what's backing it on Nexus Mutual. Here it's 1,500 USDC. There was only one depositor, so we are fully backed since it was only $1,000 of Vault shares staked in this Vault. When you want to rebalance your positions on Morpho, all you need to do is unstake. Again, it's ERC 7540, so you need to wait about 20 seconds on L2 to for that process to complete. But once it does, you just get your Morpho Vault shares back. You can go back to Morpho afterwards and change the Vault you're in, reallocate, and then potentially recover if you want to. So here you see we can withdraw the original amount minus a little bit, minus the little bit of premium that we collected when the user exited. And yeah, there you have it. We've gone in and out of the closest you can get to risk-free vol-based yield in about 2 minutes. If you want to try yourself, we've just made our reference UI available to the public, so you can go to opencover.com/vaults if you want to check it out, or you can come talk to me or send me an email on jeremiah@opencover.com. Thank you.
Thank you, Jeremiah. Now, please give us a moment while we set the stage for the last panel. Okay, our panel will be touching on insurance, pricing risk, and coverage in vault systems. And a nice session to follow Open Covers. And please welcome our moderator, Hugo from Scopelift. And our speakers, we have Charles from S&P Global, Marcin from Redstone and Credora. We have Lee from Nexus Mutual and Rupert from Aon.
Hello, everyone. Almost made it to the end. I think one more keynote after this and after the cocktail. Thanks for sticking in. Very well. So I'm Hugo. I used to work on cybersecurity, so on the mitigation part of vault risk management. And I think the previous speaker said that it was more about on-chain custody or digital custody being kind of the final frontier for scaling DeFi and going to the next level. But I think as the tweet from Morpho shown on stage just before, it's literally more about insurance and privacy as well. And on the privacy side, we at Scopelift, we are behind Umbra, the self addresses protocol. Yesterday we announced we're taking over operation of Tally, the governance platform. And that's who I am. I'm from Portugal as well. If anyone from Portugal is here, I wrote the Portuguese crypto tax law. You can thank me for that. But let's chat vault insurance and risk mitigation. That's why we're here today, and we have a great panel for that. So to start, perhaps picking up on Charles, being kind of the institutional OG here on stage together with Rupert as well. But having S&P Global kind of figured out like how to do this very complex and complicated business of risk management and pricing risk, something that in crypto it's not yet solved. Like retail clearly doesn't pay, they don't want to pay for insurance, despite of course like Nexus Mutual having a very nice business around the cover part. But as it was said, people are still not buying it as much as they should. But perhaps that's exactly what's missing for institutional adoption. And so I wanted to get like your experience on this. What do you feel that it's lacking based on your experience in traditional finance in order for coverage and insurance in crypto to work and unlock the next stage of adoption?
Okay. For those that don't know me, I'm Charles. I co-lead digital asset across all S&P Global, the different division. S&P is a leading credit rating agency, leading index provider, and a few other things. So your question is on really what is missing. So where, for vaults, that's a new type of structured product, and we should have the same discipline with Vault that we have in TradFi. So if retail doesn't want to be insured, I mean, we're not really looking at retail. We're looking at what the institution need for visibility on the risk, be able to price the risk and decide they want to be on the other side of it. So right now, I mean, Nexus Mutual will be doing an amazing job, and they provided a lot of insurance, and they pay, which is something that matters. But we're at a convergence where we can have, well, Nexus Mutual, but we got also Rupert here, and we got really TradFi coming in. So one of the things that we believe is really needed is help on pricing risk by third-party risk assessor that are not part of the deal, that are not investors, and that can just give an opinion with what we always do, a methodology that is public, that you can review, you can agree, disagree with. And we did that for stablecoin. We got the stablecoin stability assessment, and when we're looking at other places where we could do the same.
Yeah. Already back in 2023, quite early. And this is a great segue to Marcin, given what you're doing with Credora. And so I think the question here is, like, given that you are building a standard, how are you seeing like the future of that standard? Is it something that will it be eventually public but proprietary in some way as being developed by you? Is it something that you feel needs to be kind of built by the industry as kind of a consortium standard, or will have more of a model similar to that of TradFi, in which we have SP and Global, or sorry, we have Moody's and Fitch and all the other agencies?
Yeah, very good question. So, hey everyone, Marcin here. I'm co-founder of Redstone. We are top 3 Oracle in the space, have been operating for over 5 years without a single mispricing or downtime event, which reliability is the most important aspect for measuring an Oracle. And last year we acquired Credora, which is the DeFi risk rating platform. We are live on Spark, Morpho, soon Euler, ListaDAO, and many other DeFi protocols. We rate assets, markets, and vaults. And talking specifically about the question, I do believe we are very early in terms of standards in the rating aspect. We don't even have proper standards in RWA tokenizations. We, as Redstone, have created a very massive report on those standards. We published it last week. You can check it out on our X or blog. Together with Gauntlet and Dune, we looked into the open protocol standards, but also like proprietary ones like Securitize, Spyco, Tokeny, and many others. In vaults, we don't have standard widespread properly standards yet. Right now, everyone is, I believe, trying to go one way or the other. So it is going to be forging as we are moving towards maturity of the market. S&P is doing a very good job, I would say, on the more major assets. We as Credora also believe the risk ratings are needed like on a very broad level, because having some indication is way better than not having anything in general. We saw it with Stream Finance, right? Like, unfortunately, we launched Credora a couple of days after Stream Finance happened last November, but reactively we did the rating and would have given it a C-. And people seeing C- on that particular like asset or pool would definitely think a couple of times before they would allocate much. So on the standardization part, I think Ethereum Foundation is going to play an interesting role, for example, at least in the EVM's realm, because they are like unopinionated. They are going to help to guide to get like particular aspects to be like the main guidance in the framework itself.
Clear. So perhaps before moving to Lee, just wanted to try to understand, like, we are in the audience as user potentially a Credora rating to inform an allocation into a vault. Anyone so far? Well, not so many people. Just shows how early we are and how critical this is. And so, Lee, on to you. So, as head of risk at Nexus Mutual, you have like covered literally a lot of incidents, went through a lot of protocols trying to price the risk, and I'm very much a fan of Nexus Mutual back from my work at Immunify. And so then the question is, you also did like this interesting on-chain risk map document with open cover that I saw yesterday at an event, and it really shows how wide and difficult to cover is the realm of the risks in crypto. like what are the differences between like generic protocol cover and the entire surface attack versus like the more specific risks to vaults, and what like do investors need to be worried about, and even project building, of course?
Yeah, it's a great question. I'm Lee. I'm head of risk at Nexus. We've been around for the last 7 years. We've underwritten $6.6 billion in cover in that time and paid out over $18 million in claims. We've been around from the earliest days when there wasn't much data, all the way to now where we have, I think, one of the largest databases of hacks and different loss events in DeFi. Vaults have actually been around for quite a while in different forms. The big difference we've seen in the last couple of years is actually having token standards for vaults. The 4626 standard has reduced a lot of risk of faulty integrations, which used to be a large cause of loss. And now we've got things like 7540, that standard, which is built on the 4626 standard. So you can have asynchronous deposits and withdrawals, which is good for things like RWA markets and different risk in there. So we're seeing an evolution of vaults over time. Better infra, accessible yield for users. The problem is users don't understand the layers of risk underneath. So if you look at a protocol like Aave can have one layer. But if you look at something like Yo protocol, they're allocating to Aave and Morpho and other protocols, and the layers are deep. In vaults, you can get 13, 14 layers of risk, all have different components, oracle risk, counterparty risk in some cases, because there's custody at play with curators managing things. Some vaults are vaults of vaults. So that vault allocates to other vaults, and those vaults allocate to other strategies. It can get very, very complicated. The biggest thing for institutions, for retail users, or any audiences coming on chain, we cannot expect them to understand these risks because they are very complex. There are some very advanced people in the space, some curators in the space, that don't understand these risks, and we see some losses stem from that. The Stream Finance loss was a great example, because that wasn't really a vault. That was a 20-something kid managing money in an EOA, doing the riskiest stuff and rehypothecating their own assets. And there was no transparency, there was no standard for custody. A lot of people allocated to it because the yield was good, right? But one thing I often tell users, institutions, anybody, is if you're earning 25%, what's 25% of zero? That is the mindset that we need to have in the space to protect more users. So I think with vaults, it's really education, but also at the layer that you're depositing, you need to have an option to go covered or uncovered, because unless that's surfaced to users, they're not going to know that they can even get coverage in a lot of cases. And for institutions, for the rating agencies, you need to have something there that allows people to come in, so when a blow-up happens, like with Resolve, or one of the many loss events here in the last year, people don't go, well, it's not my responsibility, people should have known. There needs to be some layer for people that hedge those risks to offset the risk of smart contract losses, oracle failures, things like that in the space. And that's why you see primitives like tranching coming in and things like covered vaults with open cover, where you now have a very easy delineation of, do I posit into this thing without any coverage, or do I use something like a covered vault where I don't have to worry about it, it's all abstracted away, which fits neatly into the vault. The benefits of vaults, where as a user, I see yield, I trust the curator, I go in.
Yeah, definitely. And perhaps like after Luna, people are like, oh, if this API is higher than 20%, this is risky. But still, they will be like, oh, 10%, this is safe. But that was like the worst proxy versus everything else that needs to be done.
Yeah,
for sure. Rupert, what do you think of all this? No, more serious question. Like also coming in from Aon, like largest reinsurance provider in the world, major insurance player as well. Going a little bit back to Charles' question on the institutional side, what's the blockers here, and what are the main differences between like the way DeFi is seeing these versus the way TradFi has used to do it, and what are you doing to solve that?
Thanks for that. So Rupert Poland, I'm digital asset leader at Aon for EMEA. So we've been placing insurance for digital asset companies since 2013 with Coinbase. We continue to do things since. I think it's a really good question, something that all of our large traditional financial institutions are currently grappling with. How do we put funds confidently on chain? I think what Nexus Mutual have done is a great enabler of that, because it allows people to start to transfer risk. I suppose we can probably split the issue into two from an insurance perspective. So big institutions do need some amount of comfort to come on chain from insurance, just because that's what they're used to. The internal risk committees rely on that. And then you also have the issue of the amount of losses currently in the space. I think, to steal Jeremiah's stat, 7 to 8% of total TVL and DeFi has been stolen. That isn't an acceptable number for a large financial institution, so that will come down over time. But it's not, it's not an easy fix. We're seeing hacks becoming more and more sophisticated. So I do think there is a bit of an arms race going on between the bad guys and the good guys. And at the moment, if you're looking at 3 to 4 billion of losses, unless you get proper risk transfer, serious risk transfer as well. So Nexus Mutual are doing an amazing job, but they do need some. They've got a 50 mil per vault. So if you're a big bank and you're looking to deploy 1 billion of assets there and you want one-to-one coverage, Nexus will continue to grow, but it'd be great to have some other insurers who are able to provide that support. And I think we're currently on a bit of a precipice there, because there are issues with the insurance industry which don't align perfectly with DeFi. I think we all want to deploy into Vault strategies and pay for the insurance that we actually use. We want to be able to scale up and scale down our insurance, and this just doesn't work with existing models and frameworks. So there is a bit of evolution there. It will all be solved, but it just takes a bit of time.
Yeah. Makes sense. Very well. Let's proceed. I was curious to know a little bit about some of the more exotic risks, perhaps, and how everyone here is kind of trying to think about how to price them. So I'm talking like some governance attacks, even on the security side, for example, like it will be easy with the Balancer example to see, oh, like these guys are checking all the boxes. They've done multiple audits, they have monitoring, they have bug bounty, they have everything. Still, like these very old bugs surfaced and was critical. How are you wrapping your minds around this? Because this is like very prevalent in crypto, and it will make insurance and cover more expensive, and that's bad for everyone.
Yeah, I think one unfortunate fact that we do have to get our heads around is the fact that there is asymmetry between the bad actors and the good actors. If you're a smart contract auditor, you're spending maybe 5-6 hours. If you're doing a massive audit, you could potentially take significantly longer, but it comes down to cost. How much is the Vault curator, the smart contract protocol willing to pay for this audit? If you're a bad actor, you can sit there and you can monitor a protocol for a long time. You can test it, you can play with it, and you can find an exploit. And as soon as you find that exploit, we have a balancer issue. And you think about the upside from that, it's significantly more than what the smart contract auditors are being paid. And we have the same issue in traditional finance, where there is a big payout if you exploit. And a bad actor doesn't have a compliance department to work with. They can employ AI, they can work significantly harder for longer, and they don't have to get approval each time they want to use a new technology to prevent something, and they only need to leave once. So I think we're seeing more and more that technology is being better utilized outside of large traditional finance institutions, and that could really cause the issue to get worse over time.
I also think when we talk about what protocols are doing right, having a bug bounty program, getting audits, all of these things are great, but an audit is a snapshot in time. If you change the code over time, if there are mutations from what was in the audit in the commit, if the code in GitHub doesn't match what's actually on chain, it's not the same risk. So this is one thing I'm always monitoring at Nexus when we're looking at a protocol. Do I have access to the code? Can I review it? Has it been changed since audit? What has been changed? How does this impact the risk? Things can sit for a while and be undiscovered, and then they can be uncovered and exploited. It can be from a black hat, and it can be from a white hat that does it to rescue funds and get them out. The problem is, in our space, most protocols aren't that old, right? Balancer was 5 years old, but we've seen hacks on older protocols before. Most protocols are 1 to 2 years old. So the risk of a protocol that can be upgraded, that can have new code pushed to it over time, that risk changes. And so you always have to look at that. Pricing that is something of monitoring those changes, looking at the code, assessing the quality, looking at the changes, were the changes audited? Do they have monitoring, but also do they have good practices internally? You have OPSEC failures that aren't even smart contract related that you have to look at too. For things like governance attacks, It depends on how you define that, but looking at a governance takeover, like the Beanstalk exploit that was from, I believe, 2021, they were able to push through a malicious governance proposal, take over the contracts, and steal all the funds. On the other side, you've got things on Compound. On the one hand, you've got code that was pushed through a governance proposal that was faulty, that released a lot of Compound tokens. And then you've got someone like Humpty, who came along, which is a great name I'm sure everyone here loves. He acquired a lot of Compound. He voted with it to basically incentivize a token that he had launched, and people were very worried about this because they saw this as a governance attack. It depends on how you define it, but if you're looking at things from a loss of funds point of view, having faulty code pushed through an upgrade that no one catches, these things have happened even with Moonwell governance, where they had Claude help them with an Oracle update that then was faulty, that led to $1.5 million in losses. You always have to look at these things because the risk is always changing on chain. Nothing is static. So you can have a great security practice, but if you're not on top of things, eventually someone will find those risks and exploit them.
How often are your credit ratings updated, Marcin?
So it really depends on the asset and the vault. It can be either between 3 months and 24 hours, at least right now. We try to diminish that time depending on what exactly is being graded. When it comes to those kind of governance risk, we look at the concentration of voters, like what have been the historical proposal, whether there is a time lock, and many other aspects in there. But I do believe we are so early in the rating space that those are, so Balancer, I would call it a black swan, like the exploit over there that happened with the code that has been around for such a long time. One thing I hate is when someone tells me bad luck or black swan was like Stream Finance, as you mentioned. No, it was like fundamentally badly designed product and very unprofessionally run, right? So I do believe, at least with Credora, what we try to focus on right now is mainly distinguish something that is absolute crap, I'm going to say that, from protocols that actually have fundamentally some sense and operating pretty well. Etina is, for example, an interesting one. It has already survived a lot of stress tests. Should it have an extremely low rating? I don't believe so. I mean, it's for sure better than, for example, Stream. Should it have the same rating as USDC from Circle or USDT from Tether? Probably not as well, because there are different risks associated with that. So we rather would like to have a cutoff from the things that fundamentally shouldn't exist and people should not allocate in there, from those that might have a lot of reason, and also having those that are absolutely blue chip, like the well-regulated stablecoins, and those that are kept in a very well fashion.
So quick disclaimer, I'm not part of the analytical team of rating, so I won't touch on the different specific risk. That said, there is no doubt that there is now a confluence between the traditional credit risks that we know and are still very relevant, and the cyber Web3 risk, which can be related to the smart contract, like it was touched on, but then also all the operation. Like you can have a perfect smart contract, but if you have somebody doing a typo in a form, like we've seen with some stablecoin, and you mint trillions of stablecoin, I mean, it can go bad. So there's a lot of compliance that need to be checked. There is this need to consider basically all the operation and all the Web3 risk, and that's something that most institutions, I think, understand more and more. I mean, it's funny because just today I spoke with two founders of different groups. I won't name them, but both of them had this constatation that they think that the institutions that are coming in don't understand the risk, and you may agree, and they think that, well, eventually some of them will blow up. So I guess the experts in the field in DeFi are already having some feeling that, well, institutions are coming in but don't understand the risk. And we are at a stage where, a few years back, people were thinking, if they should look at the field, should I look at a stablecoin? Should I look at vaults? Now everybody's at the stage on how. And the full understanding of all the risk that we have in this field I mean, it's extremely large and complicated. So also in the field, I mean, we spoke of stream finance, we spoke of Resolve. Every time there is a hack like that or some exploit, everybody's suddenly interested in the yield, in the risk. But then a few months back, we go back to the same cases over and over again, right? Like, why would you actually put money in Resolve? There was not a really clear way to assess the risk for the average user, right? So we need, and on the more retail and small institution, like we need a better recognition on the lack of visibility on risk that we have right now. There's just a real lack of visibility for most people. And if we want the trillions to really come in, that's something that we need. And that's also why they will want insurance, right? Because they know that all risks might not be covered, they want to be insured. And the problem that we have right now with insurance is if you want to insure billions, and it's not necessarily something that can be done because of the size, and even if you could, and I heard some example earlier in the year, the price is too high. So my question back to you guys is, what can be done, and how can we help, of course, to get real insurance? I mean, I don't want, I mean, you're doing real insurance, but like insurance that institution can use at scale at a price that makes sense.
This goes back to what I touched on earlier, is people look at brands and don't differentiate those from protocols. So looking at Aave, Aave has been around forever. They have a great security posturing. They do continuous audits. They are on top of it in security, the largest lending protocol, so they need to be because they're at the bottom of most yield stacks. Aave v3.6 is several months old. So you have protocols that are updating things, and that risk changes. The models that we see in DeFi and lending is peer-to-pool, has exposure across these different markets. If you look at something like Morpho, it's isolated, and you can cover those thin layers for a very low cost, but the risk is not all the same on Morpho because the different market allocations make up the risk. So you can, some people will say, I think this thing is safe and should be cheaper, and then I start running through with some of the funds and institutions that we work with. Here is really what you're exposed to, and also these people are running the strategy. We can't cover this, but they're running it with EOAs and multi-sigs that have no time locks, no guardians, so you're kind of at their whim, and they don't have any whitelist structure in place. So if someone downloads a PDF that's malicious and they can lose all their money, that's in the stack as well. So sometimes what people see as being safe is actually risky, and in markets like this, when yields go down, you know, people are competing to outperform other funds, protocols are trying to gain users. They move up the risk curve, and that risk versus reward isn't quite there. What we can do is have better security practices, that's what we're seeing, and we can refine the data over time. We are seeing fewer smart contract hacks. Most losses are caused by operational security failure, but we just need that to come down over time, get that data, and then work with more people, more protocols to offer coverage. And I think we'll see losses come down over time. We have better infrastructure, things are getting safer. You know, we just need a little bit more time because DeFi has been around essentially for 6 years. It's not that long. We have lots of data on hacks, but I think we need things to mature a little bit more. And like I said, the average protocol is only a year or two old.
And just to add on that, and not to be too reductive, digital assets move very, very fast. In traditional finance, it takes a long time to move a significant amount of assets, and that really does change the risk landscape. So if you go into a large bank and they map their probable maximal loss, and that's a term that actuaries hate, so if there are no actuaries in the crowd here, but if we look at the probable maximal loss of a bank, it is pretty low compared to their assets under management custody. So they're able to buy in the insurance program, which is pretty adequate, which is a mere fraction. So the cost of the insurance is quite expensive, but if you work out the amount of assets and the activities that it's covering, it becomes a lot cheaper because it's just a matter of scale and different products and covering lots of things. In this world, if something goes wrong, you can go badly wrong. And suddenly you could be looking at a total loss within a protocol. We've seen that a few times. And that does change the landscape, but ultimately it does mean that insurance needs to catch up and change the way that it works because its current systems of assessing risk of insuring risk don't necessarily marry up with what's happening. It does mean that there has to be a cost with it, and I know you do a lot of work around modelling and pricing, and I think it's fair to say, correct me if I'm wrong, but you typically around 2.5% to 5%, which is a lot, especially in relation to is that correct?
It depends on the protocol. I mean, we have coverage for things like Uniswap where you're talking it's between 30 to 45 bips.
Sure.
We can do coverage on morpho markets that are individual layers for in the same range. But as you move up and there is more risk, the probability of loss gets higher on things. And again, that's always changing and evolving over time, depending on what assets go in, something like Aave. If Aave has a lot of exposure to Athena, and Athena is also putting in their reserves of stablecoins and lending it on Aave, if a spiral happens, there's utilization goes to 100%, people can't withdraw, including Athena, which means they can't potentially honor redemptions, and you get a spiral. So we have to constantly look at those things and price those in to our coverage. And this isn't just on Aave, this is on across all lending markets.
So I think that's an interesting point then. So it comes down to selection of the protocol, perhaps, as well. So if you think, if you go for a lower risk protocol, then you can potentially justify the cost of insurance. But if it's if you're earning 9%, you don't want to be giving away 4%, but perhaps actually that's because there is serious risk there and it's not something that we should be doing. I think over time, the risk will come down, practices will improve, and then suddenly the cost of insurance becomes less aggressive. However, I think we'll still be talking about a lot when you compare it to the traditional world because of the speed of movement. But hopefully, the returns will go up by a greater amount through the increased efficiency that we have.
Hopefully. And perhaps this question is a bit meta and only relevant a couple of bull markets down the line, but always good to talk about these things in advance. And given that in the traditional world we have had some major issues with how credit agencies and the risk ratings were abused, either by their own agencies or by the market, because something happened, like some measure appears, some standard appears, and people will immediately try to game it for their own benefit. So talking like 2007 financial crisis, Icelandic banking crisis right after. Do you see any possibility of this happening in crypto down the line, and how are you guys trying to position, and how should the industry as a whole position itself to try to mitigate this?
I think I'll pick this one up. A lot of things here. So first, all the methodology that we have are public. Anybody can look at them. Especially in crypto so far right now, most of the data is public too. So whichever assessment, for instance, we may create or that do not involve public data, anyway, you can, opine on the methodology. You can disagree with it if you don't think it's the right one. But at the end of the day, the analyst will follow this methodology. It's true in finance too, even if we can get access to private data. Now, will people try to game the system? I mean, many, if they are by the actors everywhere, they always try to get an edge. I'm not concerned about the risk within rating agency. There's been a lot of things done. All the analytical side is fully firewall. I can speak with them without a chaperone. I can speak with them if you're here. So that's not the issue. Now, they are, evaluating the risk comes with, you need a reputation. It's a reputation business. For instance, UST, we launched our team in 2022, and at the time nobody cared about risk. Right, the yield was 90%, but there was startup doing risk assessment, and I remember 3, I won't say a name, that had UST as the safest stablecoin. When everything collapsed, 2 of them just closed shop, and 1 of them removes the line and basically say, I never said that. So that's why you need third-party risk assessment by institutions that are absolutely independent from the deal, that are not invested in the token or whatever, or the vault, but also have a reputation that is at risk, right? Like, for instance, S&P is close to 175 years now. We care a lot about everything we do. Like, if we want to do a new product, there's a lot of process. We'll never do something that can endanger the brand. And I mean, that's not a guarantee because everybody can always have a mistake, but we will do all things to provide as much visibility to the market as we can.
I think this opens an interesting potential for risk ratings being publishing the ratings on chain. It will be kind of the obvious thing to do.
Which we kind of did the first stage of that. So for instance, the stablecoin stability assessment was put on chain last year. And it was a demonstration of capability, right? If we can add the on-chain, the risk of stablecoin for DPEG, if a client wanted to have his rating or another product attached to his token, I mean, we could do it. Now, the demand is just not there.
And Marcin, how in this segue of the on-chain work, are we planning to position Credora there? I'm not sure if like Catalysis with their on-chain risk solution is doing that, but like how would you frame that in the competitive environment?
Yeah, so that's clear that naturally Credora has nowhere close brand to S&P. Like guys have been around like for a very, very long time. But we are definitely like quicker. I mean, like in the sense that we're already in the market, we are rating those Morpho vaults, like it's not theoretical. All of those ratings are public. Yesterday, we announced the publication of Credora platform. If you go to app.credora.network, you're going to see all the ratings that we've delivered on Morpho and Spark right now. And as I mentioned, right now we are doing it for other platforms. All the methodology is public, reports are public. This is like the kind of a brand that we put over there. We can be wrong, right? Trust me, we would not rate UST as an A. We have some really bad ratings over there, like C or like C+ maybe. So you can easily like distinguish between one and the other. As you mentioned, there are going to be second order magnitude use cases from our ratings. Right now we have over 20 companies building on top of our API to define, for example, premiums on insurance protocols, and also AA agents. So AA agents are investing into various strategies over there, but many of the times the problem is of the turkey, like everything is okay, and then one day slash, and it's a bad investment. So right now we see people creating AA agents that can invest only in the assets and markets and vaults that have their rating over there. It doesn't mean that they cannot invest in something that is a C rating, but the agent should understand what's the risk associated with that. So I do believe there's going to be like the whole ecosystem, like for example, Catalysis. Hopefully, maybe one day we can also collaborate with Nexus Mutual about that to not necessarily like replace the whole like internal risk engine that they have, but be complementary. Because from our perspective, Credora is like an independent team and independent brand from Redstone. We just acquire like the brand, but we have nothing to say about the final rating. It's all public, and anyone can verify that. Yeah, so that's the kind of like the risk our DeFi that we push for. You don't need to necessarily invest only in the highest quality products with the best rating, but you should be aware about the risk associated with your decisions.
Kind of a yes or no question to wrap up, as time is almost there. Are you seeing any other protection constructs potentially scaling in the absence or complementary to insurance as well, such as creator first loss, liquidity guarantees, or any other interesting mechanisms out there? Heck, even back in the day, bug bounties were kind of the first abstract way to insure.
I think we're seeing a lot more interest in risk tranching. I think people just have to be careful there. There's a lot of interesting primitives that are being built now. It's not a replacement for risk transfer, but it is a way to mitigate some losses. Some things that you don't want to do is take that junior tranche and then put it into a lending market and lever up on it. I think some people here in the next couple of weeks are going to learn that the hard way, that it's a very bad idea, especially when the issuer of the asset is the one that's controlling the oracle for a lending market. So we have to be careful on those things, but I think we also need to educate people what junior capital and senior capital is, because people like to think they know what risk tranching is in DeFi, but based on what I've seen here in the last couple of years, people go in, they get slashed when they're in the junior tranche, and then they go, no one told me about these risks. But I do see that as probably the biggest source of scaling outside of insurance.
Yeah, insurance-linked securities as well. There's a massive market for that, and there's a load of cool projects. So lots of the people at the summit today have got some great things going on.
Any other ideas?
Not really a new type of insurance. I mean, our focus will be to continue to provide as much visibility as possible so that others can come with new idea and leverage this visibility on the risk.
I do believe more discussion on like public forums and calling out people that are not necessarily like making the good choices and like the scalable ones. From our perspective, for example, the moment we published risk ratings on Spark, we saw an inflow of $200 million within the next 5-6 days, which can also like somewhat showcase that people actually do care about like some sort of like rating out there.
Nice. I thought you were talking about Lee's call out moment ago on his previous intervention. I'm curious about what's going to happen in the next few weeks.
Yeah, I mean, that's mainly on Resolve, right? There were a lot of lending markets on Morpho where you could have RLP, junior tranche, loan to value was 86.5%. It's, you know, unclear if they're going to slash the RLP holders or not, but that is the junior tranche for Resolve, and they have not announced exactly how they're going to do the reimbursement. So I would estimate that RLP holders may get slashed here. And if they do, if it's slashed by, let's say, 50 to 75%, those markets will instantly have bad debt, and there'll be more bad debt in those lending markets that accept it as collateral. Yeah. So that's a problem.
Very well. Thank you very much for this panel, and off to you, Pravina.
Thanks a lot.
Thank you, Hugo, and our panelists for that session. And now we have our final keynote, which will be by Reed Simon, about how real credit becomes DeFi collateral. Welcome Reed on stage, everyone.
Hey guys, how are you? I'm Reed Simon. I'm head of digital assets at Figure. Figure is a public company in the US. We are probably most commonly known for tokenizing HELOCs. We've done about 22 billion to date, all natively originated on our system. But bigger picture, we're really about building, or reinventing rather, TradFi markets and capital systems on-chain, specifically asset finance. And you know, if we think about DeFi at its core, it really is an asset finance really construct, right? You're not underwriting the borrower, you're looking to the collateral, you're looking at the liquidity, you're looking at the volatility, and ultimately how can you liquidate those assets. But at the same time, you know, if, and we've had a lot of panels this week and bigger picture questions around, well, there's how many trillions of dollars of private credit or credit assets, and why are they not coming on chain more quickly? And the reality is, while our current systems work fantastically for Ethereum, stablecoins and other liquid tokens, they just break if it's a loan. And so that's what I'm excited to talk to you guys about, and why we believe we have found a solution for that. So the real problem is the collateral problem. Loans are coarse. Everyone in this room could have a different HELOC. You have different maturities, you have different sizes, they're non-fungible, different interest rates, different FICO scores. They might all be similar, but fundamentally they're not fungible. And we can use, you know, a simple example for auto loans. So if someone were to originate an auto loan on, say, Figure's platform, let's say we lend someone $42,000. We take that tokenized loan and we try to pop it into maybe a Morpho vault. There's no curator that would approve that, there's no curator that would approve that to provide liquidity against it because there is no liquidity. If markets move and you need to liquidate maybe $5,000, it just doesn't exist because it's a $42,000 loan. And it's really these friction points that we feel are what blocks more credit assets to coming on chain. And this, again, is the problem that we have solved. So our solution we call Figure Forge. Very simply, similar whole loans, in this case auto loans. They could be different sizes, but roughly the same sort of risk tranche. They go into the Forge, they get priced, and out comes fungible, standardized $1 units that represent or are the actual entitlement to the cash flows of that underlying pool. So it's a structure that works for how DeFi operates today. But that isn't sufficient, because the reality is it's great. You could accept that token as a collateral asset, but if there isn't any liquidity there, it still doesn't work. So liquidity is a big piece of the puzzle, and I think it's the genius really behind what we've built here. So Figure sits at an interesting intersection between TradFi and DeFi, and particularly between securitization buyers, so your largest asset managers, and institutional buyers on Wall Street, and originators of real-world assets that then get tokenized on our platform. So what we've built is a liquidity system here where Figure can sit in the middle and really operate a liquidity pool of these fungible $1 loan participations against stablecoins. And what's interesting about this is because we're connected to securitization markets and because we're connected to the originators, when those loan participations trade sort of below market, we're able to arbitrage that and facilitate a sale into securitization markets. And in the inverse, when those tokens trade rich, it actually incents originators to come in and sell into the pool. So we've built a really elegant solution for really being able to help bring on a whole bunch of different asset classes, but to facilitate doing that with the technology that exists today, liquidity models and vaults that are already there. But in order for that system to really be credible, you need to have someone who's operating it, who has both deep experience in credit origination, but more so actively participating across the full value chain. So Figures originated, as I said, 22 billion of tokenized HELOCs. We structure those HELOCs in securitizations. They've been rated AAA by Moody's and S&P, and we've even ultimately distributed 350 million of those yield assets into Solana pools. So I think in totality, we have the chops, and demonstrably so, to be able to operate this system. So Solana was really where we sort of tested this and built our MVP, and I think the results speak for themselves. 600 million in prime deposits on Kamino's market for our lend. 5 of the largest curators are deployed and supporting the asset. And I think most interestingly and importantly, it was all done with 0 incentives. So this wasn't some like smoke and mirrors. And I think that is demonstrable of proving out that there is organic demand for these products and they can function in DeFi the way DeFi operates writ large. So one big announcement we have to make is we're coming to EVM. So we're announcing a partnership with Morpho and Centaura to curate Prime, as well as some of our other assets that will be coming on. So we started with Solana, we're moving to mainnet. We started with home equity, we'll bring that to mainnet. We have auto loans, we have SMB, and corporate receivables, a whole host of other assets that are ultimately differentiated yields, differentiated maturity, fungible, constructed and restructured by Figure, and all composable with your vaults the way they operate today. So with that, if you want to join the waiting list for our Ethereum launch, it should be in the next week or so. But we're excited to really bring these unlocks to the birthplace for DeFi and usher in a whole host of new credit products from TradFi. Thank you very much.
Thank you, Reed. And now, thank you guys for surviving the day. If you enjoy yourself, make sure to join us in New York, 5th June, Vault Summit. We have Fidelity, Laser Digital, Morpho, of course, a bunch of other speakers already confirmed, and tickets are very, very limited. So make sure to join us. It's happening during New York Tech Week, alongside a few other events. Stable Summit, I know most of you know that. Vault Summit on the 5th. And a new one, Agentic Finance Summit. So I know some speakers mentioned like agents allocating to funds on chain. If you like that kind of content, join us on the 3rd at the Microsoft office. The EEA is supporting us at that summit, and yeah, see you guys in New York. And now we have apparel for everyone.